everyone, and welcome. On behalf of Traders Corner, I'd like to thank you for joining us today and for the Investors Summit Stock and Options special event. Today's event is designed to be a high-value educational experience where you'll hear directly from some of the most talented and experienced traders in the industry. With heightened volatility in the markets and ongoing geopolitical unrest in the Middle East, investors and traders are navigating a very dynamic environment right now. And in times like these, having professional insight and disciplined strategies can make all the difference. Throughout today's summit, our presenters will be sharing the tools, frameworks, and perspectives they use to identify opportunities in today's markets. Each speaker will deliver a presentation, and after they finish, I'll return briefly to thank them and provide a special discounted link if they don't already in the chat box. So if you'd like to learn more about their work, be sure to check it out and keep an eye out for it in the chat box. So let's get started. Our first presenter today is Chris Sayre. Chris is the lead consultant at BigTrends.com, and he brings 38 years of experience in the financial services industry, including roles as a portfolio manager and registered investment advisor. For the past 14 years, Chris has focused on helping traders harness the power of systematic options trading strategies. His presentation today is titled, How Our QQQ Options Strategy Has Been Hitting Doubles Within 48 Hours. Please join me in welcoming Chris Sayre.
Thank you, Anthony. What a great introduction. And on behalf of Price Headley, our founder and CEO, and the rest of our team here, thank you for having us at your event today. As Anthony was saying, my name is Chris Sayre. You can see that there on the opening slide. Lead consultant at Big Trends. Before I go any further, our team makes me read this to you, so please bear with me. The information provided in this presentation is based on our proprietary research and is intended for illustrator purposes only and are not to be construed as specific advisory recommendations. Stocks and options trading have large potential rewards, but also large potential risk. The past performance of any trading system or methodology is not necessarily indicative of future results. See our terms of use on the BigTrends.com homepage for more information. So we are based in Lexington, Kentucky. St. Patrick's Day parade is going on outside. It's Pi Day. It's March 14th. If you get into all of that, more about that later in the presentation. Not going to read all this to you. If you're new to Big Trends was started by Price Headley in November of 1999. So we celebrated our 26th anniversary back in November. I was actually one of Price's earliest clients, as Anthony told you, and as you can see there, been in and around the financial services industry for several decades. I'm 57 years old, been trading and investing since I was 18. Speaking of years, as Anthony said, I've been with Price and his team over 14 years on the front lines, assisting traders and investors just like yourself. The office is closed today, but if something pops in your mind over the weekend, you see our contact information there at the bottom. Our office hours are Monday through Friday, 9 a.m. until 5:30 p.m. Eastern time. Enough about us. Let's talk about you and why you're so gracious to share some of your time with us on this Saturday. The name of the trading system, as you can see there in yellow, is QQQ Options Playbook. So right off the bat, we're trading one security and one security only, the Qs as they are known. We're going to talk about how we boosted results with less work, tactics from our many decades of experience. Speaking of less work, it's one of the things that I've heard over the years. Most traders don't want to screen watch all day long. They want something fast and something efficient. I have that for you today. Also have success stories and stories that don't work out, right? Because there is going to be losses in trading. So I have success examples. I also have some trades that didn't work out as well. Lots of those because I believe most of us are visual learners. And I'm going to share some of the details of our QQQ Options Playbook trading strategy with you today. And of course, have a special Pi Day package for you. If you're not familiar with the Qs, why are the QQQ one of the most powerful trading vehicles? Now, I'm not going to read every word on this slide to you, or I would eat up all my time that Anthony has allotted to me. But as you can see, it tracks the NASDAQ 100. It's packed with the market's highest octane leaders, NVIDIA, Apple, Amazon, Meta, Microsoft, and other names that you're familiar with. As traders, bullet point number 3 here, elite liquidity and efficiency. If you've been trading any time at all, market makers will typically let you in very easily. Sometimes getting out of a trade can be a little bit frustrating or complicated. Trading the Qs, you don't have that. There is ample liquidity. Lately and historically, the Qs have had higher volatility, and it is one of the most broad-based ETFs out there because it is covering those NASDAQ 100. And then here at Big Trends, we're systematic traders. We're technicians. We use price action. We use technical indicators. We all know how to read financial statements, but we're not here looking for investments. We're looking for trades. So trading shares of the Qs, as you're going to hear me call them, would be attractive enough, but our QQQ options playbook takes things to the next level. So let's start by looking at a winning trade example. Now, there's some things I want to point out to you about these charts that I'm going to share with you today, okay? All trades are going to be based off allocating $1,000 a trade. Now, please hear me when I say this. You do not have to be $1,000 per trade trader to be a subscriber to our QQQ options playbook. You can do this strategy for as little as about $500 or $600 a trade, okay, based off the 12-month average recommendation. Each candle that you see, red or green, represents 1 day of trading action. And then you're going to see this technical indicator down here at the bottom. And this is percent R, percent range. Now, Larry Williams created the Williams percent R, but Larry used a negative scale. We like the positive scale, as you can see over here to the far right. This first green line is 40. The second green line is 60. More about these windows in a minute. Now, what I will not share with you today, but you will get access to when you subscribe, is you'll get access to the exact setting for percent R that our team uses. Now, on February 23rd, this trade was issued. It was to buy calls on the Qs, and we're very specific. We tell you what expiration day, we tell you what strike price, and we tell you the direction. Now, our team uses an indicator in that option selection process, and it's called ATR, and that stands for average true range, and they use a multiple of our ATR setting to help in that option selection process. Now, why did we issue this particular trade on this day? Well, you can see percent R here is below 40. It's one of the setups that we like when we're looking for call trades. You can see 2 days later, it hit our 100% profit target. And if you'd allocated up to $1,000 to that trade, you'd have made $525 in gross profit before any commission or subscription investment. Now, why only $525? Because if you look on a $1,000 trade, that had only been one contract, right? If you'd have done 2 contracts, you'd have been over the $1,000 limit. Now, you're going to see this on the slides today. I know you know it, but they make us show it and tell you. Past performance doesn't guarantee future results. Strategy guidelines. Let's talk about it. As you saw there on that first chart, we're in these trades 2 days or less, but here's a key point for you: no day trades. A lot of traders are worried about day trades. No worries with that in our QQQ options playbook. What type of strategy? There are 3 different percent R signals analyzed on those daily charts. So as I told you, percent R stands for percent range. I shared one of the setups with you on that first chart. What options do we trade? Straight calls, like I showed you on that first chart. We'll also trade puts using 3-day to expiration options. Now, I told you a little bit ago that I'm 57 years old, been trading and investing since I was 18. Back when I first started trading, all we had available to us were monthly options. Those were options that expire the 3rd Friday of every month, and we still have those. But then the exchange, the options exchange, created weekly options in about 2005. And then in 2016, they went to Monday, Wednesday, Friday. And then in 2022, they started creating daily options on some securities. One of those securities is the Qs. Fascinating to me how things have changed over almost 40 years. Now, as I showed you on that opening case study, our team is using a daily chart. So this is essential for you to be a subscriber. New trades can trigger once per day, Monday through Friday. And we enter those signals before that daily bar closes, and the alerts are sent between 3:40 and 4 o'clock Eastern time. And before anybody says anything, these options actually trade until 4:15 p.m. Eastern time, okay? So we give you ample time to enter, but to be a subscriber, you do need to be available in that last little pocket before the market closes, the options market there. Now, this defined scanning session eliminates noise and allows us to use the power of those 3-day to expiration options. Now, what's eliminate noise mean? We got a lot of noise going on lately, right? And I'm not trying to downplay the seriousness of what's happening throughout the world. But again, I've been doing this almost 40 years. There's things that happen all of the time, right? That's why we're technicians. We react to what we see within the trading system. We try to keep the thoughts and the feelings to a minimum. We follow the trading system, let it tell us what to do. Now, scanning for signals every day has resulted in high trade frequency, something I've heard from traders over the years. You want some action. And as you saw on that first trade example, large profit potential targeting 100%. Now, how to get the most bang for your buck while managing risk? And managing risk is one of the key components. So these 3-day to expiration options allows us to get lots of leverage for a small investment. Now, you heard me allude to this stat earlier. The average contract price has been $4.31 over the trailing 12 months. So if you're newer to options, there's 100 shares represented in one options contract. So simple math, $431 to be exact, has been the average recommendation over the past year. So when you heard me say earlier you can do this strategy for about $500 or $600 a trade, there's why. Now, trades are exited after 2 days. I shared that with you earlier at 3:40 p.m. Eastern time if they've not been closed before then. What does this mean? Back to that in a minute. This avoids being affected by the final day of volatility. So back up here to the first bullet point. 3 days to expiration, right? But we're only in the trades 2 trading days. We don't want to be making decisions on that last day of expiration due to potential fast theta decay. If you're not familiar with theta, it's one of the Greeks that makes up options pricing. Now back down here, if they've not been closed before then, well, I showed you on that first case example that we're targeting 100%. Nobody's asked yet, but we're risking 50%. So we're risking 1 to make 2. Now, it's not an absolute. It's not one or the other, because if neither of those have happened, as you can see here with this last bullet point, we will exit that trade on that second trading day at 3:40. So why should you care about this strategy? Let's look at the overall performance. So it was started in January of 2023 and through yesterday's close. If you'd have started with a $5,000 account back then, and you'd allocated up to $1,000 to every trade, all losses, all wins, no compounding, no commission, no subscription investment, you'd be up $18,714. Percentage-wise, that's 374% trading one security and one security only. And do a quick rewind in your mind and think about everything that's gone on in the world, in the markets over those last several years, and the Qs have navigated. Now, past performance doesn't guarantee future results, but here are the results shown in a different format. 5,000 goes to 23,714, right? 18,714 is that gross profit that I shared you. Again, that's based off $1,000 allocation before any commission or subscription investment. But I want to emphasize it's no compounding, and it does factor in all trades. And once again, past performance doesn't guarantee future results. So step 1 was what? Daily chart. Step 2, we look for a specific setup. So each day is going to fall into one of 8 categories. 3 of those categories are tradable patterns. I taught you that earlier. We look for the percent R, again, that stands for percent range, to be within certain windows. I mentioned that to you on the first case study. Then we confirm those setups with candlestick patterns, okay? Now, our team used this historical profit factor. More about that in a second. To determine which days were the best for long trades via calls, short trades via puts, or neither, mean you're sitting in cash. Again, based off almost 40 years of doing this, some days, the best days, are no action at all. Having discipline, know when to sit still is key. More about historical profit factor. What does that mean? Well, first, what it doesn't mean, it does not mean every trade's going to be a winner, right? Not every trade's going to be a winner. But what it does mean is that this security, QQQ, trades very well within this system, QQQ options playbook, and has a positive edge over time. Now, QQQ options playbook has been finding an average of 8 new options trades per month. So a couple trades per week, if you will. Let's look at some more winning trade examples. Again, all charts are daily charts. Now you'll notice that this chart is different from the first chart. How is it different? Well, we see, and if you just joined me, this is percent R down here. And this is 60. This green line is 60. You see it all the way over here at the right. But you'll notice that percent R is now above 60. If you circle back to that first case study, remember percent R was below 40. Now you may remember from that first case study, that candle was red. This candle is green. So we're looking for percent R above 60, a little green action there on the candle. And then 2 days later, we close it down 2 trading days later, because as you can see, we carried it over a weekend. We're not worried about that. And we made 100.33% or $909 in gross profit. So please remember, all these trades are based off a $1,000 allocation before any commission or subscription investment. Again, percent R above 60, green candle, yes, buying calls even after the rollover, enter, exit, make 100%, trade generated $680. And again, folks, we're very specific in telling you which option to trade, which strike price, and of course, which direction. Now, here's a trade that gapped past our target for a winner that was a little larger than expected. So if you've been trading or investing anytime at all, you know gaps can work against you. They can also work for you. So here's an example, green candle, percent R above 60. 2 days later, we get a nice open on the second there, 143.66%, $1,293 gross profit. Now, I told you in the beginning, I've been with Price Headley and his team here at Big Trends for over 14 years on the front lines, interacting with traders just like you. One of the things that I enjoy about my job is hearing from traders just like you that are clients of ours. Now, Phil S. gave us permission to share this with you all, unpaid, unsolicited. Needless to say, I'm blown away by the last Q's trade. Trades like this really take the pressure off, and I can just relax for the rest of the day. I'm still smiling about the Q's trade we closed this morning. Again, unpaid, unsolicited from Phil S. But as I've told you, not every trade is going to be a winner. So let me show you an example of a losing trade. Get in. Why? Well, we got percent R above 60 that we like down here. We got a nice long green candle that we like, and it just rolled over the next day. Now, remember, we're targeting 100%, right? And we're using 50% stops. And that's what happened there. We got stopped out. Now, remember, we're trading a single ticker, but frequency has not been an issue. Let me show you some examples of trade frequency for some trades taken in October. October 23rd, that was a Thursday, okay? Green candle, percent R above 60, enter. Next morning, gaps up, we hit our 100%. That trade made $754. Now, that happened right here at the open on that Friday morning. Now, if you've been following me through the presentation so far, these trades come out between 3:40 and 4 o'clock Eastern time. Now, did our team take that Friday off after we booked this winning trade for our clients? No, because 3:40 hadn't even gotten close yet. We're still in the first hour of the trading day. So then later that day, we get the same setup that we like, percent R above 60, right? Green candle, enter in Friday afternoon, carry it over the weekend, walk in on Monday, hit another 100%, trade makes $696. Now, that's a Monday. Happened early in the day. Did they take the rest of Monday off? They didn't. Why? Because later Monday, we get another signal, percent R above 60. Next day, close it down for 100%. Trade made $750. So yeah, we're riding this uptrend because our system keeps firing signals. Then the streak stopped. We hit a losing trade. Why? Well, as I've taught you, some trades just don't work out. So managing your risk is essential. We got the signals that we like. I just showed you multiple of those in a row. We've got the percent R above 60 here. We got a green candle. It looked like it was going to work for us the next trading day, right? And then it just fell over and we lost 54.07%. So not all trades are going to hit 100%. We told you that. Just like not all trades are going to hit minus 50%. Told you that. But I shared this with you on an earlier slide. We will exit the trades the second trading day at what time? 3:40 p.m. Eastern time if they haven't hit the 100% stop or the 50% stop or the 100% target, all right? So we will send you an alert at 3:40 on that second trading day telling you, hey, it hasn't hit the 50% stop, it hasn't hit the 100% target, let's shut it down. So here's an example. You're learning. We've got percent R above 60. We've got the green candle that we like. Next day, yeah, it moved up higher. We made 71.71%. The trade made $588, but it was time to get out. Why 2 days? Based off testing using a historical profit factor by Price Headley, our founder and CEO, and his team of analysts. Here's another time stop. Right before Christmas, December 23rd, get in. Percent R above 60, green candle. Hold it through Christmas. That Friday after Christmas, we shut it down for 13.18%, generating $106. Now, I know that's not a lot, right? You may be able to take you and your significant other out for a decent meal. I'm not saying a great meal, a decent meal, okay? But it's managing the risk of the trades. You don't sit there and hope and, oh, you know, I've got an extra day because remember, we're using 3 days to expiration. Let's just see what happens that next day. No, our research says shut it down after 2 days. So as I shared you with Phil S. earlier, we have this from Joan F. Hi, Price. Again, Price is our founder and CEO. Just wanted to thank you for your QOP trade setups. I'm finally growing my small account after many years of failure and stalemate. Though I'm not courageous enough to stay in for 100%, 85 and 90% have been great for my account. I'm so encouraged now. Thank you, Joan F. Again, unpaid, unsolicited. So as a reminder, if you'd have started back in January of 2023 with a $5,000 account, allocating $1,000 a trade, your account now would be worth $23,714 before any commission or subscription investment. Now, I was doing a presentation yesterday and I asked folks, I said, hey, what are you paying in commissions, right? I hear most people are somewhere between 50 cents and $1. That held true yesterday. If you all don't mind, I won't call you out. Tell me what you're paying for an average contract to trade options. I'd just love to know, because one of the things I do know, it's a highly competitive industry. Now let's look at a few more examples of 100% winners while you all are putting those answers in the chat box for me. Again, these are daily charts. Again, this is percent R down here, percent range. You see 60 is one of the key thresholds. 40 is another. Now, just like that first trade that I showed you, this is one of the other setups that we like. Percent R below 40 and a red candle. Yep, we're entering calls even after all this downward action because the system says that's what works best. Next day, on that Wednesday, close it down for 100%, $900 in gross profit on that trade. Here's a trade, 23rd of January. Why do we get in? Different setup, okay? Different setup. Above 60, green candle, 2 days later. And as you can see, we carried it over a weekend, making 100%, $882 in gross profit. Kent, thank you so much. He says 35 cents a contract. It's one of the lowest I've heard out there, Kent. Congratulations on that. Appreciate you sharing. So trading 3-day to expiration options can be seen as aggressive, But with our unique trade management, it has been extremely successful. Let me remind you how this strategy has performed over time. Again, $5,000 account. Now you can trade with a lot more because of the liquidity in the queues, and you're only trading one security, okay? Now, if you've never heard me speak before, I try to emphasize this based off my experience. Please trade with what fits in your financial situation. Don't go jamming half or all of your account into a single trade, whether it's one of ours when you subscribe today, one of your own that you pick up, one that you see on television, one that your best friend or work colleague tells you about. Don't go jamming the majority of your money into a single trade. So 5,000 generated $18,714 gross profit before any commission or subscription investment. It's a 374% return trading one security and one security only. So now I'm going to show you how you can get real-time trade alerts when this strategy finds a trade. Now this is only available for the first 25 traders. Now I can tell you, and I think Anthony would vouch for me, there's more than 25 of you in the room today. So space is limited. 25 traders. Again, the name of the newsletter, here at Big Trends, we call them alert services. It's called QQQ Options Playbook. So 6 months of trade alerts from the QQQ Options Playbook alert service. Resources. Again, Price Headley is our founder and CEO. When he started Big Trends over 26 years ago. Why do I emphasize that? One, because I'm proud to be a part of it. Two, because I was an early client. And three, how many businesses are you doing business with each day or each week that have been around for 26 years? I don't care what industry they're in. We've been around for over 26 years. So Price does weekly video updates. We give you what's called the settings and rules. That is a condensed version of the strategy session video that Price has recorded. As you can see, it's a digital on-demand strategy session, okay? Do you have to utilize these resources to be a subscriber? You don't. But if you do, or if you have questions about any of the trades or the option selection process, we give you a dedicated email address to reach Price and his team of analysts. All of that information is going to be provided to you in your welcome email today. You'll get 2 emails, the welcome email and a purchase receipt. It'll all be outlined there for you. We all know the markets are closing until Monday morning. But when you subscribe today, you can go in and start watching that strategy session video if you want to. You can study that settings and rule sheet if you want to. You can create an email, draft it to Price and the team, have it sitting there for them on Monday morning when they come in. Now, retail value for 6 months is $1,782. That's based off the monthly list price of $297. Now, Anthony has invited us to come speak to you all today. So thank you again, Anthony, to you and your team. So Price Headley, our founder and CEO, JP Uli, our marketing coordinator, gave me permission to share this special package with you today. So 6 months of trade alerts from the QQQ Options Playbook. As I showed you, that's a retail value of $1,782. We're going to mark that out. As I told you, it's only available for the first 25 traders today. I'm going to knock that down to $997. Now, if you've been with me throughout the presentation, you know I teased this earlier. What's today? Yeah, it's March 14th. But if you write it out, it's 3.14, which makes it what? Pi Day. So we're going to give you a promo code, Pi Day, that will make your total what? $314. That's right, $314. And I'm going to do something else for you. I'm going to include an additional 6 months free. So as you can see, 12 months in total. It's a 1-year subscription. It will not automatically renew, okay? Will not automatically renew. What'll happen is 3 days prior to your expiration, our team will send you an email alerting you, hey, your subscription's about ready to expire. Would you like to renew? Here's your choices. If you miss it, you ignore it, your subscription will simply expire in 3 days. Now, how do you take advantage of this Traders Corner special package today? You simply go to bigtrends.com/QQQ and you apply that promo code, okay? You apply that promo code Pi Day, okay? You see it, it's PIDAY. And then when you do that, well, I'm trying to put that in the chat boxes for you. I think I got it. Hang on just a second here. There we go. All right. Bigtrends.com/QQQ and Pi Day, PIDAY. Your checkout total will be $314. So here's the checkout card. Billing information up here at the top left. First name, last name, email. Please put in your email address. Type it in correctly. That way you can get your purchase receipt and your welcome email. Okay. And of course, your trade alerts. And you could get your first trade alert as early as Monday afternoon. Am I guaranteeing a trade Monday afternoon? I'm not. But you could. Contact information up at the top of the checkout card. It's also at the bottom. More about that here in a few minutes. You see right below that, we take the 4 major credit cards: Visa, MasterCard, Amex, Discover. Slide down to the bottom of that column, you'll see that we also take PayPal down there in that golden yellow rectangle. So 5 ways for you to subscribe, but before you do, use promo code Pi Day to save today. So how do we do that? You see the word subtotal right there. Below that is a blue hyperlink that says have a promo code. You need to click it. Then you need to type in Pi, right? Pi Day. Slide over to the right, click apply, and look at that. You're going to save $683, making your checkout total $314. Again, it does not automatically renew. Our team made a reminder up here for you in the order summary. It's a full year of trade alerts. It's buy 6 months, get 6 months free. But you know what? I've got something else for you. How about this? How about I throw in Price Headley's top 3 indicator boot camp for free? Folks, that's a $297 retail value, okay? In Price's extensive top 3 indicator boot camp course, you'll experience the full spectrum of Williams %R, acceleration bands, which are Price's proprietary indicator, and commodity channel index tactics so that you can learn how to spot big trends irrespective of the trading vehicle, chart time frame, or market condition. This is going to be included in your package, right? So you're going to get a full year of trade alerts because it's buy 6 months, get 6 months free, okay? And you're going to get Price's boot camp. When your purchase order comes through, our team will activate your access to that boot camp. So now you will get a 3rd email. So let's summarize. You get a purchase receipt, you'll get a welcome email for the QQQ Options Playbook, and you'll also get a welcome email for Price's top 3 indicator boot camp. All for you today for just $314. But please do not forget to apply that promo code Pi Day to save and make your total $314 on Pi Day. Hey, Terry, I've got a trade example for you here in just a minute. Terry's asking to show a trade example. I've got one for you here, Terry, so stay tuned. I'll get to that here in just a second. FAQ, let's talk about it. What type of strategy? Buying calls or puts. How are you going to receive these trade alerts? Real time via email. So when you heard me talk about that email address, please put in the email address you want to use for your trades. Now you'll notice out here to the very far right, WhatsApp. What is that? It is a free, no-cost application that you can put on your computer, your laptop, your tablet, your mobile device. Again, it's free. Do you have to use WhatsApp? You don't. Now, if you want a notification other than email, then WhatsApp is the solution. We do not text. Why don't you text, Chris? Because about 2.5 years ago, the cellular industry said, hey, you can't send out trade alerts via text message. And we're like, hey, clients said that they wanted to receive them, and the big industry was like, nope. We know what's best for your clients, even though they gave you permission. So we use WhatsApp, and we've been using it successfully for 2.5 years, okay? So listen, do you have to use it? No, you can just simply sit back and get email. But here's what I can tell you about WhatsApp versus texting. It's faster, more efficient, and it's free. When are those trade alerts sent? Between 3:40 and 4 o'clock Eastern time. Remember, the market trades until 4:15, the options market on the Qs. Time stop, showed you a few case examples of those. Remember, 2 trading days later, we'll close the trade down if it hasn't hit the 50% stop or the 100% profit target at 3:40 p.m. Shared this with you earlier. How many trades per month? 8 trades per month on average. Day trades, no day trades. Okay, no day trades. Average contract price over the last 12 months, I shared this with you earlier, $4.31 a contract. So $431 has been the average recommendation. Resources, prices, weekly video updates, full year subscription, 52 weekly video updates. Settings and rule sheet, it's a condensed version of the strategy session video and the dedicated email address to Price and his team of analysts. Again, you don't have to use any of the resources. You can sit back and just trade. But if you're curious, you want to know more about why is Big Trend sending me these trade alerts, we give you access to the information. So remember, this is a trading system that will have wins and losses and lots of frequency. So here's a trade, February 19th. We got the setup that we like. We got percent R down here below 40. We enter, and it rolls over on us. Lost 50.11%. That was closed on the 23rd. Later on the 23rd, we get another signal, percent R still below 40, get the setup that we like, we enter, and then it takes off for us, and we hit 100%, making $525. This is the first case study that I shared with you today. So it just goes to show you, you're going to have wins, you're going to have losses, you're going to have frequency. So Terry, here you go. What did that trade alert look like? So this trade was issued at 3:50 p.m. Eastern time on February 23rd. Because remember, these trades come out between 3:40 and 4 o'clock, and we even remind you, these options trade until 4:15. But we're only trading one security, Qs. We give you the exact expiration, we give you the strike price, we tell you the direction, and we even tell you what to pay. What does buy to open mean? Sometimes that trips people up or throws people off. Buy to open simply just means you're starting in a new position. So I told you the St. Patrick's Day parade's going on here in downtown Lexington. So I apologize if you hear festivities and all that. We're located, interestingly enough, right next to an Irish bar. My window overlooks the courtyard, so I apologize if you hear any noise and celebration going on. But my point is, right? My point is we're very specific, okay? We're very specific in what we do. Now, that next morning, 9:31, we give you the stop and the target. But you're going to know that already. But we still remind you, why do you know that? Because I've taught you today, we're using a 50% stop and 100% target. So let's just say you got in at $5. You're going to know intuitively that your stop is 250 and your target is 10, right? So do you need to wait on us? You don't, but we're going to tell you. So we tell you exactly how to navigate the trade. Very specific on how we do that. So remember, the package starts off at 6 months, okay? 6 months. Weekly video updates, settings and rule sheet, strategy session, dedicated email address, $1,782. But again, special package for you, 6 months, $1,782 goes away. First 25 traders. Again, there's more than 25 of you here today. And again, once again, so glad, so grateful that you're sharing some of your time with me today. Knock it down to $997. If you just joined me, promo code on Pi Day. We're giving you a promo code Pi Day to make your checkout total $314. It's buy 6 months, get 6 months free, 12 months in total. When you go to bigtrends.com/QQQ and apply that promo code Pi Day to save $683 to make your checkout total $314 on Pi Day. And don't forget, folks, don't forget, I'm throwing in Price Headley, our founder and CEO, his top 3 indicator boot camp for free. It's a $297 retail value. As I said earlier, Price's extensive top 3 indicator bootcamp course, you'll experience the full spectrum of Williams percent R, acceleration bands, Price's proprietary indicator, and commodity channel index, tactics that you can learn how to spot big trends, irrespective of the trading vehicle, chart time frame, or market condition. We believe that you can use those indicators on different securities, as you can see, different time frames, and market conditions. So remember, special package, 6 months, $17.82 goes away. 25 of you, $9.97. That goes away when you apply the promo code PIDAY. And a little tip for you, you don't have to make the I lowercase. Our team made me do that. So you can do all capital letters. $314. Buy 6 months, receive 6 months free, 12 months in total. bigtrends.com/QQQ. And I'm going to put in our contact information, but I'm also going to show it to you in the checkout cart. So if you just join me, give me just a second. I'm throwing this in the chat box for you. Okay. Showing this in the chat box for you. And then I'm going to take you to that checkout cart because I've got a few minutes left. Don't want to leave Anthony too high and dry like I did my very first time he had me. I flew through the presentation and left Anthony with a lot of free time. So Anthony was very gracious, showed me grace, allowed me to come back, but he's like, Chris, you got to utilize the whole time. So let's talk about it. Here's the checkout cart, bigtrends.com/QQQQ. Billing information. Folks, you see this email field highlighted in red. Why do I click into it and click out of it and make it red? Because I've been here for over 14 years. I can't tell you how many typos I've seen or how many email addresses I've changed where somebody's typed in an email address and then they'll call us and say, hey, can we switch it to my trading email address? I use my marketing email address, and that's fine. But I'm trying to save you the hassle of not getting in a purchase receipt or a welcome email, right? Or missing a trade because you typed in the wrong email address. So I know you're excited. I know you want to take advantage of our special package, our Traders Corner special package. Take your time. We got time. Type that out. Contact information, Monday through Friday, 9 a.m. until 5:30 p.m. Eastern time. It's up here at the top of the checkout cart. It's at the bottom. I'll show you that here in just a second. 4 major credit cards, Visa, MasterCard, Amex, Discover. Again, we take PayPal down there at the bottom. But as a reminder, it says use promo code PIDAY to save today. Now, you can see I've already typed mine in there. But you'll have this, have a promo code. You'll click it. Now, I can't do it twice. You'll click it. You'll type in PIDAY. Again, you can use all capital letters if you like. You're going to save $683, making your total $314. But you will have the word apply out here. You'll need to click the word apply to make it apply that promo code so you can save $683. Terms and conditions are there and there. Contact information is here. Again, it's 1-800-BIG-TRENDS, 1-800-244-8736, or email client@bigtrends.com. And as it says just below, I just highlighted it in blue. It says we're here to help, right? We're here to help. We've been around for over 26 years. 26 years. Again, ask yourself how many businesses that you interact with on a daily or weekly basis that have been around for 26 years. Traders Corner special package. Buy 6 months, get 6 months free, okay? And don't forget, we're throwing in Price's boot camp as well. That's yours to keep. Even if you don't renew your subscription next year, you'll get to keep access to Price's boot camp. Now, you'll lose access to the resources, right? The weekly video updates, the strategy session, the settings and rules, and the ability to email him, right? But you'll still keep that $297 value, which is Price's top 3 indicator boot camp. So go to bigtrends.com/QQQ and apply that promo code. And hang on a second. Let me throw that back up there. Where are we? I love when I have technology issues. Give me just a second. There we go. And go to bigtrends.com/QQQ and apply that promo code PIDAY to save yourself $683, locking in your total $314 today here on PIDAY. Anthony, I believe I'm right on my time here. So appreciate you having us. I'm going to let you go and continue on with today's festival. Good luck. Thank you again, folks. Thank you, Anthony, and your team for having us. Really appreciate it. And as Price Headley, our founder and CEO, says, trade well.
Thank you, Chris. Thank you for being here and all those kind words. Thank you for that excellent presentation and for sharing your insights into your QQQ strategies. For those of you who would like to learn more about Chris and the work he does at Big Trends, he's placed a special offer, discount link in the chat box, so make sure you check it out. I really like these guys, so check it out. Be sure to check out any other additional information as well. Now let's move on to our next presenter. Our next speaker is Matthew Whiz Buckley. Whiz is a former Top Gun fighter pilot, a Wall Street executive, and the founder of Top Gun Options. He has spent more than 30 years developing strategies designed to capitalize on major market shifts. His presentation today is titled Solo AI, the only sector investors must own. Please welcome Matthew Whiz Buckley. Whiz, are you there?
Clear?
Hey, I can hear you.
Awesome. All right, man, I appreciate it. All right, folks, let's go ahead and throttle up and get airborne. We're going to talk about the most explosive sector, essentially in the, let's just call it in the history of humankind. This sector is not only going to wipe out tens of millions of jobs, it's ultimately going to kill all of us, and I'm not joking. So welcome aboard my presentation, Solo AI. Before we get airborne though, I'm going to tell you a little bit about my background in a second, but definitely want to remember the 6 Air Force airmen who were killed in a mid-air collision the other day. I've refueled off the KC-135 literally hundreds of times, and they're just the backbone of military aviation. It was as a single-seat fighter pilot coming home from Iraq and hitting the tanker. Made my heart smile, because all these big tankers on the other half of the side of the planet, I pull up next to this big piece of America and see a state on the tail: Alaska, Arizona, North Carolina, Alabama, and it would make home see a little bit closer. So God bless these airmen and their families. And man, I just pray hostilities end soon, man. A little peace on earth is what we could all use right now. Okay, here we go. Let's go ahead and throttle up, man. Like I just said, and this isn't hyperbole, folks. I've been trading for over, geez, I'm going to age myself, over, let's just say 30 years. It's closer to 35, but I have never seen anything like this. I've traded through the .com bubble. I was in the Chicago Board of Trade, the Chicago Board of Options Exchange during the global financial crisis. I ran to the VIX pit when it was at 90. I've seen all of this. This is it. So, ladies and gentlemen, driving is over with. You see all these, in my neighborhood, when I go for a walk, I'll see somebody in their personal car, a beater of a car, get out like wearing a blue Amazon vest, drop a package off, take a picture of it, and jump in their car and leave. They're gone. Taxi drivers, gone. Driving is going to wipe out 12 million drivers, conservative estimates. Doctors, gone. AI diagnoses better than humans, prescribes perfectly, and never forgets. How many times you go to the doctors and the guy's like, you've been going there for 20 years, and they look at you like, what's your name again? How about surgeons? Gone. I have one of my close friends is an orthopedic surgeon. He's like, you wouldn't believe, and he's like, man, I remember during residency, I didn't sleep for 72 hours, and I'm like doing surgeries and stuff like that. I'm like, oh, that's safe. He's like, oh yeah, and a lot of the surgeons that I went through were on coke or alcoholics. I'm like, oh, that's awesome. Gone. Absolutely gone. Coders, ladies and gentlemen, AI is writing and testing all its code right now. We're going to dig into all this stuff, man. Teachers, personalized AI tutors available. They remember you, individual attention for every student, not a big blanket. Lawyers, I don't even start about the legal profession, man. I have saved tens, if not $100,000 so far in legal stuff, from basic contracts, terms and conditions. The only thing it can't do right now is walk into court and file, right? It is wiping out first year through fifth year junior lawyers. It's over with, period. The law firm, imagine, and any of you have ever been sadly invested in legal stuff, it sucks. It's like years. We're gonna have AI courts soon. One AI, this side AI, the other side, and an AI judge, like Judge Dredd, right? Sylvester Stallone, who's gonna look at the facts antiseptically and render like an instant decision. It's over with. Artists, factory workers. Folks, if you go into an Amazon fulfillment center right now, there's barely any, first of all, it's dark. Isn't that creepy? I've seen the inside of an Amazon fulfillment center. Robots don't need lights. It's completely dark, except for the random human that needs to go oil the Fetzer valve once in a while. Hell, Amazon recently announced up to 500, they didn't announce it was leaked and they didn't deny it. 500,000 people they plan on laying off by 2030. Soldiers, ladies and gentlemen, we are here. It's RoboCop, it's the Terminator. Man, I saw this the other day. Where's that story? Look at this. Humanoid soldiers tested in Ukraine. Unbelievable. I saw a video a couple weeks ago of a China like dance thing. These were humanoid robots that were flipping and dancing, and I was like, okay, that's really creepy. Give them a weapon and it's over with. So if you don't know what you're doing, you're going to be destroyed, right? Now, I take the other side of that trade. Every AI job that gets destroyed creates massive profits for who? The companies building it. So you can either be disruptor or you can own the disruptors. I'm going to show you how. Do you remember like 5 years ago? No, about 3 years ago, Bill Gates, what a scumbag. Did you see him in the Epstein files? He got a STD from a Russian prostitute and was emailing with Epstein about how to like secretly give his wife penicillin. Whatever. Here's why I bring that guy's name up, because at the time, Bill Gates was like, oh no, AI's awesome. It's going to be great. AI's great. I'm like, I don't trust this guy. And then Elon Musk around the time came out and said, AI is going to kill all of us. We should stop right now. We should have a big summit and put some curbs on this. And I was right. Elon Musk was right. Bill Gates is a scumbag. So ladies and gentlemen, $700+ billion is being deployed this year. Now, the companies building this future are on our targeting list, and I'm going to share that with you folks. Here's some recent headlines, man. And I'm going to show you the most up-to-date headlines. Did you see Jack Dorsey like 2 weeks ago? Seems like a lifetime ago, before obviously Epic Fury. This was the big story. Jack Dorsey, with his mala beads and kind of a hippie, and I'm a man of the people. No, he isn't. He's a billionaire who just laid off 40% of Square. 4,000 people. These aren't baristas, folks, making minimum wage. These are white collar $250,000 to $500,000 a year jobs. Man, absolute insanity. And did you see, one of his quotes? Let me share with you the quote here. Intelligence tools have changed what it means to build and run a company. A significantly smaller team using the tools we're building can do more and do it better. Ladies and gentlemen, this is obscene. Now, Wall Street is terrified, and they should be, right? Did you see the Anthropic CEO in that interview? What was this, 2 weeks ago? Again, it's almost everything before Epic Fury. It's like B, E, F, and AEF. But folks, the Citrini research document, did everybody read that? I woke up the next day, I posted that over the weekend to our Top 10 Options members, this 2028 global intelligence crisis. Whiz, it's 2026. Yeah, I know, genius. Citrini research went into the future, so to speak, and wrote a report looking back on the years between 2026 and when they put that report, and it was terrifying. The next day, the S&P 500, the NASDAQ got destroyed on this report. Look at it. Viral doomsday report lays bare Wall Street's deep anxiety about AI future. And then the Anthropic CEO on a 60 Minutes interview. AI will wipe out every job and spike unemployment to 20% in the next 12 months. Are you paying attention to this? Now, folks, let's make a market. There's a bid and an ask. Either all these people are nuts or none of that will happen. Or let's meet in the middle. Even if we meet in the middle on all of this stuff, it's insane. So, and these are recent headlines. Let me give you the most recent headline that dropped last night. Where is it? Right here. Ladies and gentlemen, Meta plans sweeping layoffs as AI costs increase. 20%. This is Reuters. Reuters is reporting 20% of Facebook gone. Why? Greater efficiency brought about by AI assisted workers. And again, folks, these are Meta employees, right? You ever see those videos of, hey, here's my day at Facebook, and I wake up whenever I want to, I have a coffee and I do yoga, I work for about an hour, and then I, do some more yoga and I go home. Gone. And these, again, folks, are not low paying jobs. These are serious jobs and they are getting destroyed. Now, you might be sitting there going, well, Whiz, we've always found a way, the horse and buggy and the automobile and the jet and no, folks, this is the technology to end all technology. Where do you think these people are going to go for work? Like 6 months ago, FedEx and UPS, ever see the movie, Castaway with Tom Hanks, right? Tom Hanks, FedEx plane crashes, he's stranded on it. He was a systems engineer at FedEx, right? He's AI now. That job doesn't exist at FedEx. So when FedEx lays off those people, do you think the guy goes, I'll just go down the street to UPS and get that job? No, they just laid them off too. So where are these Meta people going to go work? Ladies and gentlemen, the current AI headlines are even worse than a couple of weeks ago. Carson Block turns bearish, says AI threatens 15% of US knowledge jobs. This guy did a 180. Up until a month ago, I was completely sanguine on the S&P 500 markets in general and the economy. Now I 180'd. He is like, the S&P, or where is it? Block now believes AI could meaningfully reshape both the economy and the stock market. He says that here it is. I think it's not unrealistic to say 15% of knowledge worker jobs in the US in the next 3 years are gone. If new roles don't emerge quickly enough, higher unemployment could reduce flows into retirement accounts such as 401ks that have long supported the S&P 500. Displaced workers drawing their savings can't find new jobs. I'm telling you, man, even this isn't a sky is falling. This is fact, ladies and gentlemen. This isn't, oh man, this is here, right? Okay, so yeah, the week that these are all recent headlines. The week the dreaded AI jobs wipeout got real. Look at this guy. This guy asked Claude Opus 4.6. He said, hey, based on everything you know about me, will AI replace my job in the next 12 months? Look at what the AI told him. I've completed my analysis. Based on current AI growth trajectories, you will likely be replaced within 6 to 8 months. On a positive note, you will have significantly more free time to explore new hobbies. I would not recommend signing any long-term leases. I want that to sink in, folks. While the Elon Musks, the Mark Zuckerbergs, the AI explosion will make billionaires and trillionaires at the top, it will destroy everybody else. This is a fact. If you work with any sort of screen, it's over with. Who am I? Thanks for that doom and gloom, Whiz. Well, we're gonna, if you want a friend, get a dog, right? Like the Gordon Gekko said in the movie Wall Street. I'm here to profit off of this. I'm here to profit, teach you how to profit as others panic. Who am I? You can call me Whiz. Matthew Buckley, flew the F-18 Hornet, United States Navy, went to Top Gun as an adversary guy, deployed for Operation Southern Watch, Noble Eagle, and Enduring Freedom. I have a very close tie to everything that's going on right now. I know General Dan Kane, Raisin. I've known Raisin for over 2 decades. He and I worked in the civilian world together. He was an Air Guard guy. He and I both, when we got off active duty, flew fighters part-time. Him in the Air Guard, me and the Navy Reserve. So I've known Raisin for a long time, and it just, you know, I have a lot of up-to-date intel with everything going on, and we've been printing money at Top Gun Options off of this volatility. I saw a tweet the other day from Jim Cramer on one of these really volatile days. He's like, just impossible to make money on a day like today. You know, I'm like, are you in? What an embarrassing tweet. I think that day I made about 7-8 grand on S&P 500, not sitting here all day staring at this drool cup, buying some puts when it imploded and buying some 0-day expiration calls when it exploded, like 7 grand in a day when he posted that tweet. I'm like, people actually pay for your quote investment club? You don't get paid to sit on your hands. All right, so what does this have to do with trading? Any of that stuff? Well, I went to Wall Street. I had a very brief airline career. The morning of September 11th was my first and essentially last day at American Airlines. But on active duty, I taught myself how to trade, right? Stocks, options. I mean, this was almost back before Al Gore invented the internet, man. I had to read books on options trading, folks. So after getting furloughed from American Airlines, moved to Chicago. Why? Because I applied everything I was learning as a fighter pilot to my trading, having a strategy, implementing tactics, managing risk, contingency planning. And I popped up on the radar of that firm right there. Everybody knows that building, right? The Chicago Board of Trade. You see the big, beautiful windows? That is our trading firm. I was a managing director of strategy for this multi-billion-dollar vol arb firm. I helped build a hedge fund when I was there. I helped build the retail brokerage known as Options House. Some of you might have traded with Options House before. So yeah, essentially went from self-directed retail trader to $2.5 billion firm, and I built a company called the Options News Network. We were like the CNBC for options. We'd shoot on the floor of the CBOE and the CBOT and give you all a behind-the-scenes look at what was going on. I felt like Eddie Murphy in Trading Places, right? Valentine. It was interesting. I've also published a couple books from sea level to sea level, going from essentially the cockpit to the trading pit, and then also COVID crash. We made, speaking of Jim Cramer and people who don't know what they're doing, people like Jim Cramer, Bill Ackman, who else? Kyle Bass. Do you remember what happened during the COVID crash? I timed it to the day. Why? Because I had a deep throat in the White House, and that's a separate story. But ladies and gentlemen, I did outsider trading. I told everybody at Top Gun Options, get out. Buy puts on the S&P 500, get long volatility. The only level 4 weapons lab in China, something escaped. They're ripping up the highways around this town and building mobile crematoriums. We're being lied to. I also got booted from Facebook and Twitter. I lost a couple accounts, shadow banned on YouTube, making that call. And then what happened? The market imploded. We made $2.8 million in a couple weeks. Well, Jim, and you remember, who was it? Bill Ackman or Kyle Bass was like crying on CNBC, like, we need to close, markets need to shut down for a couple weeks. Let's just stall. I'm like, no, buddy. I'm bearish. There's somebody on the other side of all your bullish trades. And if you're an idiot, that's on you. So I've written a couple books. And real quick, before we go look at the solo AI portfolio, here's a couple other things that make my heart smile. About 5 years ago, I went down to Mexico with Marcus Luttrell. Some of you might remember him from the movie Lone Survivor, and it saved and changed my life, psychedelic assisted therapy. So I got home and I started a foundation called the No Fallen Heroes Foundation, where we give grants to veterans, first responders, and their families to heal with these compounds. So I also started my own church last year called Sacred Warrior Fellowship down here in Florida, where we use these compounds in ceremony. So you don't have to go to Costa Rica, you don't have to go to Mexico. to heal trauma incurred serving this one. So there's Marcus Luttrell. If you drink Black Rifle coffee, that's JT. That's JJ. He's another Navy SEAL. And that's Robert Gallery. If you're an NFL fan, he was an All-American at Iowa, played for the Raiders. Horrible head trauma. He is a different human being. Matter of fact, he started his own nonprofit to help NFL players sit with these compounds to heal their traumatic brain injury. Met with the Secretary of Veterans Affairs last year, and that's our L-39 fighter jet. I take donors flying in the back seat for the flight of a lifetime. All the donations go to our foundation. Okay, that's me. Now let's throttle up and really get airborne with what we're talking about. Here's what I want to do, though. I think I have to be a presenter to share this with you, a document. So this, I just literally, let me show you our member area. I just posted this in our solo AI service, updated AI infrastructure report with meta rumors. What is it? It's a 19-page hedge fund document with all the recent news in AI and all of our names that we're targeting in this portfolio, and our allocation, our 12 and 24 month target for the stock. I'm going to pick a couple of these names to go through, but I'd love, yeah, I'm looking right now. I have to be a presenter to get this to you. Why don't you just, here's our portfolio summary and our conviction rankings. What the current stock price is, 12 months, 24 months, and our percent of our portfolio and my conviction in them. Yeah, let me, I'll give you my email address, and I'll just, how about we do that? Unless I can get this to Anthony and he can upload it. Whiz at top. Because this, ladies and gentlemen, this is the type of report you would get from Goldman Sachs Asset Management. If you were you had about 50 to, $100 million. This type of report goes to private wealth management clients. And me, it goes to my members. So here it is right here. So all the stuff we're going to talk about, right? There's a meta workforce reduction already in here right now with that news and how it's going to impact all the stuff. So this right here, if you weren't a private wealth management client, that would probably cost you $4 to $5 grand just for that report. And I'll throw that at you for free. Okay, and because I can't figure out how to post this for you guys to be able to download. But let's step through some of this, and then we're going to go look at the stocks and the portfolios. So I'm going to open, or it's Saturday, I'll show you how to open a new position. So here's the opportunity: 700 billion coming in. Look at Amazon is a third. Look at the Amazon outlay, 200 billion in capex for this year. That's just, I call it the Death Star. Look at Alphabet, look at Meta, look at Microsoft. Ladies and gentlemen, they are pumping cash into this. Did you see NVIDIA report a couple weeks ago? Unbelievable, 73% year over year explosion, and it guided higher for this quarter. Unbelievable, ladies and gentlemen, or it's believable. Amazon, I call it the Death Star. The recent earnings we'll go take a look at, but ladies and gentlemen, look at the revenue, 24%, the fastest growth in 13 quarters. The backlog, they can't fulfill what is on the books right now, man. That's locked in. CapEx, we already talked about. What are they spending money on? They don't need to buy more airplanes. They're already bigger than FedEx and UPS. They don't need to they need this stuff. That's what they're spending their CapEx on. The revenue up 12% year over year. Folks, never forget that Amazon does a bunch of things. You want a toothbrush? Are you going to Walgreens today? No, you can order it on your phone and it'll probably be here in an hour. They have Amazon Prime, bigger than Netflix. They have AWS, which is essentially Microsoft. Amazon is the Death Star, so it can afford to pay for all of this CapEx. Some of those other companies don't, and that's all down. That's in that report I'll share with you. Look at that, advertising, 23%. That's a self-funding cash machine. That's why we love it, right? And they're training, folks, this chip, do you all understand that the Trainium chip is faster than NVIDIA's chips, and it is 30 to 40% cheaper. You want to talk about putting all your eggs in one basket? Just trade NVIDIA. If you want to talk about a diversified AI name, you got to buy Amazon, period. So yeah, right down there at the bottom, folks, Amazon isn't just an AI play, it's everything. And it funds what it's doing. Maybe we'll go take a look at Amazon real quick. Month to date, Amazon profits 107 grand with more to go. Thanks, Whiz, for all your expertise and guidance doing day trades with short calls to protect my Amazon profits, learning from the best. And in November made me look like it was my first day. Monday through Wednesday, in 3 days, she trades a larger account, obviously. In 3 days, I made 90 grand on short calls against her 30 contracts utilizing Whiz's guidance, right? So if you're familiar with Top Gun Options, we used to have a service called Solo Amazon, and it was 97 bucks a month. It was our gateway drug service to join TGO. That's gone. It is now Solo AI, and Amazon obviously is our largest holding, but there's other stuff we need to target as well. Here's the targeting list. And I think in this, you can click on, what is it? There's a little screenshot thing. You can take screenshots of this or watch the recording, but I'm going to rip through this because I want to show you a new trade you should potentially add Monday. So look at this: NVIDIA, Amazon, Broadcom, the AI compute in the cloud names, hyperscalers and Silicon, those 3 names. What about power? Do you know there isn't enough power on the planet for AI? I mean, Jeff Bezos and Elon are talking about solar or space state power space stations. So we're gonna look at the power names because there isn't enough. This is free money. When you look at these charts like Constellation Energy, which we'll look at in a couple of minutes, buy it with both hands. What about the software and infrastructure? These are free money as well. The apps, the cooling, the uranium needed. And then I have a lottery ticket in the portfolio. There's conservative names in here, there's medium, and then there's my drinking money. Even though I don't drink anymore, thank you to psychedelics. I call it a drinking money trade. NNE, micro reactor moonshot, folks, right? Trump already said that. He's got a big push. He's like, stop sucking off the taxpayers' electrical grid. Start making small nuclear reactors. This is the way to go if you really want to do this. So here's what you're going to get. Let me show you this, and then we'll go look at a potential trade. You're going to get that hedge fund investment reports. I update them throughout the week. Institutional grade, 12 and 24 month price targets on those 10 names. Every Monday at 10 a.m. Eastern, I do a live Solo AI brief. We go through the names in the model portfolio that I am trading with my own money. And we go through the updates, new trades, all sorts of stuff. I show you what I am doing. I just showed you the online members area. You get an app. It looks exactly like the online members area. And whenever, Whiz, I work Monday morning at 10 a.m. Well, guess what? 85% of Top Gun Options members work Monday at 10 a.m. They're going to be sitting in death by meeting, and they're going to get a little alert on their app. I show a screenshot of the trade. You get it. I do it during the brief, so it's not like there's a delay. You're getting it when everybody else does. And then watch the replay when it's posted on the member page, at lunchtime or when the kids go to bed or something like that. You get 3 skill-based manuals. You get access to the Ready Room, which is where I post all my intel and commentary. And look at this, man. I'm wanting to lock in lifetime, belong to Hunters and Solo Amazon, just renewed my Hunters in October. Look at this down here. Did great last year. Doubled my retirement account from 110 to 225, mostly from Amazon snipers. Not always in front of the computer to hit those. Thanks for all you do. This is a recent screenshot too. You're welcome, Whiz. Great work you are doing. I'm up on JP Morgan, a little down on SIBO, up on Amazon, up 27 grand on Raytheon using synthetics, 31,400 on trades I would have never done without your teaching. That's what puts a smile on my face, okay? All right, so here's what we're gonna do. Let's go and take a look at some real trades. And for folks who, man, look at that. It's GEV. Look, or CEG, Constellation Energy. Wow. Look at Constellation Energy, folks. It's 4 years. It opened at 38. It's a $300 stock. All right. Let's start with what I used to call, or I still call, the Death Star. Look at Amazon, ladies and gentlemen. Now, if you're sitting here going, man, this guy, Top Gun options, I don't even know what the hell an option is. Perfect. Welcome aboard, Top Gun options, because I'm going to show you. If you wanted to buy, based on what I just showed you, that would be what I call commit criteria. I love what Whiz just showed me. I should buy Amazon with both hands. Okay, I'm going to go buy 100 shares. And I'd laugh at you. And I would laugh at you. Why? Do you have 20, let me round up. Do you have 21 grand, $21,000 to buy 100 shares of Amazon? If you do, great. Still don't buy 100 shares of Amazon. Buying stock is for chumps. I'm cheap. Let's go save some money. Now, this is the options chain. I'm going to deselect everything. And look at this. I'm going to fly all the way out to the future, to December of 2028. Why? Because I want to give this trade as much time to work as possible. In the options world, I can go out. Guess what the average holding time of somebody buying a stock is? This isn't your mother's stock market where they buy shares of GM and get it in the mail and put them in a shoebox in the closet. It's over with. The average holding time is either a year or just over a year. But we could go all the way out to December of 2028. Let me click on that. Okay, that is over 1,000 days into the future. And look, I have an existing position here. So if you don't know anything about options, at least you probably have heard, hey, I can buy a call option, and that means I'm bullish. So let's do it. Amazon's trading at 207. There's a 200 strike and a 210 strike. Let's just look at the 210 since 207 is closer to that. Ladies and gentlemen, if you buy one December of 2028 210 call, you are controlling 100 shares of Amazon stock. Why buy the cow when you can get the milk for free? Why would you do that? So ladies and gentlemen, I just saved you 20, what was that? It was 21 grand. We rounded up. I just saved you $15,000. I'm not done yet. How many of you have heard, if you don't know about options, somebody say, uh-oh, I think the market's going to implode. I'm going to buy some puts. So if you buy a put, you're bearish. You think something might go down. Well, guess what? Somebody has to be on the other side of that. They have to sell you the put. A put seller is bullish. So why don't we sell a 210, same expiration, December of 28, same strike, 210, put? Ladies and gentlemen, would you rather spend 21 grand or 1,800 bucks? Let's round up to 2 grand. I just saved you $19,000. On your screen is something we call synthetic stock. Everybody look over here. That's long stock. That's the synthetic stock. Let me just zoom out a little bit. That's the synthetic stock. That's the long stock. So ladies and gentlemen, well, Whiz, I don't get it. You're synthetically long the shares. What's synthetic stock mean? With synthetic stock, ladies and gentlemen, you don't get two things, and neither of them matter for Amazon. The first thing, since you don't own the shares, is you don't get to vote. You don't own the shares, you're not a shareholder. Last time I checked, Jeff Bezos and his ex-wife probably own 1 or 2 more shares than you ever will in your life. Your vote is meaningless. The other thing you don't get with Amazon, synthetic stock, is a dividend. Jeff Bezos chokes when he hears the word dividend. He literally laughs at it. Jeff Bezos, if he makes $1, if Amazon makes $1, where's the dollar go? Back into the Death Star, back into Amazon. The guy has said never in the history of Amazon will there be a dividend. We put the money back in the company. What a chump move to do to give it back to the shareholders. They want a bigger Death Star. So one more time, why would you spend 21 grand on Amazon stock? It's stupid. Now, the smart people looked here immediately. Well, Whiz, I'm risking 23 grand in this trade, a little bit more than the stock. But what are the odds? What are you risking if you buy 100 shares of Amazon? The same thing. If Amazon goes to zero, you lose your 21 grand. If Amazon goes to zero in the next, between now and these 28, you could potentially lose that. What are the odds of Amazon, probability for max loss, of Amazon going to zero by December of 2028? It's 0.00. Now, the odds of getting eaten by a golden retriever are never zero. That's probably 0.00, 10 decimal points and a 1. Can Amazon go to zero in the next 2.5 years? Yes. Will it? No. But here's what I'm going to do, because I'm not an idiot. I'm going to buy what I call a disaster put. What's a disaster? Well, if you watch CNBC, breaking news, the S&P 500 is officially down 20% today. It's in a, say it with me, bear market. So I just use a round number. Why don't we buy a disaster put 20% under the stock price? What's that? 2 and 2 is 4. Let's just say 160. Let's go buy a 160 put. Now, ladies and gentlemen, what's that do? Well, the cost of the trade goes up a little bit. Why? Because you're buying insurance. I never went flying in the F-18 Hornet without an ejection seat. This is what you do. But check this out. Instead of risking 23 grand, I'm only risking 8,800. I lowered significantly my risk. If Amazon goes to zero in the next couple years and you bought the 100 shares and you didn't exit or didn't buy a put, you lose your 21 grand. If Amazon, God forbid, goes to zero in the next couple years, I'm in the synthetic stock trade and I hit my head and never managed the trade again, that's what I'd lose. So again, rhetorical question, why would you ever buy another share of stock in your life? It makes 0 sense. I'm also not done. One more thing I'm going to show you real quick, because I'm cheap. I can sell, what's next Friday? The 20th. I could sell a March 20th, it says March 26th, call against this and bring in a little coin. Let's sell, what are we at, 207? Let's sell the 210 call against this. Ladies and gentlemen, that would bring in, you see this, $310. If I sell one of next Friday's 210 call, right in the middle there, it's about 310 bucks. I lowered my cost basis even more. If Amazon stays flat for the next 2.5 years, I would pay this trade off just by selling short calls against it. It's not going to stay flat, it's moving up and to the right. But my point being is, not only is this trade going to profit as the stock moves up and to the right, I'm going to sell short calls against it every week and bring in some money. The only time I don't sell short calls against Amazon is if it starts ripping. It makes no sense, right? Don't fly in front of a steamroller in your Superman cape trying to pick up dimes or nickels. It's gonna get caught one day. You're gonna get run over. But I will teach you all of that. If you were hung out for most of that, welcome aboard Top Gun Options. You get it, and guess what? You will get access to Options Weapons School if you join today. Options Weapons School, ladies and gentlemen, 9 training sessions. This is a call. I don't even start with calls and puts. Hey man, this is where Whiz gathers his intelligence. This is the basics of the markets. This is our trade plan that we use at Top Gun Options. I don't even get into what a call or a put is until session 2. Session 6, ladies and gentlemen, I just did. It's about an hour and 10 minutes. I just gave it to you in about 10 minutes. Go watch that and get more detail on it. So I'm going to show you the page to join. It's included if you do the annual membership, not the monthly, because it's $497 worth of training. If you do the annual, I'm going to hook you up, ladies and gentlemen. Folks, in volatile sectors like AI, options give you the edge stocks will never give you. Period. I'm not going to go through all the benefits of trading options over stocks. You got to trust me because I want to keep these guys on time. This is the way. I rose from a young fighter pilot trading options all the way to the managing director of a multi-billion-dollar Wall Street firm. What do you need to trade, folks, successfully? Training. You're going to get that in Options Weapons School. I need a plan. Whiz, you never went into combat without a plan. You're damn right. So our trade plan, you're going to get access to here at Top Gun Options. We do the trade plan before we ever hit fire. We never place a trade until we know exactly when we're getting out for max profit or minimum loss. And then with your training, with a tight plan, you need to practically apply that. How do you do that? In the live trade brief. These are the 3 things you need to trade successfully. I've been doing this for over 3 decades, folks, so I know what I'm doing. Other services give you the fish. I don't. I teach you how to fish, not build the rod, tie the lure or whatever. But, you know, folks, this is what you want. Top Gun Options, okay? Again, recent screenshots. Thanks, Whiz. $1,600 profit. Bought a naked 6,900 call, made $500 in an hour. Boom is right. Hell of a call, Whiz. Missed the bottom. Where's it? 3180 profit in 28 minutes here. Again, calling you, Jim Cramer. No, impossible to make money today. Whiz, loving the group. Jumped on the AMD put today. In and out, easy 1,500 bucks. Awesome advice, brother. Probably could have waited a bit longer, but still getting my feet under me. I'll take the profit. Folks, I'm not even going to ripple through any of the stuff. The live trade briefs once a week if you don't think you have time. The trade alerts come instantly on your phone through our apps. Man, this is you do have the time. I don't have enough money, folks. Couple $100 you could get into this service, right? That was synthetic stock. Obviously, that was a little bit more of an investment, but that's years into the future. I put that trade on years into the future, and then what do? I trade the front month, March, April, May, and I'll show you those trades. I'm not experienced enough. I love that. Then you're going to be even better. You got no bad habits to unlearn, right? What's the motto at Top Gun? You think you're good, we'll make you better. So time to get airborne. Choose your plan. 197 a month. Folks, I just showed you a handful of trades from last week where people, you know, the least guy made $500 in 10 minutes or whatever that was. 197 a month, right? Options Weapon School is not included. That's some significant training that I put my heart and soul into, right? So you can purchase Options Weapon School separately, or do the annual membership. You save almost $1,000. You get the Options Weapon Schools, you get the manuals, everything is included. Folks, this is the fastest way to start trading options while targeting the most explosive sector in history. Folks, I'm not joking when I say this, man. It is, if you don't know how to invest or trade, that's going to be very hard for AI to do. I get it. There's AI black box. I use AI in my trading a little bit, but still there's emotions, there's human involvement. Kind of like using AI in combat. There always will be, until someday, a human in the AI ultimate kill chain, right? Same thing with trading. So you better learn to trade now and how to profit off all of this stuff, right? Before you end up out of work and living out of your 401k. So there's the page right here, folks. Okay. And like I said, if you do the monthly, you gotta take the upgrade there. $4.95. Hey, you're saving $2. I thought it was $4.97. I gotta change my slides. So, ladies and gentlemen, this is the most explosive sector in the history of mankind. The other positions that we have, good looking portfolio performance. There's our Amazon synthetic stock, Constellation Energy, and NVIDIA. So Monday morning at 10 a.m., we're going to add, what am I adding Monday 10 a.m.? I think Palantir, right? So we're going to add some Palantir to this AI model portfolio. And then let me just show you real quick, and I can take some questions or we're getting close to time. NNE, like it says in that report, this is my drinking money. This is my lottery ticket call. This is the nano nuclear, man. This thing potential has to explode. CCJ is the other name we love. Look at that, man. Look at this energy name from 36 to 127. I'm going to be a buyer down here at 100. And what's the other one that she told me? It was CCJ. No, yeah, and NNE. So we're going to rip through all this stuff on Monday morning, folks, at 10 a.m. Eastern. If you can't make it, guess what? Underneath brief replays up at the top, you click on Solo AI and you watch the replays, right? Let me click view the replays right there. This is the one from last week. bottom line up front. And then I show you, take a screenshot of all the trades that I did, scroll down, there's our new CEG. So I just put on this trade on Constellation Energy last week. If you want to join this portfolio, this would be the day. And then look at this. We put on a Amazon bull put spread that expired yesterday for max profit, 540 bucks. Boom, love that one. So max profit on the Amazon trade from last week, and then the new entered the CEG. All the other replays are over here on the right. Oh, and by the way, look on the right side of this replay, right? They have all the AI documents, and then there's your manuals right there. The site is very easy to use, very high and up to speed. I love this stuff. All right, so I'm a fighter pilot and I'm an options trader. I love finishing on time and on target and putting the bomb through the window to the second, and that's exactly what I'm going to do here with Anthony and all the folks at Traders Corner. So let me close with a prayer. I pray for peace on earth. I pray for the Persians, the Iranian people, beautiful, great people. God, please bless them. No more killing on their end. And please, I pray, my son's leaving in 3 weeks. He's in the Air Force for deployment. I pray all the young men and women on the tip of the spear with the United States military come home safe as well. Anthony, back to you, my brother. Everybody else, have a great rest of your day. Fights on. Namaste and basi, basi. Whiz out.
Thank you, Whiz, for that great presentation and fascinating perspective on the AI sector. If you'd like to learn more about Whiz and his solo AI strategy, Whiz, are there any other links we need to put in there before we go?
No, just that email, Whiz, W-H-I-Z at Top Gun Options, and I'll send you our AI report since I couldn't post it in there. But yeah, there's the link to join our service, and then you can shoot me an email if you want that. That's a $3,000 to $5,000 PDF you're going to get. Just shoot me an email.
Okay, thank you so much, Whiz, and have a great weekend.
You too, man. We'll see you.
Thank you. Now let's move on to our next presenter. Our next presenter is Stephen Primo. Stephen is a former stock exchange specialist and a 49 years professional trader. We're so lucky to have this guy, who has spent decades helping traders develop consistent strategies across multiple markets. His presentation today is titled The Only Trading Question to Ask. Please welcome Stephen Primo.
Thank you, Anthony, and thanks to everyone attending today. This promises to be a great presentation. You've heard probably a lot of great speakers and some more to follow, but this is going to be a great one because it's extremely simple, and I'm really going to teach you the only trading question you should ask, but you have to ask yourself this question before you pull the trigger, regardless of what market you're trading, regardless of what time frame and what direction. This is really the only trading question to ask. Now, as traders, from the very beginning, we're taught to ask as many questions as possible. And there's nothing wrong with that because that's how you learn. But unfortunately, we kind of take it over the top where we begin by asking questions to learn, then we ultimately start asking questions to find out what to do. For example, a lot of traders you'll often hear say, what do you think of the market? Or what do you think of this stock? Is it going up or is it going down? Or what's the best time frame to trade? You see, when you ask questions like that, you're basically saying, I don't know what to do. Can you tell me? And I'll just blindly follow you. And that's really where trading goes off the rails, and that's where you start to become inconsistent. I mean, think of it. Trading is extremely important. But for some reason, we just give our power away and ask anyone in the world what they think of the market or what they think we should be doing. And that's no different from, let's say, a brain surgeon asking right before he goes into the operation room, asking, well, what do you think I should do? How do you think I should operate? Or imagine you get onto an airplane, you're going to fly from the West Coast to the East Coast, and you hear the pilot come over the intercom saying, hey, everyone, how do you think I should fly this? What do you think I should do? Or how should I land this? I mean, it's no different from with trading. You should never put yourself in a position where you have to ask someone or something how to trade. You should be knowing that already in advance. And here's the good news. I'm going to teach you exactly how to do that in today's educational presentation. So welcome once again. My name is Stephen Primo. I am the president and founder of Specialist Trading. I've been trading now for 49 years. I started my career on the floor of the Pacific Stock Exchange. I was on the trading floor for 16 years, and 9 of them, I was a specialist. That's where we get the name Specialist Trading. I know a lot of you aren't familiar with what a specialist is or does. I know there aren't a lot of them around anymore, but a specialist isn't someone who's more special than anyone else. It just means that they specialized in making markets, and roughly about 50 or 60 stocks. So in the old days, if you wanted to buy or sell a particular stock, let's say IBM, which was one of the stocks I made a market in, you would call your stockbroker and say, I want to buy 100 shares of IBM. Stockbroker would put you on hold. He would call the floor trader and say, I have a client here who wants to buy 100 shares of IBM. The floor trader would put the broker on hold and walk over to the trader who specialized in making a market in IBM. He would say, I want to buy 100 shares of IBM, and I would sell it to him. Vice versa, there were other traders who said, I want to sell 100 shares of IBM, and I would buy it. So I did this roughly for 9 years. I made markets in IBM and Waste Management, US Air. I made markets and traded through the crash of '87 and the bull market that followed. And I left the floor in the mid-90s to manage money and to also trade my own account. About 15 years ago, I teamed up with my sister site, Pro Trader Strategies, and we formalized specialist trading with one goal in mind. We wanted to be an educational company to teach students around the world all the tips, techniques, and methods that I've accumulated in my nearly 5 decades. So hopefully they'll never have to ask anyone questions and take charge of their own trading. You see, if there's one thing I've learned in nearly 50 years of trading, it's that the only traders who are still around, the only ones who are consistent, are the ones that are in charge of their own trading. They don't ask anyone questions. They don't go to chat rooms or trading rooms. They have a simple plan in place and they follow it. And the purpose we have and the goal we have is to teach our traders all these things so that you will never have to ask anyone. You'll be in charge of your own trading for the very first time. And you'll see that attention to education in today's class. Now, before I begin, we are required to share this with you, so please take a moment to view our disclaimer. I'm going to show you a lot of performance results by applying this specific question and then by showing you how well it can be achieved. But please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. And since we are first and foremost an educational company, all examples are strictly for educational purposes only. Now we have a pretty good crowd here today. If you haven't done so already, please feel free to follow us on X, formerly known as Twitter. Every day I post between 5 and 7 different snapshots of signals our methods have generated or little bits of financial wisdom. So there's lots of free education on a daily basis. Please, I would advise copying down our handle right there, abbreviation for specialist trading, SPC, LST, TRADG. Okay, now I'd like to start out with some facts, and I'm not presenting these to scare anyone or to scare anyone off, but these are actually the facts, and they've been facts for a very long time, since I first started trading. The first fact is that 80% of all traders will lose money. And when I say lose money, I don't mean, well, you'll have a bad week or a bad month. 80% will lose everything that they put away for trading, their little trading nest egg. Right? So you're either going to have to make a decision and say, well, this is just not for me, which is what a lot of traders do, or save up some more money so that you can get back into the trading game. The second fact is that 15% of all traders will just break even. Now that's no small fact in today's markets, but after all your hard work and money you've put in, you've really got nothing to show for it. You're just basically treading water. And ultimately, this means that only 5% of all traders will be consistently profitable. Now we have a pretty good crowd here today. I think we have roughly close to 100 people. This means that only 5 of you listening today will be consistently profitable out of the remaining 95 listeners. Now, if you want to see what this looks like on a pie chart, this large portion in red right here represents the percentage of traders, 80%, that will ultimately fail. This blue slice represents the percentage of traders that will ultimately break even. And this small green sliver here, the small little green slice, represents a percentage of traders that will ultimately be consistently profitable. Now, you have to ask yourself a question. How is it possible that the majority of all trading profits, either on a daily basis, a monthly or yearly basis, but all the trading profits are captured by such a small percentage of traders? Now, I've been trading long enough to know that there are, on a daily basis, an infinite amount of profits to be captured, more than enough for the taking. So why is it that only 5% are able to consistently capture them? Well, it's actually more simpler than it appears, because these traders, these 5%, have all learned how to be in sync with the trend. Now, everyone in the world thinks they're in sync with the trend, but are you really? Because ultimately, being in sync with the trend means that You're wanting what the market wants. In other words, when you make money, let's say you buy and the market goes up. Well, you're in sync with the market. You're wanting what the market wants. It wants to go up and you're buying, so you're going with it. You've jumped on board. But you only lose money when you're out of sync with what the market wants. If you buy and the market goes down, you don't want what the market wants. You're doing the opposite. The market wants to go one way and you're fighting it. And conversely, if you go short, maybe you buy puts, betting the market to go lower and it goes up, you don't want what the market wants. You're out of sync. So obviously, it stands to reason that the easiest way to be consistent is simply to want what the market wants, to be in sync with the trend. And that's what we're going to tackle today and share with you a really simple but powerful way to be in sync with the trend. Okay, so let's begin. So what if there was a tool designed to have you in sync with the overall trend of any market, any time frame, any direction? Makes absolutely no difference. Now, before you go out and say, oh, okay, I see, he's going to try and sell me some $10,000 model or some AI model or something that's based on, some indicators, I have no idea how to use them. No, you actually have access to this right now, because in able to get in sync with the overall trend, you need to use the buy-sell line. Now, it's not some convoluted indicator. It's not some AI trick. What it is the 50-period simple moving average. That's all it is. And you all have access to that. You should. If you're using any type of platform, they should have a moving average line. But let me share with you how to properly apply it. In order to use the buy-sell line, which is the 50-period simple moving average, you must ask yourself this question before each trade. But it must be before each trade, not after you've pulled the trigger, not after you've bought, not after you've sold, but you have to ask yourself this question. And here's the only question you should ever ask. And that is, where is price in relation to the buy-sell line? Not in some chat room saying, well, what do you think of this stock? Or what do you think the earnings are going to be? Or what do you think about that economic indicator? No, the only question you should ever ask is, where is price in relation to the buy-sell line, the 50-period simple moving average? Because you'll only come up with two possible scenarios. If price is above, then you will only have a buyer's bias. That means you will only look for buy setups. Makes no difference whatever you're trading. Could be one of my strategies, could be someone else's, could be another system, could be an option play. Makes no difference, but it should come from a buyer's bias. And conversely, if price is below, then you'll only have a seller's bias. You look to either go short or to get out of the market entirely to avoid it, because you know a lot of people don't like to sell to go short. Now, if you don't believe me how powerful this is, go back and look at your last 10 or 20 trades, apply the 50-period moving average on the chart or what you are trading, whatever time frame, whatever market, and I can almost guarantee you the reason why you had losses was because you were buying below the 50-period moving average and you were selling, meaning going short, above the 50-period moving average. Now, obviously, if you're long a position and you want to get out, we don't mean you can't sell to exit a position if it's above the 50-period moving average. You can exit a position wherever you like. When we say have a seller's bias, we're talking about going short or buying puts or some type of option strategy with a negative bias, okay? So what we want to do then is identify the overall trend. And this is the overall trend of, once again, any market, any time frame. Now, we've made it simple because when I first learned this concept almost 5 decades ago from my mentors, okay, I had to look through literally hundreds of charts a night, almost thousands, and apply the 50-period moving average. Sometimes I had to draw it in because we didn't have, 50 years ago, we didn't have high-speed computers and, trading platforms. It was basically all the charts we saw were through a book that came out on a weekly basis. But now we've made it simple. We've developed and defined different ways in which to identify the overall trend by using our simple tools. And everything you're seeing today is coming displayed by the platform I developed with Pro Trader Strategies. It's the PTS Primo charting platform. It's the only educational platform I know that gets you in sync with the trend automatically, okay? So I'm going to show you some examples of some current charts, some recent charts up until the last week or so, and show you how asking this question by applying the buy-sell line could have extremely helped or can help your trading in the future. But before we begin, once again, let's just take a moment to view our disclaimer, because I'm going to show you a good 9, 12 charts, the recent charts, and I'm going to show you a lot of performance results. But please remember, we are required to share this with you, and we cannot in any way guarantee that any of the results I'm about to share with you will be repeated in the future. And since we are an educational company only, all examples are strictly for educational purposes only. Now I'm going to toggle over onto our platform, the PTS Primo chart platform, as you can see right here. And let's start out with this first chart. This is AXTI. Now, obviously, someone looking at this would say, wow, looking back in hindsight, sure, this was a $2 stock and it's taken off to be a $50 stock, but how would you have known? I mean, you really don't know until somewhere around here that it's in a really strong uptrend. Well, I'm going to show you how you would have known to have a buyer's bias well in advance of anyone else, before you even listen to any earnings or any news events or economic conditions or, you know, what someone says in a trading room. You can do this yourself. You don't have to ask anyone, what do you think of AXTI? On our platform, we start off in the far left-hand corner where it says buy sell line right here. All right. And when you click that on, you get this drop-down menu. Now, the buy sell line is just the 50-period simple moving average, as it says. We have a number of ways in which to apply that. Let's apply our most popular way, which we call the fluid buy sell line. And once you click that on, here's what it does. This line right here between the two colors is actually the 50-period moving average, but anything above is colored a nice blue, and anything below is colored kind of orange red. So this automatically tells you which bias you should have. It tells you where price is because you're looking at the background color. So look what happened here, going back to 2025. All right, this was in August, I believe. Price was kind of flirting with the buy sell line. It's hard to see, but right here at the end of August 2025, almost a year ago, right here when the price was $2, $3, look what happened. We had consistent closes above. Now the rule of thumb is you want to see at least 3 closes above for you to have a buyer's bias, and you want to see at least 3 closes below for you to have a seller's bias, because sometimes price will oscillate above and below. So you need 3 consecutive closes above. And we had that right here, as you can see, in August. So the market, not some guy in a chat room, not some guy on TV, not even some guy in a webinar, the market was telling you, I want to go higher. So that entire time, all you had to do was apply some type of strategy, some type of system, whatever you wanted to. Now I could apply one of ours and show you exactly how easy it was using our buy signals. These were all our buy signals using this one technique because we're all in sync with the market. Let's look at another example tomorrow, okay? This is a daily chart going back to October, November of last year, a good 5-6 months. Obviously, this has been going lower, right? And someone would say, gosh, you know, Steve, I'm long this in my portfolio, but I'm losing a lot of money. I mean, that guy in the chat room tells me to keep buying more, but I keep losing money. Well, how simple would it be if you had asked yourself this question right here by applying the fluid buy sell line? Where is price in relation to the buy sell line? Now, right here we have 1, 2, 3 consecutive closes below. This is when price was about 17 or 18. Okay. Do you think you would have loved to have gotten out last November and bypassed all of this? There's no reason to look at earnings. There's no reason to look at some economic announcement. The market, the very thing that you're trading is telling you, I want to go lower. So why would you be out of sync with that? Remember, you only lose money when you're out of sync with the market you're trading. So why would you buy this or hold on to a position? Now, look what happened here Friday. This was up until this last week. On Friday, it closed above. That's not enough for us to tell that the overall trend is up. We need at least 2 more closes with that blue background, the blue buyer's bias, to tell us it's okay now to start looking to maybe buy this. But remember, just because it closes with the blue background above the 50-period moving average, it does not mean that we simply buy at the market. The buy-sell line is not a strategy. It's not a system. It's simply a directional tool telling you which bias you should have. Should you have a buyer's bias or a seller's bias? And once you know that bias, then it's simple to apply any strategy or technique you'd like to that market. It's half the battle. Let's look at Costco. Here's a daily chart of Costco. Now, Costco, going back to October, November, was headed lower, and then all of a sudden it took off and now it's headed higher. How could this have helped us? Well, we apply the buy-sell line once again. This is how simple it is. And you see this entire time we have 1 close above, right back down. One close above, right back down. One close above, maybe two, right back down. But here we had three closes above. 1, 2, 3. This was our signal telling us it's okay now to apply a buy strategy to this. And as we said earlier, you could apply any strategy you'd like to buy this, you know, and you could have potentially captured upwards of 85 points to the upside. Let's look at FICO. Now this was doing the opposite. This was heading higher, and then roughly about the beginning of the year, it started to head lower. What if you were long this and said to yourself, gosh, I'm losing a lot of money. This is an expensive stock, and I'm getting killed here. You say, boy, maybe I got the wrong information. Maybe that guy I listened to didn't know what they're talking about. This is why we say you should never listen to anyone or anything tell you what to do. There are readily available tools around that you can just decide for yourself. As we apply the buy-sell line, we see that price was above this entire time until right here, beginning of the year, 1, 2, 3 closes below. And this is when the stock was trading roughly about 1650. It dropped all the way down almost 600 points. It lost a third of its value. Now, at specialist trading, we don't follow the news. We don't look at anything fundamental. We don't look at any earnings estimates or economic indicators. We only listen to one thing, and that's what the market is telling us. And the market told us in January, I want to go lower. That's all we needed to know. Now, if we're not the type of trader that likes to be aggressive and go short, well, then we would exit this and say we're not going to get involved. We'll wait for it to go in the blue zone. But if you're a more aggressive trader, you could have applied some type of shorting strategy and taken advantage of this nearly 600-point drop. Let's look at a weekly chart of Google, okay? Same process applies. Here's a weekly chart. Each one of these bars represents a week. Right here, going back to July or August, we had 1, 2, 3 closes above. This was telling us on a weekly basis, it's time to start looking to buy this. And this is 170 points lower because the stock has risen roughly 170 points since then. Or we can look at Amazon. Okay, here's a weekly chart of Amazon. Now, Amazon has been above the buy-sell line since June of last year, but look what happened this past couple of months. 1, 2, 3, 4, 5, 6 weekly closes below. This is more than enough to tell our students, not me, not some guy on TV, but for the market telling our students, I want to go lower. So if you're thinking of buying me, that's a very low percentage trade. What you should do is think of selling me, or else don't get involved with this at all, because the market is telling you it wants to go lower, even though it really hasn't even begun yet. Now, the market can change its mind, but it would need to have 1, 2, 3 closes in the blue zone before it told us it wanted to go higher. Here's a weekly chart of CPB, all right? Don't you think if you were long this, you would have liked to have exited somewhere around here when we had 3 consecutive closes below? All right, this is basically a 20-point drop, but that represents a 50% loss in value. It lost roughly about half its value. What if you had owned this stock and you said, gosh, you know, I owned this stock in the 40s, now it's in the 20s. It's lost half its value. How would I have known? That the earnings look good, that guy, my stockbroker said it was a good company. Remember, only listen to the one thing you should be listening to, which is the chart in front of you. After all, that's the source, right? That's what you're trading. So why would you listen to an outside source? I know a lot of you are saying, but I'm always trained to do that, Steve. I was taught to look at earnings and stuff. Well, remember, I started trading roughly about 50 years ago. I was trained the exact same way. I was told to look at all the earnings, look at all the economic news that was coming out, listen to all the gurus, find out what they liked. And guess what? 50 years ago, that didn't make me a dime. For the first year or so on the trading floor, I struggled because nothing made sense. I would have fantastic earnings in some of the stocks that I traded, and they went straight down. Or there was terrible news, terrible economic news about the markets, and the market went straight up. So there's no consistency in that type of trading. I know you're all aware of this. You've all gone through this, right? Where it just doesn't make sense when an announcement comes out or somebody says, oh, it should go straight up, and it goes straight down. It wasn't until my mentor said, Steve, listen, stop listening to that useless noise and only listen to the one thing that makes sense. That's the chart in front of you, because it tells you what it wants to do. So that's when I started listening to them and following their advice. And that's when my trading started to become consistent. So The market tells you just about everything you need to know. The only trouble is we're never trained to listen to the market. Remember, we're always trained to ask as many questions as possible, which ultimately leads us down the path of asking someone, what do you think of the market? What do you think I should do? Once again, would a lawyer in the courtroom ever ask his client, how do you think I should try this case? What do you think I should do? But for some reason, it's okay to do that with your hard-earned money. Let's look at a monthly chart of GLD. Now that's the ETF that represents gold. We've all seen what gold's done in the past year or so, right? A couple of years. This is where traders love to play the victim game, and they love to say, gosh, how would I have known? I mean, the gold just like took off without me knowing, and by the time I found out, it was too late, right? Well, that's because you're relying on outside sources to tell you what to do. If you would use the buy-sell line, all you would have to done is click it on, and you would have seen right back here, we had 1, 2, 3 closes in January of 2019. Remember, these are monthly bars. And you would have known when the gold ETF was roughly trading around 150, it's gone up in the 500s now, okay? So it told you it wanted to go higher. So all you had to do was apply some type of structure in the form of a strategy or a system and an options play. It's up to you. But you knew that it was time to buy gold because the market, not me, the market was telling you. Now we can apply this to different markets, different time frames. Here's a 4-hour chart of the yen, the British yen, the dollar yen, I should say. If we apply the fluid buy-sell line, same process applies. Just because we're looking at a different market or a different time frame doesn't mean we change anything. The buy-sell line doesn't know what it's looking at. It's just listening to the market. And right here, going back about a month in February on a 4-hour chart, it told us it wanted to go higher. Now, had you taken advantage of that and applied some type of buy strategy right here, well, guess what? Coming into yesterday, you potentially could have captured 500 pips. That's potentially $5,000 per unit just by simply applying the buy-sell line, which you all have access to. It's just the 50-period moving average. Now, if we look at a daily chart of the Canadian dollar, well, this is the opposite. It's going down, it's going up, going down, kind of flattening out. But if we apply the buy-sell line, it's telling us right here since December that I want to go lower. We had one close above here, close below, another close above, and then look what happened. This is why we say you need at least 3 closes on one side, either the blue buyer's bias or the blue seller's bias, to tell you what the overall direction is. And so this wasn't enough to tell us to go long. And look what happened here just Friday, 1 close above. Now, sure, we may have 2 more days of closing above, in which case that would be the Canadian dollar telling you I want to go higher. But until that happens, you would still have a seller's bias. Now, we just looked at gold, the ETF that represents GLD that represents gold. Let's look at SLV, the ETF that represents silver. Now, this is a daily chart going back to June of last year. Look at the closes that were above. It's hard to tell here, but we were originally below in May, but then coming into June, we have consecutive closes above. This is when it was trading roughly in the 30s, okay? It went all the way up past 100. And basically, this was telling you I want to go higher almost a year ago. It never went below the buy-sell line. Now look what's happening now. We had in February 1 close below and then right back up. 1, 2, 3, 4, 5 closes below, but then right back up. 1, 2, 3, 4 closes below, right back up. Then 3 more closes below. So what the market is telling us is that it's at a turning point. It's very indecisive. It may bounce and go right back up, or it may be over and go lower because it wants to go down. So the market, not me, not some guy on TV, the market is telling you, I'm trying to decide what we're going to do here. So in cases like this, you may want to sit back and just watch. Now, the market wasn't indecisive at all with the Dow Jones Industrial Average. Here's the Dow Jones. This is going back to December on a daily time frame. We were well above the 50-period moving average. We had 1 close below, and then we closed right back up. But look right here, 1, 2, 3 closes below. This was at the first day of March. This was just a couple of weeks ago. This was the market telling you we're going to go lower. I want to go lower. Forget about what's happening in the world. Forget about what's going on economically or with gas. The market told you I want to go lower roughly 2 weeks ago, okay? Now, it's since then fallen 2,000 points. There was no reason to look at news. There was no reason to listen to some guy on TV. There's no reason to follow what's going on in the world. The market told you, I want to go lower using this method with the Dow Jones. Now, in the Dow Jones, there's only 30 stocks. Let's look at the spiders. That's the ETF that represents the S&P 500. Now, this is going back since the beginning of the year, December into January. It's had this kind of fits and starts, up, down, up, down, up, down. But we apply the buy-sell line. We see here that once again, it would flirt with the buy-sell line, one close below and then right back up above. One close below and then right back up above. One close below and then right back up above. That's why you need at least 3 closes below. So look what happened in mid-February. 1, 2, 3 closes below, okay? So this was telling us that, well, it looks like we're getting ready to go lower. And then we had 4, 5 closes. 1 close above, 1, 2 closes. 1 close above, 2 closes above. And then look what ultimately happened. 1, 2, 3 closes below. And then we've continued to go lower and lower. So the market tells you just about everything you need to know. The only problem is we are more concerned about asking someone, what do you think I should do? What do you think the market's going to do? What do you think this stock's going to do? I should go into that chat room to find out what to do. Or I should subscribe to this newsletter to find out what to do. We're all taught to give our power away. Remember, in my nearly 5 decades of trading, the only traders that are still around are the ones that make their own trading decisions. They don't really focus on news. They don't focus on what someone is saying on TV. They just simply have a plan in place and they follow it. So it's our goal to provide you with the tools and techniques, one of them, which you just saw here today, to help you make your own trading decisions. Because I just don't want you to have a good month or a good year. I want you to have a good couple of decades. And these consistent methods will help you to survive any type of market scenario, because for the first time, you will be in sync with whatever market you're trading. Okay, so let's go back to the presentation. Remember, the only question you ever need to ask is what, or should say, well, where is price in relation to the buy-sell line? You will have a higher level of consistency if you only buy above the 50 and you only sell below the 50. And as I stated earlier, if you don't believe this, if you still don't believe it, go back and look at your last 10 or 20 trades. I can almost guarantee that the reason you lost was because you were buying below the 50-period moving average and you were selling, meaning going short, not exiting, but selling or buying puts above the 50. You only lose money when you are out of sync with whatever market you're trading. Okay, we have a great offer for all of you taking time out of it to listen to this special presentation today. We're going to offer you what we call our Trading Floor Edges course. This is a 10-video course which includes over 49 years of trading experience. Now, if you like the edge I just shared with you today, how would you like to get many more high probability trading edges? Similar, but totally different from what I just taught you today. 2 more techniques that will elevate your trading. Now, I gave you one way in which to be in sync with the overall trend. How would you like to have a total of 4 different ways to be in sync with the overall trend? 3 steps to a successful trade. I also go into how to fine tune your entries. A lot of our students who are new students of ours say, you know, Steve, I have a strategy that's okay. It's just my entries are faulty. Or next level exiting techniques. A lot of our students have been exiting too early or too late, and this really digs into a lot of their profits. So we'll take you to the next level with our exiting techniques. Everything we teach, all the things I've accumulated in my 49 years can be applied to any market or any time frame. So it makes no difference if you're trading crypto, if you're trading currency pairs, stocks, futures, makes absolutely no difference, okay? Now here's one of the best things about this course, the Trading Floor Edges course. I'm also going to share with you a superior candlestick trading edge. Now we know that most people either currently or at one time have traded with candlestick patterns. Candlestick patterns are often referred to as reversal patterns because they're looking for a trend to be established, and then you look for a candle pattern that is telling you that that trend is going to reverse, okay? For example, as we look at this older chart of PLTR, obviously the trend was going higher, right? Higher highs, higher lows. And so you would say, well, if I'm a candlestick trader, I'm looking for a pattern or a series of patterns that's telling me that this uptrend is going to reverse, or simply stated, is over. And what do we have here? We have a dark cloud cover pattern, which is a very negative pattern, and then followed by a bearish engulfing pattern, an extremely negative pattern. So you have a series of two negative candle patterns that are telling you either to exit or to go short. So let's say you were a more aggressive candle trader and you decided to sell, go short, okay? So you're all excited, you think the market's gonna fall out of bed, maybe that guy in the trading room tells you that this is a great short, and then look what happens, go straight up, right? Well, it's been my experience that trading candlesticks, the traditional style, really doesn't have a higher level of consistency. I'm gonna share with you a very high edge trading way of trading candlesticks that would not have gone short here or sold. In actuality, you would have bought just before that right there and potentially captured this gain. So this is what you'll learn in the 10 video course as well. This is our superior candlestick trading edge that is yours included in this course. Okay, so let's break this down. You're going to get many more high probability trading techniques, all of these things that you can apply to any market, any time frame, and a superior candlestick trading edge. Now, my sister site, which is Pro Trader Strategies, usually sells this for close to $1,000 because it's jam-packed with so much information, 10 videos. But here's what we're going to do. We're going to drop that down tremendously and discount it, but for a very limited time, down to only $39. So think of that, $39. I know most of you maybe are thinking about going out to breakfast or lunch, or already have, and if you're going out with someone else, you can't go out to lunch or breakfast for less than $50 or $60 these days. But for $39, you're getting nearly 5 decades of high probability trading edges that I continue to apply today. So this is for a limited time only, $39. But guess what? We're going to take it up a notch. We're going to also offer you some extra bonuses, but this is for the first 20 traders only, okay? For the first 20 of you to respond to this, to the $39 deal. We will also, along with your purchase of the Trading Edges course, we will include a 50% discount on any other product we sell. So any other strategy, any technique, any indicator that we sell, you will also get 50% off. That's tremendous, tremendous deal along with the $39, okay? But remember, this extra bonus is only for the first 20 people that apply. So you have to be sure about this. Remember, we're trying to elevate your trading. You owe it to yourself to take your trading to the next level. If you're truly serious about elevating your trading, I think you can afford $39 to really get yourself on board. Okay, so here's how to take advantage of this great, great offer. Contact my sister site, which is Pro Trader Strategies. I would highly recommend giving them a call at area code 310-598-6677. They have trading consultants manning the phones right now. They would be more than happy to take your order over the phone or answer any question you may have. There's absolutely no obligation. They'd be willing to answer any question about other products or other things we teach or sell and trading techniques and methods. So I would really give them a call. And if you're at all interested, once again, in learning more about these simple techniques that can elevate your trading, that $39 deal is for a very limited time only. I think it'll probably expire by this Monday. So I would highly suggest giving them a call and taking advantage of it. Now, that link you see at the very bottom is the link that will take you to the info page with this special offer. Also, I believe you can sign up on that if you'd like, but it's not a live link. I don't know if Anthony is going to post that, or maybe he already has. I'm sorry, I just don't know if you have, but you have to copy and paste that onto a browser in order to use that link. Okay, I think we just have about 5 minutes left. If anyone has any questions, I guess go to your question and answer. I don't know if Anthony, if you want to read them, or I can kind of scroll here and see if anyone's asking any questions. One of the main questions, while you're taking time to write something, one of the main questions I always get is that someone will say, well, Steve, I haven't been trading long enough. I'm not experienced. Maybe I don't have enough money, and so I'm not really sure how to do this. Well, there's no reason to worry about that, because every one of my students, whether they've been trading for 30 minutes or 30 years, gets my private email address. So you can contact me whenever you'd like. During the weekend, I've already had some emails already before I presented this webinar. During market hours, after the market closes, before it opens, it makes no difference. And all emails go directly to me. They don't go to an intern or to a salesperson. They come directly to me. So I'll just be the only one viewing your question. So if you ever have a question about the information that is jam-packed in this, don't worry, I'll be able to answer it and get back to you as soon as possible, okay? So it's the next best thing, I think, to have me sitting right next to you on your trading desk, wherever you are, okay? I don't see any questions, or maybe I'm not looking in the correct place, but if there are no questions, I guess I would give it back to Anthony. Let me see here if I'm looking at the correct place. I'm looking under the chat, and I don't see any questions. So Anthony, I guess we're a little ahead of the game here. If you'd like to take it back, I just want to thank everyone, and remember to take advantage of that $39 deal because it's not going on for a long time. And just give Pro Trader Strategies a call at 310-598-6677. They're very flexible. They're there to work with you, and they'd be happy to answer any question or even take your order over the phone, okay? With that, I guess I'll give it back to you if I don't see any questions.
Thank you so much, Steve. I just put in your offer there.
Oh, thank you so much. I see
Yeah,
it.
you're welcome. I'm going to put in the phone number right now too, so people could grab it quick. I didn't see any questions either. So if there are any more questions, please ask now before we jump off here.
That just means I explained everything pretty well, so that's good.
You keep it simple, Steve. So
Yeah,
we appreciate that. You do, man. You're great. And what a really great offer today too, I have to say. I mean, I apologize. I'm still typing in the number here.
Yeah, no, the reason why we have such a low offer is not because it's not that valid. It's because we want to show you in good faith that we really want to educate you, and we wouldn't feel right sharing with you one of our more expensive, $5,000 products, and we know that not everyone would be interested in finding out who we are. So we really want you to get to know us by presenting you with a low offer so that you'll get to see how sincere we are, really wanting to educate you, and then hopefully you'll come on board and buy one of our strategies or one of our indicators.
Yeah, it seems like a great offer for sure. Thank you so much, Steve, for being here today. I just put in the phone number as well, so be sure to give them a call. I said it's Steve's phone number. It's not his number, but give them a call and click on that link. That's a good link. I just put it in there and checked it myself.
Great, thank you, Anthony.
Y'all, you're welcome. You're welcome so much. We appreciate having you here today. Thank you, Stephen, for the valuable educational presentation, because it always is a valuable educational purpose while you're here, and we appreciate that. And we appreciate all the years of service you've given to the financial markets. For those interested in learning more about Stephen's work, we've placed a special discount link in the chat box for you. So thanks again, Steve, for being here. We love you. Now let's continue with our next presentation. Our next speaker is Larry McMillan, founder of McMillan Analysis Corporation, one of the most respected voices in the world of options trading. His presentation today is titled McMillan's Market Outlook, What Option Indicators Are Saying Now. So please join me in welcoming another trading legend, and that is Larry McMillan.
Oh, thanks, Anthony.
You're welcome.
You see the screen okay there?
Yeah, we could see it.
Okay. So pretty interesting market these days, especially in terms of volatility. So I'm going to go over the indicators, but at the end, I'm also going to offer a couple of volatility strategies. They don't come along too often. Just owning volatility all the time is a losing proposition, but there are times when it does pay to own it. And right now, this is one of them, I think. Anyways, so this is just a quick background on our company. We started out as a derivatives research firm originally, then moved into money management in 2008. So we're both a CTA and an RIA. And then we also have an education division, things like this, webinar, mentoring, etc. I'll come back to this later, but we will be sending you the PDFs of this webinar. That's plural because one's in color and one's in grayscale in case you want to print it out, you don't waste all the ink in your printer. I'll come back to this link later on. So there's four main indicators that we look at. They're all pretty active right now. The chart of the S&P 500, of course, being the primary one. For a long time, it was going sideways, even though sell signals were developing. That's changed now, finally. Equity-only put-call ratios and individual stock and futures put-call ratios. We'll take a look at some of those. There's a few interesting ones there. Market breadth, which is basically in the toilet right now, but we'll discuss how that lines up. And then we'll take a look at VIX and the VIX products and what strategies might be appropriate with VIX. There's a couple of important rules, and this first one right now is very important. Oversold does not mean buy. So we're already oversold in some areas, breadth being one. But just because we're oversold, it doesn't mean you want to jump in front of a downward rolling freight train. So you really need to wait for buy signals to confirm. You might miss the absolute bottom by doing that. In fact, you will miss the absolute bottom by doing that. But you won't be holding, into a roaring bear market because you bought the first time it was oversold. The companion to that is overbought does not mean sell. We don't have anything really right now that's overbought, but there were some last summer when the market continued to go higher out of the April, May lows. And overbought conditions can persist for a while too before they eventually confirm into sell signals. So here's a long-term chart. A couple of things on this chart are I think, of importance. First of all, those solid blue lines there, they kind of indicate where the market had trouble making a top. So this is the first one. That's just recently. We tried a 7,000 level several times, just could never get through it. A year ago, we were hammering during December, January, February against at a new high level at that time too, around 6,100, a little bit higher maybe. And both times it's failed now. So last year we went into a monster 21% correction in 37 trading days, which is pretty ugly. That came about, it started to go down just out of its own weight, but then it went down faster when the first tariffs were announced. Right now, it started to go down out of its own weight, but of course now we have the war with Iran, and I'm not sure how far down it can go, but we do have some support level here around 6,500, 6,550. It's been tested. You can see 1, 2, 3 times in last fall, not since. And we've also already now declined to the 200-day moving average. Sometimes you'll get a bounce off of that if the institutional investors, they like to use that as an indicator, but that's very questionable because it can be overridden pretty easily. A budding downtrend has started in the S&P chart. That's that downsloping red line there. And the pink line is an important point, and I've been writing about this for a while now, last few weeks, but it finally happens. The December low was 67.20, and we finally closed below that on Thursday and again on Friday. So when that happens, Trader's Almanac had a lot of systems invented by Yale Hirsch back in the 50s, 60s, 70s, what have you, and the company's run by Jeff Hirsch now. But Yale had discovered, or documented, I guess a better word, that if you, during the first 3 months of the new year, if you break the December lows of the old year, the market declines another 10% on average. So, 10% on average is going to take us down around 6,100. I mean, 6,100 does have some, support from those highs from a year ago we talked about. That's roughly where they are. And then there's also, some other work on the way up that we saw, but this 6,100, 6,150 there, just a little over 6,000 there. So the 10% decline doesn't happen immediately. I mean, many times it took almost a year for that to unfold, and it's, again, just an average number of all the times that this has happened. So it's just something that is bearish in my opinion, and we're going to be dealing with that for a while. Here you can see the support level at 67.50. I'm sorry, 65.50. Again, we bounce off that 3 times. We haven't tested it recently, but we're probably going to this week. So, you know, what could turn a chart bullish again? Well, you'd have to break through 7,000 and hold it. We went above 7,000 for a day or two or whatever, but we never did really hold on to that. So right now this chart is bearish. It's in a downtrend. The 20-day moving average is trending down. The modified Bollinger Bands, which I'll talk about next, are trending down. And you've broken the support at 67.20, which I think is a big, is very important. So modified Bollinger Bands. When John Bollinger first invented Bollinger Band, you needed a realized volatility to draw the bands around, and he used the standard deviation of closing prices, which seems to be a reasonable thing to do. But in the Black-Scholes world and the math world, where the professors are involved, they use the standard deviation of percentage daily price change. So you get a slightly different number. We use that in our work because we need our realized volatility to line up with our implied volatilities that are coming out of the Black-Scholes model. And so we draw these Bollinger Bands around the chart, and we get a chart that looks like this. So this is updated through last night, and the top right there, the top one, that's plus 4 sigma, 4 standard deviations, and then one just inside it is plus 3 sigma. So for example, back here, we came above plus 4 sigma, then went below it. That was a sell signal, which its downside objective right there when it hit the -4 standard deviation band. So you can see that the 2 red signals are the successful ones. Those other blue ones were stopped out. We have a system trading around this. Normally it has a much better percentage than that, but we haven't had a signal for a while. Now we're nearing the -4 sigma band, which is interesting, but you know, I don't know if we're going to actually get an actual full-fledged buy signal right away. We would have to come below there, then rise back above, and there's a couple of other criteria that have to be met. So it's a potential buy signal, but probably falling below the -4 sigma would just be an oversold condition, and as I said before, oversold does not mean buy. So right now the Bollinger Bands are not giving us a signal. We can draw these around individual stocks. In fact, we have a service that we sell for a pretty low price where we just look for these things daily, and it runs off of TradingView. So this is that same chart as you'd see it on TradingView. That's the sell signal of the curve back there last summer, and then nothing else since then. You can see the previous buy signal in April, and then the other sell signals that I showed on that previous chart along the way. So one interesting chart right now, though, is Netflix. I circled the signals on there on TradingView. They're just the triangles, not the circles. But you can see that it's been pretty good. I mean, the sell signals are decent, the buy signals are pretty good. And we just had a double buy signal now. The first one really didn't do all that well, but it gave us the second one right here, which then led into this big earnings run up. And now we've gone above the +4 standard deviation band. We've come back below the 3, which is right here, but we don't have a confirmed sell signal yet. I mentioned there's other criteria, so it's waiting for these other criteria, but we could soon have a sell signal here in Netflix. Anyway, let's move on to put-call ratios. Put-call ratios are a great contrary indicator. For the broad market, we use the equity-only put-call ratio. That's all stock options that trade. But basically, the indicator was invented by Marty Zweig back in the probably 1970s, maybe even 1950s. And he was getting the volume out of Barron's. The put and call dealers would advertise in Barron's each Sunday and tell how many puts and calls they traded. And he started to realize that if there was a lot of put buying going on, the market went up. And if there was a lot of call buying going on, the market went down. So it's a contrary indicator. Defining what too much is of course, the crux of the matter. When we publish over 1,600 put call ratio charts every day on our website in an area called the strategy zone. And all of our put call ratio charts include not only the put call ratio chart, but the stock price as well, because it's important to see them working together. So let's just say, this is theoretically, now let's say a stock is falling, and as it's falling, people are buying puts, that forces the put call ratio higher. Put call ratio is just put volume divided by call volume in this case. So put volume is increasing, the ratio is increasing. Eventually you get to a point where you get a local maximum in the put call ratio. That is a buy signal for the stock. So now the stock starts to go up. You over to the left-hand side. Stock is still going up, and as the stock is going up, people are buying calls. Well, that forces the put call ratio lower because the denominator is calls, the denominator is increasing, the fraction decreases. Eventually, you get to a local minimum in the put call ratio, and that is a sell signal for the stock. So that's the theory. And if you're looking at a put call ratio chart and you're not seeing that symmetry, then something else is probably going on, like arbitrage perhaps. So on top is the S&P 500. This is not a current chart, by the way. On the top is the S&P 500 index, and on the bottom is the equity-only put call ratio. As I said, all stock options that trade, and you can see the inverse symmetry here. So that's why we use the equity-only put call ratio as our indicator for the stock market. So here's where we are today, and we last got a local minimum right in here in February, actually late January, and that's a sell signal. I marked it in green because it's still open at this time, but the ratio has been going higher and higher, and just this again through last night, it's the highest point so far. And eventually, we'll come up here and make a local maximum for another buy signal. But right now, this is on a sell signal. You might say it's sort of in oversold territory because the last time it was this high was last April. It was higher then. But again, oversold doesn't mean buy. So we're watching this. It's a sell signal. At first, it seemed like the sell signal was early. The market kept going sideways, bouncing off of support. Eventually, now that support has given way. As the computer came along, we could also calculate a weighted ratio, which is how many dollars are being spent on puts versus how many dollars are being spent on calls, not just using pure volume. And so that's called the dollar weighted ratio or the weighted ratio. And you can see it's similar. It formed a local minimum here in February. That was the sell signal. It's still now going higher, and that sell signal is still in place. The red letters, though, are pretty successful trades. Typically, a put call ratio signal will only get maybe 6 to 8 a year. So the big one, of course, last year was the buy signal in April, or maybe the sell signal in February last year. We'll see. This one right now is going pretty well so far after a slow start. So well, this is just sort of a repeat of everything I was just saying, but we can do these same signals for individual stocks. We'll take a look at those in just a second. But what do we buy when we get one of these signals, either a modified Bollinger Band signal or this? So we buy SPY options, typically slightly in the money, a fairly short term, maybe 3 weeks out, 2-3 weeks out. So that option is going to have a fairly high delta, meaning that as we're right about where the underlying is going, say SPY in this case, then our option is going to make money because the high delta means it's going to track right along with the underlying. If you buy options with too low of a delta, you're then you need to almost be right twice. You have to be right on the underlying, and you have to be right in magnitude that your out of the money option you bought for a low delta pays off. Even with put call ratios, sometimes we'll go out 2 or 3 months on one of those positions, especially in stocks. We'll still buy it at the money call because that has a delta of slightly better than a half. Now, on TV, if you see them make option recommendations, they almost always want to spread. And by spread, I mean this. So they'll buy a call at the lower strike if they're bullish on this stock. And then they also sell a call at a higher strike. So as long as the stock is moving up between these two in this area, fine, you're making money. But eventually, if you rise above the higher strike, you cut off all your profit potential. Now, I don't like doing that, and you shouldn't like doing that either. That's a terrible thing to do to yourself. It only makes sense if the options are quite expensive. So like right now, VIX is high, as SPY options are expensive. It makes some sense. But even there, you want to take some, measures to try to mitigate the negative effects of the spread. But why do they do this? Well, they always say, well, the risk is lower. Actually, the risk is not lower. Your broker asks you to put up cash for either the bull spread, which is what that spread's called, or the long call. So you're risking 100% of that cash in either case. So your risk is not lower. Dollar risk is a little bit lower, but that's easily adjusted. And instead of maybe buying, 5 bull spreads, you buy 4 calls. And then if you're in the call and it really takes off to the upside, you have this, which is really what you want. I mean, I've been trading for a long time, and if I cut off all my big winners before they really got started, I would be in trouble. I think, I tend to try to get into trading and follow it. It's momentum as it's going on. You can only do that if you keep opening the upside. So if you did do a spread, though, if you kind of felt that options are so expensive, you can mitigate the negative effects of the spread in 2 ways. One is widen the difference in the 2 strikes. So right now, SPY is trading around, I think, 662. Yesterday, just look at, 662. So if we're buying a SPY options expiring late, well, I said March 13th, that should say March 20th. We've already gone past March 13th. But if we're buying options expiring more than a week from now, if I'm bullish in the next week, just buy the call, forget about the spread. But if it's longer than that, I'm going to buy, and I'm bullish, I will buy a call spread that's 20 to 25 points wide. But if I'm bearish, I'm going to buy a put spread that's 50 to 60 points wide. The reason that you can do that is that the option out of the money puts are much more expensive than out of the money calls. So the 2 spreads cost about the same, even though one's much wider than the other. The second thing you can do is roll if the short strike is hit. So what do I mean by that? Well, let's say you put on this spread, SPY 680, it was just that the other day. And what is going on here? I know I changed some of these they were supposed to all be April. Oh, okay. That's supposed to say April. I'll fix it up in the PDF that I post that we'll send to you. So let's say you're buying the April 680 call and you're selling the April 705 call, so 25 points wide. You put that on, you're fortunate enough to have SPY rally up to 705. What do you do then? Because you're just you're almost out of room on that spread. In other words, it started out like this, and you've rallied up here now to 705. Yes, there might be a little profit potential left in the spread, but basically the profit line is just going to start going sideways and you're pretty much out of luck. So what you do is you sell that spread, take the profit, and buy a new one, moving everything up 25 points. So graphically, you first bought this black line spread, and now you roll up to the red one. And so it's not as profitable, let's say, as maybe have just owned the call in the first place, but you did the spread because you were trying to keep your risk in line. And so now you can just keep doing this as SPY keeps rolling to the upside. Right now, that spread costs $12.80 if we look at April expiration. And that's, so it's 25 points wide. So we're paying $12.80 for a maximum of 25 a month from now. I mean, that's okay, but as option trades go, that's not all that great. You could even do it a little wider if you want to put up more money, but we try to keep our position, our speculative positions in our newsletter recommendations down around $1,500 or so. or slightly less. So that's not all that great. But if you look at the put spread, remember I said the puts are more favorably priced. So again, you'd be buying the at the money put and then selling a put 50 points out of the money. This spread now costs about the same, 12.30, but now you could make as much as 50 if the market drops. So that's just the way you know, the log normal price distribution pricing of options works out. But right now, you know, that spread is available. We actually are buying that spread. The one at the money, buy it at the money put, sell one 50 points out of the money, because S&P is broken down below 67.20. So in this case, if it did trade all the way down to the lower strike, you take your profits on that spread and set up a new one. Again, do that repeatedly. So that's how you mitigate the negative effects of the spread. Let's just take a minute, look at some individual put call charts. This is H&R Block. You can see that it gave a very nice buy signal back here a year ago, short-lived but decent. And then it gave another one here in December. That really wasn't worth much. I don't think it would have made much on that little move in the stock. And now it's given another one. And so the stock has been bumping up against 32.5 and hasn't been able to get through there. But if it does, we want to buy it, we'll buy it. And if it doesn't, then I'm not going to take this signal. So sometimes we combine the put call ratio signal, in this case, the local maximum, the buy signal, with some chart analysis. Similar thing on the downside here, CarMax came down, formed a local minimum, very low on the chart. A lot of people were, you know, very optimistic on the stock at that point, so that forced the put call ratio lower. Now we got the local minimum sell signal, but this is the 41 level. Unless it can break through 41 on a closing price basis, I'm not that interested in buying puts. But if it can, and it's almost there right now, then yes, we'll buy puts. You can use the same analysis, put call ratio, with futures options. This is copper. So the blue line along the bottom of the chart, the put call ratio, that's drawn using the volume, the weighted dollar weighted volume of copper options that trade on the ICE. So recently it gave a sell signal in January, and we noticed the thing kept bouncing and bouncing and bouncing. It went below one day, then bounced again. Finally, it's bounced down again below that resistance level. If we look at the chart of, you don't have to, in this case, you don't have to have a futures account in order to speculate in copper. You can trade FCX, the Freeport McMoran stock, because its price pretty much tracks the price of copper. And FCX has also now broken down below support. So this would be a new sell signal, a new position, buying puts on FCX. And you don't have to actually have an account with a futures broker to trade copper futures. On the other hand, this is cocoa, just gave a new buy signal, a very high level buy signal. There was certainly a lot of bearishness in cocoa in the last 6 months, 8 months. You can see the put call ratio finally just took off this year and went to really high levels, a lot of pessimism. And now it's rolled over, giving us a buy signal. So if we want to buy cocoa or cocoa options, we're going to have to do that on the ICE, and we have to do it through a futures broker, because there is no ETF that tracks the price of cocoa. There used to be, but there isn't anymore. So if you want to take advantage of this speculation, you need a futures account. Now, if you're trading at Interactive Brokers, every account is allowed, assuming you satisfy the compliance requirements, every account is allowed to trade both futures and options out of the same account. That's not going to be the case at, let's say, Merrill Lynch or somebody like that. You probably have to have a separate futures account. Anyway, let's move on. The next indicator is market breadth. In this particular case, there's two things we can do with market breadth. First of all, market breadth is just advances minus declines on a daily basis. And you can use New York Stock Exchange data for that. Or we also use what's called stocks only data. meaning all stocks that have listed options. And there are over 6,000 of those, so that's a pretty robust data set too. So we can keep a running total of the advances minus declines, and we can also keep an oscillator. We do both. And our the oscillator value for today, let's say, is 90% of yesterday's oscillator value plus 10% of today's advances minus declines. So we keep this for both the stocks only and the New York Stock Exchange. And here's how it looks right now. So this chart goes back about 7, 8 years even. Oh, well, not quite 8. And you can see that for a long time, over on the left-hand side of the chart, we're hardly ever oversold. Yes, there was this big, that was the pandemic, and this was a really nasty period in 2018, right before Christmas. But most of the time, you didn't really have a persistent oversold condition. Then we went into a bear market during 2022, and now you had a lot of oversold conditions, but then that ended, and so again, we just have had a few here and there. Right now, though, we are all the way down here at minus 733, as it notes on the right-hand side of the chart, and that's pretty oversold right there. It's pretty oversold, but again, oversold does not mean buy. So this indicator gave sell signals a week or so ago, and it had been giving sell signals. All those red areas up there are basically overbought, and when it stops being overbought, that's a sell signal. But we weren't getting much traction, as with many other indicators, until recently. Now the market is breaking, breadth is terrible. These oscillators are getting very oversold. But we're going to wait for this to stop being oversold before we actually jump in and use it as a buy signal. So now the one sort of interesting thing is that typically when S&P is making new all-time highs, breadth will follow along and be very strong, very overbought. That was not the case this past year, even though we went to new all-time highs, I believe, last June. And many times since then. I think last year S&P made a new all-time high in some like crazy 85 days or something. But breadth didn't really follow along, and so that's not an indicator by itself, but it's kind of a warning sign. Anyway, another thing we look at is cumulative breadth, where we look at that running total I told you about. So cumulative breadth has been doing pretty well. That made new all-time highs. Even if we did cumulative volume breadth, that did pretty well too. Now, of course, those are backing away from their all-time highs, just like SPX is. Sometimes the cumulative breadth can be used as a negative divergence, but in this particular case, there is no negative divergence. However, not every bear market has a negative divergence at the beginning. The 2022 bear market did, but many others have not. So just because we don't have a negative divergence doesn't mean that we can't go into a bear market now. New highs versus new lows is another thing we keep track of. We use the New York Stock Exchange data for our signals. And on the right-hand column, you can see the various signals that took place in the last year or so. Not that many of them. In fact, the one that we had right after Thanksgiving, we had a buy signal, and that was right here. We bought on November 26th. That was stopped out just this week when new highs, new lows exceeded new highs for 2 straight days. So that stopped out that buy signal. You really didn't do all that well. I mean, if you were buying options, you lost a lot of time decay in that period of time, and SPY just pretty much went sideways. The smaller cap stocks, which are more reflective, let's say, of making new highs, did a little better, Russell 2000, but again, not all that great. So meanwhile, the last 2 days, though, things have gotten even worse, and now we've got more than 100 new lows on each of the last 2 days. That's a new sell signal. So we have a brand new sell signal as of last night from this indicator. So let's talk about VIX. VIX is crazily important most of the time, and a lot of times not saying much of anything, but you still need to pay attention to it. So with VIX, there's a couple of things the chart alone can help us with. One is the trend of VIX. VIX should be trending opposite to the stock market. And number two is spike peaks or buy signals. So here's the current 1-year chart of VIX. We have a trading system we built around these spike peaks. The red letters were successful trades, buy signals. The blue letters were not. The system has a stop out. And you can see what's happened here recently. Once the market started to weaken and VIX started to go into an uptrend, really the uptrend in VIX started all the way last December. We had a few peaks along the way, actually 4 of them now. And the first 3 were just stopped out because it kept going to higher peaks. So the last one was just last week. We're actually not taking that as a signal because of the other negative aspects of VIX. And the main negative aspect is that VIX is in an uptrend. And I said, that's the other thing we pay attention to. So by our trading system, that pink S was a sell signal that occurred from this indicator about the second week in February. And it's still on that sell signal, and it's going to be on that sell signal until VIX falls back below its 200-day moving average, which isn't going to happen anytime soon because this is the 200-day moving average right there. This is the 20-day just above it there. So the trend of VIX is negative. That's a sell signal, and that sell signal is going to stay in place, as I said, for a while. We're not taking this spike peak buy signal that occurred on March 9th until we get some improvements in some of the other aspects of VIX, and I'm going to be talking about this in just a second. So as you can see, spike peaks have trouble, that system has trouble, while the trend is accelerating to the upside. So you can't trade VIX, but you can trade VIX futures and VIX options. And there's a couple of things we can discern from them. So first of all, let's take a look at the futures. So the VIX futures will, if we plot the price of each one out in time, most of the time the futures prices rise the farther you go out. And so we call that the term structure. The term structure slopes upwards. It's nice and positive, and everything is bullish. But occasionally this happens. And when the term structure starts to slope downwards, you need to take notice, because some of the nastiest markets in the last real 20 years, counting 2007, 2008, the futures started trading in 2004, so don't really have data before that. Some of the nastiest markets, including the pandemic, etc., even last April to a certain extent, this negative term structure existed. And when that happens, it's time to either sell some stocks, play some defense, or whatever. So here's where we stand right now is the last night's close. VIX closed at 27.19. And the front month futures, March futures, these are going to expire on next Wednesday. They close at 26.59. So 26.59 minus 27.19 is minus 60 cents. In other words, the futures are trading 60 cents lower than the price of VIX. Now we look at the next future out, which is April. It's trading at a lower price than March, and May is trading at a lower price than April, and June is trading at a lower price than May. Now these two are about the same. So what is that? That's a downward sloping term structure. That's what I said just in the last slide. That's dangerous. This is dangerous. You can see all the futures are trading at a discount also. There are sometimes ways to take advantage of that, but for now, just suffice it to say that if the futures are trading at discounts and the term structure is sloping downwards, that's bearish for stocks. So this indicator is definitely bearish on the stock market. Now, you can quote the price of the futures just by going to the CBOE futures website. They have delayed prices there. You can also look at the CBOE's 6 volatility indices. They quote these all day long. They publish these prices all day long. So the first one, the shortest term one, is VIX 1 day. That's usually more useful for 0-day to expiration traders. Then there's a 9-day VIX. Regular VIX is 30 days, and then there's a 3-month, a 6-month, and a 1 year. So we look at the price of these. You see downward, and then kind of flat after that. So again, sloping down in the front end, maybe not quite as negative as the futures term structure, but again, this term structure sloping downwards. I'm only calling this one modestly bearish because, well, you know, VIX is not above the VIX 3-month. It was almost all day yesterday, but by the close it was not. So again, though, modestly bearish. So the total picture of this term structure, we're talking about these volatility futures, is bearish. And the thing that we usually just look at to keep it simple without having to look at a whole term structure picture and everything is to look at the 2 front months. So right now, the front month is March, and I said that's going to expire shortly, but it's trading at 26.59, and April's at 24.92. You know, that's minus $1.67. So anytime it's more than -1, that's a big warning sign for stocks, and that's what we have right now. Not, you know, every time, it doesn't work every time, but this one has been kind of persistent. It's been this way now for a week. And last October, we did have it go to -2, and then it immediately rebounded, right, boom, came right back up. But that was a very short-term one. And again, I mean, most volatility traders were surprised that didn't have more ramifications, but it didn't. But this one is persisting right now. And as I said, March is going to expire on next Wednesday. So then we'll be looking at April versus May. I'm going to back up 2 charts here. But you can see April is trading higher than May, 24.92 versus 24.20. So again, you know, that's a negative for this term structure. So where's that leave us? So this is the totality of all the indicators I just talked about. So the only thing that's bullish right now is that VIX spike peak buy signal, which I said I'm kind of setting that aside for a minute on deference to the weight of everything else. But the chart of S&P is bearish. It's as bearish as it can get. So I get a slit all the way to the right-hand side there because not only is it downtrending, but it broke the support. New highs versus new lows, I just showed you, that gave a new sell signal last night. The trend of VIX is trending higher, and you know, it really can't be trending higher too much faster than it is right now, so that's negative. The breadth oscillators are on sell signals, but they are oversold, so I moved that off the right-hand side just a little to indicate that, you know, perhaps there's a ray of hope there. The equity-only put races, we looked at those earlier, those were on sell signals. And then we just now looked at the construct of volatility derivatives, that's those term structures, that's bearish. So those things are all bearish. We do have a couple of things that are not giving us a signal right now. One is the McMillan volatility band. It's the Bollinger Band sell signal, that's a signal that's not in existence. And we didn't really talk about realized volatility, but realized volatility is actually not that high. It will start to increase this week. But we look at the 20-day historical realized volatility, and it hasn't been that great because even though there's been some sell-offs on certain days, you recover, and the net day-to-day change has not been all that high. So, you know, overall, our conclusion is we're bearish, we're taking bearish positions. We have this new position we put on in S&P. We'll probably be putting on another couple in the next couple of days. You know, this rise in the equity-only put-call ratio that we saw started last February, and the rise in VIX really started last December. They were rising together for a long time when S&P was still holding sideways. It really couldn't seem to break support. But now support has been broken, so I think those are going to dominate for a while. But if I'm wrong and we do get buy signals, we will take those as well. And again, we roll our positions, as I showed earlier, when they get fairly deep in the money in terms of SPY 8 to 10 points, or in individual stocks 10 points, 6 to 10 points. So let me return now to that offer that I talked about earlier. If you go to the website optionstrategist.com/traders corner, there's an offer there to buy 1 month of each of our 3 top newsletters for a total value of $99. So $99, you get 1 month of each. You don't have to take them all at the same time. That could be a little bit overwhelming. You can take them concurrently, consecutively, I mean. But the 3 newsletters are a daily volume alerts, which comes out every day. I write that one myself. That has all these indicators in it that we're talking about, plus the occasional, option tipped takeover. They don't have too many of those, although we did have the Warner Brothers Discovery a couple of months ago. Used to be a lot more of that, and some people on TV would have you believe there still is a lot of it, but there isn't. The Fed, the enforcement guys sort of made it pretty clear they don't want these things being tipped in advance, so they're not, pretty much. Then there's the daily strategies, which comes out twice a day and has not only that stuff in it, but it also has a lot of just basic option strategies, including those MBB signals I talked about, as well as things like straddle buys and momentum trades, that sort of thing. And then the option strategist, that comes out once a week. That's a newsletter that's of some length, often has an article in it. And so this week we're putting out the article on volatility trading. Now, I'm going to talk about volatility trading here in just a minute, but this article will go into more depth. But the option strategist, there's a long track record on the website and in the newsletter itself. And there's a few strategies in there that you're probably not going to find anyplace else. One is trading the earnings moves. We've been pretty successful with that. Straddle buys, that's been a pretty good thing. We're pretty selective. I mean, it's not like every issue has 5 straddle buys in it. It's like the occasional issue has a straddle buy in it. But we've had some pretty good ones. And then HTB stands for hard to borrow. That strategy is not really prevalent right now, but it has been in the past. So the other 2 are similar. All of these have our market commentary, which is the culmination of all these indicators I've been talking about. And even though things have been going well in the past, there's no guarantee that's going to happen in the future. This is our website. I invite you to visit the website in general. Just look around a little bit. We have a put writing newsletter. I have a YouTube channel where we put out a Monday morning comment every Monday, and there's another newsletter dealing with special situations. All right, so I want to wrap up on the time we have and just talk a little bit about trading volatility. As I said, we'll be publishing an article Monday in the Option Strategist newsletter. So if you want to sign up for that, you'll be able to get that article. So if you want to be an aggressive buyer of volatility, what do you do? I mean, people are like, okay, I want to buy volatility. What's happening? What do I do? So one thing you can do is you can buy futures, or probably less risky options on futures. So the options on futures are the VIX options. They trade in the CBOE, and even though in theory they're a cash-based option, they're really the options on the futures. If you're going to buy those things, stay short-term. Don't go out more than a month. And in fact, I would say probably 2 weeks at most, and just keep rolling things over. Because if volatility explodes, it explodes in the front end. You see how the term structure went negative? That means that front end is rising much faster than the rest of them are. And so you want to be in the front end of that curve. Perhaps a better choice would just to buy an ETN or ETF, because those guys are trading the futures and you don't have to worry about which ones to buy. They're taking care of that. So the top 2 ETNs on the long side are VXX or UVIX, which is twice the speed of VIX. And you don't want to own those all the time. I'm going to show you a chart in a minute. But if the VIX futures have little or no premium or trading at a discount, as they are right now, then these things can be bought. Someday VIX will come back down too. So you could be an aggressive seller. That's not the case right now. But if you want to be an aggressive seller, you can buy SVXY, which is short VIX, or you buy puts on these other guys. So that's a subject, I guess, for another day. But here's UVIX. So the first thing you want to notice about this chart is that the UVIX, if you buy and hold it, is just a terrible, big, huge loser. And why? What's going on? Well, because they're buying the futures. The futures have a premium in them, like time decay, and it just keeps decaying and decaying and decaying. So that's just the future. Remember, I said most of the time the futures trade at a premium to VIX, and that's what's happening here. So you do not want to buy this thing and just hold it. However, if the futures go to a discount, and I'm really talking about the front month, maybe the front 2 months, if they go to a discount, then it's worth buying this thing and holding. So last year in April, when VIX went shooting up, this thing, let's say you probably wouldn't have really bought it, too early. You might have bought it, like, say, somewhere around where this line is right in here, and then it went up 100% from there. So the 100% is just the gain from basically 50 to 100. That took place last year. Right now, the thing is trading at about 9. Oh, well, actually 888. The year before, you may not even remember this, but in August of 2024, there was this huge spike in VIX. It only lasted a few days, but this thing went from basically, 60 something to 200 or whatever. So a gain of like 200%. And again, in a matter of days, and you can see it doesn't last long. So again, if you in one of these things and it takes off like this, start rolling your options up. So, you buy the 60 strike, it goes to 70, roll up to the 70 strike, it goes to 80, roll the 80 strike. Just keep doing that. We did that with silver this year, and it paid off handsomely, because in the end, the crash comes and you're left holding the last option, which is worthless. But if you've rolled up for credits all along the way, everything is good. So right now we are buying UVIX calls, slightly out of the money. If there are other strategies that can be used, and they'll be explained in this article that'll be published on Monday. One is futures calendar spreads. Those used to be great when the margin requirement was very low. They had a really high leverage. That's not true anymore. And then there's a thing called the VIX SPY hedge. If the VIX futures get at a really deep discount, let's say 3 points or more to VIX, this comes into play. We made a lot of money with this strategy during the pandemic, made a lot of money during the financial crisis, made a little money with it last year in April. So, but it's something that's on the table now, and can be if you want to pay attention to it. We don't actually have this position on yet. We're still waiting for that deep discount to occur. But anyways, if you take advantage of our offer and visit optionstrategist.com/traders corner, you'll get the scoop on all those sorts of things. This is our contact information. If you're interested in our money management, that's the email at the bottom there, or the website at the bottom there. I will say that our minimum account size for money management is $100,000. All right, Anthony, I'm going to turn it back to you. I think we're right on time.
Thank you so much, Larry. Really affordable offer there, I think. I put your offer in the chat box there, and
Okay, thanks.
yeah, I mean, the VIX is really one of the most hottest topics right now, so thank you so much for being here. Oh,
Right.
you had I didn't see any questions, but Raf San said you got an audience that follows you, and he said you're a phenomenal resource for options trading. Your book is amazing, and the daily newsletters are always on point. And the daily video before the market open is a solid guide for the day. I didn't know you were doing videos, so I bet that's really great too.
Okay, yeah, thanks.
All right. Thank you, Larry, for that excellent market outlook and valuable insights. We always appreciate you here. For those who'd like to learn more about Larry's research and analysis, we've posted a special discounted link in the chat box, so check that out and pick up the coupon code of 3NL99 as well. All right, now we will move on to our next presenter. Our next speaker is Barry Burns, founder of Top Dog Trading. Barry specializes in helping traders understand how to interpret markets using pure price action. His presentation today is titled, How to Trade Pure Price Action. Barry, are you there?
I am indeed here. Can you hear me?
We can hear you. We can see your screen too.
Oh, great. All right. Excellent. Well, looks like technology is on our side today, so
Yeah.
yay. All right, so if I understand correctly, I have 45 minutes. Is that right?
Yeah, that's correct. And
Okay.
thanks for being here today. We always appreciate you.
Oh, my pleasure. I always love being here. All right, well, got a great presentation for everybody today. I have my questions box open in GoToWebinar, so feel free. If any of you want to type in any questions as I go along or any comments, that would be fine. Make it a little bit interactive. In fact, I'm going to make this a bit interactive by design anyway. So as you can see today, the topic is how to trade pure price action. And of course, we have to have our, on these, especially on these multi-speaker events like this, it's very important to have the legal disclaimer before every single one of them because people come and go during the day. So I'm not going to read all of that since most of you probably already seen it or read it, but it is very, very important. I think sometimes people tend to minimize these disclaimers, and they really should not. I mean, I understand that the language is not the most exciting, but the content of what is said is so important, which is why we're legally required to share this information on our websites and so forth. So this information will keep you out of trouble. This is what will help prevent you from blowing up your trading account, and this is the reality of trading beyond a lot of the hype that's out there. So please do read those either on my website, Traders Corner, wherever, and be familiar with that. Well, there's my ugly mug. I'm Dr. Barry Burns, owner and founder of Top Dog Trading. I wrote the book Trend Trading for Dummies, part of the famous Dummy series of books published by Wiley & Sons. Received numerous Reader's Choice Awards from Stocks Commodities Magazine. Pretty much every year we get at least one. And then I've helped other authors write books as well, and I work with different software companies, exchanges, done seminars for all kinds of groups, and it's just a very small sample. I also have a YouTube channel. So if you want to check out my YouTube channel, feel free to do that. Obviously, all free videos, hundreds of videos on there now. That's actually an old screen capture. We're over, gosh, I think we're at about 150,000 subscribers now. So lots of free education there. Also, I've got my podcast, also for free. So Top Dog Trading, we provide a lot of free trading education because we want people to get up, get started, and do it all without any out of cost pocket, or you might even say out of any pocket cost. All right, and now I have just proven a very important fact that you don't really have to be very good at English to be able to trade. So, all right, well, it's a good thing I can laugh at myself because I give myself a lot of subject matter for that. All right, so what we're going to do today, as I said, is going to look at pure price action, and we're going to start out with a very basic, and then we're going to go to an intermediate level, and then by the time I'm done with my 45 minutes, we're going to get to a very, very advanced level. So something here for everybody. Now, the way that I approach reading price is to do it in a very logical manner. So you'll see there at the top of the slide, it says 1 bar price logic. So there's a logic to this price bar, right? And I don't use the nice, flowery, poetic Japanese candlestick terms. They're nice, nothing wrong with that. But for me, I just look at what does this logically mean. So what it means is within this bar, whatever time interval that might be, let's say it's a day, the real body is the green part. It's always the part that's colored in. We opened down here and we closed up here. And we know that because, well, that's how, because it's colored green, that means it closed above the open. And then it reached a high of this intraday up to this price and then came back down. So 1 bar price logic is that this is a very bullish bar. Now, 1 bar and homeopathic, or 1 bar and a $20 bill, I should say, will get you a homeopathic amount of caffeine at Starbucks. So not enough to trade with, but it's a foundation. It's one piece of evidence. And as you'll see, we're going to be putting together multiple pieces of evidence, building blocks. All right, so this is a building block. It's not something you trade by itself, but it is the building block of our trading methodology. So just the opposite, this would be a bearish bar. Now, a couple of things with this, of course, again, as I said, when it's red, then the close is below the open. So we know it opened here. The high was the same as the open, went down, reach a little lower prices, but by the time all was said and done during the trading day, all the news, the gossip, the rumors, etc., the market, meaning market participants, decided this price level is what they valued it at. That's what they considered, oh, that's the fair value today after everything has been said and done. Now, a couple of things here that are very, very important, and that is two distinctions. Number one, for these one price bar patterns, the range of the bar must be very wide. So we would not consider this a bearish bar if from the high to the low, it was just medium range or narrow range. It's not significant enough of a price action. And the other thing is we want the close to be, in this case, since it's a bearish bar, very close to the low of the bar. I'd say within 25% of it is ideal, no more than 30%. So same thing when we go back and we look at the bullish bar. Okay, it's got to have a wide range from high to low, and the close needs to be near the high of the bar. So those distinctions are very, very, very important. All right, now here's a third type of price bar, and it has a little different logic to it. So this one has a long wick or shadow on the top. See a long wick there, small real body, narrow range real body from high to low, from open to close technically. And then it tested all the way down here during this time period. And again, this could be a 5-minute bar. That would just mean that within this 5 minutes, that was the action, that was the market sentiment as it changed, because the markets are always dynamic, so it's always changing. Now, what does this mean? What's the logic of this bar? Logic of this bar was, well, we opened here and we tested all the way up here to this high. Again, it's got to be a wide range bar or it doesn't count. Right? And I'll show you a little bit more about that in a few minutes. So it's got to test all of these prices, reject all of them, meaning that it didn't close until it came all the way back down here toward the low. So these prices were rejected, these high prices were rejected, and therefore this is a bearish bar. The logic of the market action that is mapped by this bar is that this is a bearish bar. Now you notice that it's a green bar, and I did that on purpose. Don't get distracted by whether the candlestick is green or red. Sometimes it doesn't matter. And in this case, it doesn't matter because the open and the close are so close to each other. It's within the realm of noise, if you think of the signal noise ratio. Point is that it's a narrow range real body, and all these higher prices were rejected. That's what matters. Same thing on the other side for a bullish bar. Rejection of value bar. I just call these rejection of value bars. Rejection of value is not a candlestick pattern. It actually comes from market profile, but I've adapted it over to price bars. So the same thing here. Now you see that again, the candle is red, the real body is red, but it is a bullish bar because what's most significant here is that all these prices down here were rejected, and then the market closed up here. So after all was said and done, the market participants decided the value of this market, and you could do this with any market. This works with Forex, futures, crypto, currencies, whatever. Yeah, rejected all those prices. That's what matters. Now, that's one bar of logic, all right? Like I said, that's just a building block. So now we got to go on to 2-bar price logic. So our first bar on the left, that is a bearish red bar, wide range, closes near the low. Second bar, bullish, wide range, closes near the high. So this 2-bar price logic is that, oh, we've had a change in sentiment. So the 2-bar pattern is bullish. This 2-bar pattern, almost exactly the same, except the inverse, and it is a bearish pattern. We started out with a bullish bar, like we said in the last one, $25 bill, and one of these candlesticks will get us a homeopathic amount of caffeine at Starbucks. So this is a good example of that. This can turn around within 1 bar, meaning 1 minute, within 2 minutes, within 1 day, whatever. So 2-bar price patterns are more significant and reliable than 1-bar patterns. So again, this is a bearish 2-bar pattern because this bar negates the bar before it. That's one way that I like to say this. This bar, the most current bar on the right edge of the screen, negates the bar before it. It invalidates it. It's saying, no, sentiment has changed between this time and this time. All right, now another two-bar price logic pattern is built on the foundation that we set before with these kind of rejection of value candles. So we've got a bit of a bullish bar here, and then the next bar, whoosh, all the way up here, tests all these higher prices. So market participants are saying, oh, we're bullish, we're bullish, we're bullish, but wait, no, nobody's taking the other side of my trades here. Nobody's willing to sell. Oh, these high prices, okay, oh. So now we get a bearish two-bar, bearish pattern. And then finally, two-bar price logic, same as the last one, inverse, bullish. And again, we started up bullish, or bearish, I'm sorry. But then, very next bar changes the sentiment. All these prices are tested, and it comes all the way back up here and closes way up here. All right, now, in passing, I mentioned real quickly the concept of a narrow range bar. So narrow range bars, such as this second one here on this illustration, they're just considered neutral bars. And the way that we interpret them or read them is we just say that the energy of the market that has been coming into it up until that neutral bar, it remains in the market. So in this case, we have a nice bullish bar, wide range. See again, notice wide range bar, narrow range bar. Because it's a narrow range bar, it's automatically neutral. I don't care if it's a spinning top, I don't care if it's a doji, as long as it's narrow from high to low, then it's a neutral bar because again, it's within the noise filter of the markets. Whereas this bar, wide range bar from high or from low to high, wide range from open to close. And then the next bar is just like, okay, just people are not really doing anything. They're just kind of waiting. They're pausing. They're waiting to see. All right, so now, as I said, we're going to make this a little bit interactive now that we laid the foundation, now that you've got the basic lesson. Let's interact a little bit. Because it's so easy for me to just sit here and tell you all this stuff, and you say, yeah, I get it. But now it's time for a quiz. Did you really get it? You don't know if you really understand something until you're actually quizzed on it. So let's get down on it, as Cool in the Gang used to say. All right, so we're going to look at just where these arrows are. And the question is this: for the bars marked, did they validate or invalidate the price action of the bar that precedes them? All right, so go ahead and type this in. This is to be really done in real time, publicly. That's right, you gotta, well, you don't have to, but I invite you to post your answers in the questions box. And so the question is, does this green bar invalidate the bearish action before it? Yes or no? Type your answer into the question and impress your friends, your family, your colleagues, your trading mentors. And don't be squeamish, don't be shy. Don't be shy, because in trading is all about making a commitment, right? We got to make a commitment, we got to take a trade. And so in this, you're practicing that as well, of saying, okay, I'm going to make a commitment, and right or wrong. Now, if you're wrong, I would invite you to open up the window and yell out to the neighbors, yippee. What do I usually say? A little slogan for this. Oh yeah, hip hip hooray, I learned something new today. That's it. Kind of silly. But the point is, if you get something wrong, that's a good thing. That's a great thing, because it means that you, well, learned something new. Otherwise, if you get it right, well, then that's good. Good for you, you got it right. Congratulations. But you didn't really learn anything yet, did you? So getting something wrong is actually a better use of your time, or a better growth experience, so that you grow and learn something new. And by the way, No shame. I never put shame on anybody. I made so many mistakes in my life. It's just ridiculous. All right, so I'm not going to put anybody on the spot. I'm not going to read the answers out loud. You can see them there. But the answer to this question is, does this validate or invalidate the price action of the bar that precedes it? And the answer is it doesn't do either. This green bar, where'd my arrow go? There it goes. This little green bar is a neutral bar. It's narrow range from low to high. And therefore, price action coming down into it, and then this bar being basically inside that bar, it doesn't validate it, it doesn't invalidate it. And so the bearish energy is sustained in our analysis. Now, you might say, yeah, but Barry, but the market went up after that. Yes, it did. And I specifically chose this chart just for that example to point out two things, two lessons there. Number one, I used a little bit of a psychological technique here to maybe fool some people, that when you see what happens afterwards, it gives you forward-looking bias because you are able to see what happened. And therefore, the mind tends to want to say, oh yeah, it invalidated the price before it because you can see the market went up. So you know that's the right answer. But on the hard right edge of the screen, we wouldn't be able to see that if we're really trading this in real time. And the truth is, it did not provide a reversal signal at all. And also, the other lesson here that's very important, nothing is going to be accurate 100% of the time. In trading, we're not trading certainties, we're trading probabilities. And probabilities, by definition, means that there will be times that whatever you're trading, it could be a great trading system and you make money with it most of the time, but not all the time. There's going to be instances in which you don't. By definition of us trading probabilities, it has to be that way. Otherwise, it would be a certainty. Okay, let's go to this one up here now. This is your next quiz. Go ahead and type into the question box. Does this red bar validate or invalidate the price action of the bar that precedes it? Go ahead and type that one in. This one, a little different. Okay, we covered this, so see if you were listening, if you got it, you comprehended it, you understood it, you took it into your brain cells. So yes, it invalidates it. That's correct, because now this red one is a wide range bar from high to low, and it's wide range from open to close, and it engulfs this green bar. So yes, you see how those little rules there, they're not little, actually, they're big rules. It's not just green, red, and it's not just, you know, is it a doji or other fancy schmancy poetic names? But no, what does it logically mean? Logically means that, oh, the selling overpowered the buying as mapped by the candlestick. Candlesticks don't make the market do anything, by the way. I had someone respond to or post a comment to one of my YouTube videos the other day saying, well, I don't think, and it was about technical analysis, and they said, well, I don't think, you know, that indicator made the market go down. I think that was because of the war in the Middle East. You know, I responded and said, well, of course, I never said the indicators made the market move. They don't. And price bars don't make it move either. Candlestick bars don't make it move. This is just mapping what the money flow is, the market bid and ask, the group, the masses, and the algos, and the big money, and a little bit of the small money, all of it put together. When it responds to whatever catalyst there might be out there, what does that look like? And it creates a visual map for us to follow. And in trading, we are not leading, we are following. In fact, trend trading used to be called trend following, which I still think is a better term because it's more accurate and it keeps in our mind what we're doing. And we're just waiting, we're going to get in line with the energy of the market. Once we find it, we jump in as early as we can find that new energy in the market, bullish or bearish. And then we wait until it shifts. And when it shifts, then we get out. And we can determine that by looking at price bars. Okay, so I'm going to go through these other couple real quick here because I want to make sure I get done on time. This one is a neutral bar. Okay, so therefore the bearish energy coming into it, we interpret that as, okay, we're still bearish. And sure enough, gets more bearish. This one is a bullish bar. So this does invalidate the bar before it. Okay, wide range, high to low, wide range, open to close, closes way up here in the top of the candle, kablambo. Okay, so now let's make the quizzes a little more challenging. As I said, I allowed you to use forward-looking bias in the last couple of quizzes, so let's do a quiz where you can't use forward-looking bias, where we're gonna do the quiz just like we would if we were trading right on the hard edge of the screen. So this bar right here, that last bar printed, see the little arrow there, based on price bar formation, your quiz is, type into the question box, what would you expect to happen next? All right, so right from there, okay, what do you expect would happen next? Go up, go sideways, or continue going down? Type in your question, and we'll see who, and oh, by the way, if you want, you get bonus points if you type in why you think it's going to go up, or why you think it's going to go down, or why you think it's going to go sideways. Because if you can say why, that means you didn't just get lucky and get a 50-50 guess up or down. But you actually have again, the market logic. You understand the market logic. And that means you can repeat it, right? That's the point. You didn't get lucky in one quiz, it means you can repeat it over and over and over in the future on trades. Okay, got several answers coming in. Thank you, by the way, very much for all of those of you who are participating. So, okay. So what happened? Well, let's just go to the next slide. And kablambo, there you see. So that's where the error was, and then that's what happened. So for those of you who answered up, congratulations, you were right. For those of you who answered sideways to down, congratulations, you're learning something new. So what happened here, of course, we had a gap, and then the price went down, made another lower low. So bearishness continued. We came up a bit. Then this is the operative bar right here with the arrow. Wide range bar from high to low. Long wick on the bottom, testing all these lower prices. And then by the time the bar closed, see, this is a 5-minute bar, the market participants said, no, we don't think it's worth that. No, it's worth more than 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 that. It's worth this. And so it went down, and by the way, also touched support here, this previous low, because the market did get to that low earlier in the day, and then it went back to test that low again, and then it said, oh no, our sentiment has shifted now between that time, and now we're bullish. And up she goes, and she closes the gap as well. Okay, yeah, a couple more here. What do you think will happen the next day and why? Type that in here. And we're going to do some of these pretty quickly here, and then we're going to go, this is the intermediate level, by the way, and then we're going to go to the advanced level here in just about 4 minutes. So from this point, what do you think is going to happen in the future? Type that in. Very good. Thank you, Bradley. Nice. Really appreciate you guys who are participating, by the way. Extra special thank you to you. With that, I'm going to give you everybody who's actually typing in answers. I really appreciate your participation, and I understand that, you know, that can take some courage to do that publicly. So I'm going to give you 1,000 top dog trading admiration points. How's that? And well, that means you get the admiration of everybody in this webinar. You certainly have my admiration. Okay, well, we got good answers here, so I don't even have to spend more time on this because you guys already seem to get it now. So you're right. Engulfing wide range, easy for me to say, wide range red bar from high to low, wide range from open to close. Close is very close to the low, right? Again, tested this high. You'll often see that the best opportunities for when energy does change from bullish to bearish or bearish to bullish is often going to be on the second attempt. And sometimes it'll be a higher high, sometimes it'll be a lower high, sometimes it'll be an equal high. But quite often it will take the market an extra swing high to change, just like it did on the last one, right? Let's go back there real quick. Just like here, it went down and then it tested that low again and then went up. Very, very common. So watch for that and don't give up if the first time didn't work real well. All right. Oh yeah, now we're getting into intermediate advanced stuff here. What do you think will happen next and why? Actually, I won't do this one as a quiz. I'll just answer it. So now we're introducing here one more element, and that element is support resistance. So sure, we got a big green bar, no question about that. But when we scale out, okay, that's the big green bar that we had on the hard right edge of the screen. And yes, the market did go up after that. But what I'm introducing now, another aspect of bar price logic is support resistance. So we had a resistance from this high. And I didn't put it on the chart, but and that's what made it more of an intermediate quiz, but we didn't do the quiz because I just wanted to show this to you so I can spend a little more time on the advanced stuff. The point is, it closed. Not only do we have the wide range bar now, not only do we have the wide range real body, not only do they have the closing near the high of the bar, but it closed above resistance. It just sliced through resistance like butter and closed above it. So that is another element of reading price bar logic. Now you'll notice, and this happens to be a great example, I pulled just Primo examples here. Price went down, 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 and here we have a wide range red bar, pretty much the same range as this green bar over here. And it opened at the top and it closed near the low. But what's the difference? Well, it closed right at support. It closed right at support. It did not slice through support and close below it. So it didn't break it. So that means that, oh, the market participants, again, people trading the market, they're aware of this low over here. And they're saying, well, back around 9:20 this morning, the market saw that as a low that it didn't want to go below. I thought it was this market, what is this one, the YM, the Dow. That the Dow futures is worth more than 10,610. So it went back up. Now, this will often happen at support resistance levels. People are looking at that and like, well, what did people do in the past? Everyone's kind of looking at each other and saying, what are you going to do? 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 It's a mass psychology game. And so when we come back to a level where the market participants said, no, we think it's worth more than these lower prices, then the market participants now, might be the same people, might be some new people, might be a combination of the two, they're going to say, oh, I have uncertainty that I'm going to be able to gain traction on a short down here because before it wouldn't have worked just a few hours earlier, just a couple hours earlier. So uncertainty. And so now this time, boom, certainty. Slices through it with butter, closes above it, and off we go. Okay, so now we'll get to the advanced part. We got about 12 minutes left. So we're going to use this with volume now. Okay, so we've been talking about price logic. Now we're going to talk about volume logic. You should never trade price without volume along with it, because those two things are interwoven. You really cannot, or you should not separate them. So we're going to look at large volume versus small volume, enough volume, but not too much volume, not just large volume, but smart volume, meaning professional participation, and then compare that professional participation with retail value. All right, so now that's what we're going to do, but let me show how we do it, the how-to, because that's where most people get tripped up. So what we did is we brought up a time and sales window. That's what this is called. This one is from TradeStation, but NinjaTrader has it. I don't know, a lot of trading platforms have a time and sales window. So if you decide you want to add this tool or test it out, just talk to your trading platform provider and ask them if they provide a time and sales window function. Now we've got 4 columns here, as you can see. Time. So this is the actual timestamp of the trade. Type. Now I edit this. I just right-click and edit it. By default, it's going to plot the bid, the ask, and the trade. I don't want to see the bid and the ask. I only want to see the trades that go through. So I'm going to uncheck the bid and the ask because the trades are actually executed trades, meaning people committed their money. They're serious. Okay, the price at which they took the trade and the size. Now, each one of these rows is one trade. And this is one way that it's different than a level 2 or a level 3. It's not going to combine volume. And by the way, this is on the futures, so these are contracts over here. And oh, by the way, the other thing is too that I also went in and I edited the size so that, and again, all you do is you right click, boxes come up, and you can put in whatever minimum contract size you want for a trade. I don't want to see all the trades. Most of them are going to be 1 contract, 2 contract, 1 contract, 2 contract. Yeah, I don't want to see those. I want to see the professional volume. So most amateurs, they don't have enough money in their trading account to trade 20 contracts. So that's the key. I'm looking for the professional trades. All right. So I made a minimum of 20 contracts to filter out anybody who can't afford to trade 20 contracts, meaning, you know, the vast majority, well, the people are going to have large trading accounts and the vast majority are going to know what they're doing. Now, please understand this. Not everybody who has a big trading account is a good trader. Okay, that doesn't go 100% hand in hand. But most people who don't have large trading accounts are amateur traders. And most people who have big accounts are professionals, not 100%. Okay. Anyway, now look at this. Over here, we've got a chart that coordinates with the time and sales window on the right. Some trading platforms, again, you'll have to check with yours, they will allow you to chart what's called block trades. Block trades on your chart. So it shows up as volume. It's just like the regular volume histogram that's plotted down here, except it's not plotted under every price bar because, again, I've set this to only plot the volume line if there's 20 or more contracts traded there. And then you can see some are longer than others, so some might be like 20, 30, maybe 60. But that means that that bar, that's the bar. So now I can put together my candlesticks, my whole overall price pattern, my chart, and seeing the size of the individual trades. Interesting thing to note here. A common teaching is to say, wait for a trend and get it in the middle of a trend. But if you notice, and I've seen this over and over and over and over and over and over, the smart money doesn't do that. There's no smart money coming in the middle of this trend. Smart money always comes in early in the trend before it's even really obvious. And then they get out toward the end of the trend. And in between, it's all amateurs. Okay, so that little theory, that concept is no so bueno. All right, now let's talk about, take this to the next level. Oh yes, there's even another level beyond this. And what we're going to do now is we're going to bring up 2 time and sales windows. So this left one here, as you can see, I changed the filter of the size to only be a maximum of 2 contracts, no more. And then the one on the right, I changed to, let's see here, it looks like I changed this one to 10. 10 or more contracts, no less than 10. So Set one to only show the trades of the small size, the retail traders. That's what this is doing. It's putting up side by side. What are the retail traders trading? And what are the professional traders trading? And notice, by the way, if you look at price, 1205.75, 1205.75, almost all down the line. Here, there's a couple of 1205.50s. So the amateurs and the professionals, they're trading the same price. They're on different sides of the trade. So, well, you tell me. Again, you guys participating means that you'll get this into your cells more and remember this afterwards. Just the little bit that I've shown you, right? The very little bit that I've introduced to you so far. Just looking at these two time and sales windows. Would you rather be long right now or would you rather be short right now? Type that in and win a 1,000 top dog trading admiration points. Yeah, good. Good. See, even it's pretty self-evident, isn't it? It's not rocket surgery, as Paris Hilton would say. It's and again, it's just logical. It's just data. It's raw data. This is not theory. This is not ancient Babylonian numerology. This has got nothing to do with indicators or trend lines. These are not indicators, right? This is data. It's literal data, volume data, price data. They don't indicate anything. They are what they are. That's what indicators do. Indicators point to something else. That's why we call them indicators. They indicate something. Data, raw data, price and volume, that's not an indicator. It doesn't point to anything else. It just is what it is in and of itself. And now, of course, to trade, yes, we will add some interpretation to that. What do we make out of this data, right? How do we interpret this data? And people do this in all fields, medicine, engineering, science, all kinds of things. They'll be doing research and they'll gather data. And then they will have experts analyze that data. And so that's what we're doing. But sometimes it's just almost, well, I don't like to say easy. Nothing's easy with trading. But I will say it this way, this is a better way to say it. I have found it's very important to wait for very imbalanced pictures like this. All red on the retail side, almost all green on the professional side. And that's very important. Don't trade this technique when, oh, there's like 40 or let's say 60% red on the retail and 60% red on the professional side. No, that's not a strong enough difference. Remember, markets are dynamic. They can change anytime within 1 second even. But good, you see how intuitive this is, right? It's very, very intuitive. Now, some time and sales windows, TNS, that's time and sales. This one's the NinjaTrader one. NinjaTrader has a very sophisticated one. It has a little more, gives you more details than some of the others do. So I'll point this out for those of you with NinjaTrader or maybe a platform that also offers these extra features. We can add now more sophistication to it if we want to. So I can change the color if the for the buy being above the ask. So we've got 38, 18, 75, and then someone came in with 30 contracts and they said, oh, I'll buy it above the ask. And we can color code that. I color coded it lime. So what that means is it's a very aggressive buy order. They're willing to pay up an extra tick. And then the same thing for lows or for bearish. It's kind of hard to tell the coloring here. I should make it a more distinct difference, but red is for down and magenta, this is magenta here, is for when they sell below the bid. And then finally, we look at this and we say, oh, okay, well now we have what I was just talking about. It's not clearly all red. It's definitely not clearly all green. We got a mixture. Is there another filter we could add? that would help us even more when we get some of these kind of mixed or Christmas tree, I call them Christmas tree patterns, where it's red and green, red and green, red and green. And it's not just totally lopsided one way or the other. And the answer is yes. Here's the other tool. In this final column here, NinjaTrader has this extra feature where not only can you say, all right, let's see, what did I do here? Minimum of 20 contracts I did on this column. Now, this column, you can plot what they call block trades, and you can set that to a different amount. And I set it to 50 contracts. So if we look at the block trades, now the block trades are going to be the biggest ones, right? Because I'm plotting everything above 20. But then this column is going to tell me everything above 50 to get the even bigger traders. Well, look, every block trade, 50, 50, 50, 50, 100, they're all red. They are all red. So the really big money is all bearish here. And one last thing, I showed you this tool where you can have the block trades plotted down here. So if you like breakout trading and you're getting a lot of trouble with failed breakouts, this is a great tool to help you with that. If you'll notice, that block trade comes in as the market breaks this high, been stuck in this consolidation for a long time, finally breaks out. Question is this a real breakout that will continue or a fake? And when you see a big block trade come in, or multiple, that's actually multiple block trades coming in on the breakout, that's a good sign that that is a sustained breakout. So a little extra tool for you. All right, so what I have here for you today is, well, unfortunately, I didn't bring anything to sell you. So I kind of dropped the ball on that, and I hope you're not too mad at me for not offering anything to sell you today, but I do have something for free, and that is my rubber band trade strategy. This is a strategy that I've been trading for decades, actually. Works out any market, and I continue to trade it to this day. In fact, I scan for it every single day because it's that good. But I'm going to give it to you for free, and the reason is because I want you to start making money before you invest any money with me, if you ever choose to make or invest money with me, which you certainly don't have to. But the way that Top Dog Trading works is we feel we want to prove ourselves to you first, and the best way to prove that is not with my track record, not with testimonials, it's with you making money with my system before you pay anything. So this rubber band trade strategy is a moneymaker, and there's 5 videos that teach you how to use it. Some interactive quizzes, just like today, I gave you some quizzes. Oh, you also get my cycle indicator with it. And so you're going to get that all for free, all of this stuff for free. Start making some money, use the cycle indicator. You'll get my email address, by the way, also. And well, actually, it's right there, barry@topdogtrading.com. So as you're going through it, if you have any questions, need any help, you want me to review some of your rubber band trades, send them on over to me. I'll be happy to review them. And you just go on over to www.topdogtrading.com/free. And that's where you get it all. Oh, and I see Donna asked, why do we care retail versus pro? 2 reasons. Great question, by the way. The professional traders, they're professionals. Well, the fact that they're professionals mean they make money trading. And so therefore they're successful. And we want to follow the people who are being successful traders. Most retail traders, I mean, the vast majority of retail traders lose money. So we want to do the opposite of what they're doing, and we want to do exactly what the pros are doing. In addition to that, so that's level 1. In addition to that, when a lot of money comes in, like professional money, they trade with bigger size, that tends to push the market more, provide strength to the market follow through, the price action follow through that we talked about. Yeah, big volume tends to push it more. Where if just little retail volume comes in, doesn't tend to really push the market enough to make higher highs or lower lows. Okay. Yeah, thank you for asking that. That's a great question. I'll bet there's probably at least 20 other people here who were wondering that same thing. But they didn't have the courage that you have, Donna, so you helped some other people as well. All right, well, that's it. I'm done. So let me just turn it back over to our host, and I want to make sure that we stay on time.
Hey, thank you so much, Barry. Can I ask one question?
No.
And maybe some of the others are wondering as well.
Of course.
Do you have a certain indicator for block trades that you like to use?
Oh, it's built into most trading. Well, I don't know if I want to say most trading platforms, because I'm not familiar with most trading platforms, but a lot of them have it built in as a custom indicator.
Oh, okay.
Yeah, it's not something that I've added. It's not a custom indicator that I've made. It's been built into the platforms that I've been using as a native, I should say, as a native indicator.
Ah, okay. Thank you, Barry. Let me check questions one more time before you go. No, I think you're good. I thought I saw a question come up. All right. Well, thank you, Barry, for that excellent presentation and valuable insights into price action trading. For those who would like to learn more about Barry's approach, we've placed his free offer in the chat box, so check it out. And thank you so much for being here, Barry. We appreciate you.
Thank you. I appreciate the opportunity.
Thank you. Now let's move on to our final presentation of the day. Our final presenter today is David Wyse of Right Line Trading. David will be presenting high volume Heikin-Ashi signals that create explosive options opportunities. So everyone, please welcome David Wyse.
Hello, Anthony. Thank you very much.
Hey, you're welcome. Thanks for being
Appreciate
here
it.
on a Saturday.
Yeah, well, you too. You put in a long day
Yeah.
today. And really good information from everybody there. I think I know Dr. Barry, and I know Mr. McMillan for a good while. So excellent information. I appreciate it. Anyway, so we'll get started here. Again, my name is Dave Wyse, and I'm with the Right Line SPY Super System software package that we're going to be talking about. Piece of software that indicates when institutions are in trades and when they're not. And I run a live trading room every day from market open to market close. I'm in there every single day, all day long, which is kind of rare. And talking to all my traders, I have hundreds of traders in the room with me. I also have a text alert service. I've been doing this professionally for full time for about 17 years now. And so in case there was any question about whether you can actually make money trading professionally, the answer is yes, but it's not easy. Okay, we'll move ahead here. First thing I have to do, of course, is the disclaimer. All signals and trading opportunities we provide here are for educational and demonstration purposes only. Trading is very risky, so you should never trade with more money than you can afford to lose. And neither myself or Right Line Trading are licensed financial advisors, so we won't be giving financial advice. All right, we'll move ahead here. And if you have any questions, if you put them in the question box with your name and phone number. If I can't answer them, Rory from Right Line will give you a call back. But I'll watch the question box as well and see if I see anything that comes up during the presentation. I'll be happy to answer any questions that I can. You can also, if you don't want to put your name in there, you can put your Teams username. This should be changed to Teams. There's no Skype anymore. All right, and I'll present this at the end in case you have any questions or you want to get back to Rory. Okay, just kind of briefly, I'm going to go over a little bit of how we operate in the room, what we do. Again, it's an options trading service. We're not an investment service. We do options trading, and I do some stocks, but mostly options. And these are the strategies that we use inside the room. These are our swing strategies, the swing trades that we're going to hold at least overnight and sometimes up 2 or 3 weeks. We do straight calls and straight puts. Of course, that's the most common trades that most people understand with trading options. We also do straddles and strangles. This, if you don't understand it, is a really, really good strategy. It's non-directional. You don't care which way a trade stock moves. You just want it to move a lot. And we do quite a few of these straddles and strangles when the volatility is high and the market's really whipping up and down, as it has been lately. I do debit spreads, and on these debit spreads, I only do them for stocks that have weekly options expiration because that's what I use. I use the Friday expiration of the week that we take the trade. Do I do condors now? I think you might have asked me this before. I do not do condors. I don't do condors, iron condors. I don't like them. Usually you can't get enough premium to cover any kind of wild volatility. And very volatile markets are very hazardous for condors because you can get obviously you're putting on a covered call, well, not a covered call, but a call credit spread and then a put credit spread. And if you get whippy trades, whippy price action, it can wipe out the calls and the puts in just one day. So no, I don't do those. Okay, I also do time spreads over earnings. These are called calendar spreads. This is, again, a non-directional trade. All we do with this is catch the volatility crash when earnings comes out. When earnings come out, the premiums drop on the options because the market makers have jacked those things up just before earnings to cover themselves because they don't know which way the stock's going to move and they don't know how far it's going to move. So that's called volatility. It's called volatility crash. You also have a strategy that we use during neutral to bullish markets, which we're not in right now, called the weekly ATM strategy, where we actually sell puts on a bullish, neutral to bullish stock. We sell weekly puts while holding a longer term put out in time at a lower strike price, maybe 3-4 months out to protect that position. And we do obviously credit spreads to capture premium over a few weeks. Okay. Can I explain about selling calls? I'll make one comment about this before I get into this number. Selling calls, naked calls, uncovered calls, not calls in a spread. Selling calls, okay, if you sell a call above the stock's price, expecting to bring in premium, that is the most hazardous and most risky trade that you can take. Trade has an unlimited risk to it, and you should never be doing them. Naked calls should never be sold without having them inside of a spread. All right, and I won't go into that a long time because it's not the same as buying puts. Absolutely not. All the strategies we do in my room are what's called defined risk. You can't lose any more than what you put into the trade. If you sell a call on a stock, a naked call, let's say you get Microsoft trading at 100, and you sell a $110 call expecting it not to get that high, and you're going to collect the premium. If you wake up the next day and Microsoft's been sold, and it's been sold to a company that just paid $300 a share for it, you're on the hook from $110 to $300. That's how much you load. It'll blow up your account. All right, that's more people blow up their accounts doing that. So please don't do that. Okay, now in this room we also have a lot of two specific intraday strategies. These are swings. These are for stocks and trades that we're going to take overnight or out a couple of weeks. This is for intraday trades off of a 5-minute chart, and we only take these very quickly. These are quick trades. I can't post them and I can't alert on them. These I take and I call them out in the room when I see them, but I have strategies, videos on these two particular strategies. We call the SPY super system. These are for very high probability trades. You can use it to catch SPY, Qs, IWM, or you can use it for futures or even stocks. But it's trading off a 5-minute chart, and they're very, very quick trades with them for the most part. They're very profitable if you follow the criteria. And I have a strategy that's a video on that. The second one is this called UMCAT. This is we'll go into this a bit. This is another 5-minute intraday trade, out of the money catalyst. These are out of money catalyst trades for high momentum, high volume trades, and I'll show you the results I have with this. Now the results I have is for the SPY super system and for the UMCAT are my own trades because I can't post them. But lots and lots of people in the room who are using this are doing better than I am because they can take more trades. But I will go into this. And there's a reason that I'm emphasizing these intraday trades, because a lot of people can't trade intraday because they're under what's called PDT, or pattern day trader rules, which means you typically have to have $25,000 in your account to trade stocks or options intraday. I mean, you can only take 3 intraday trades in a 5-day rolling period. That doesn't give you a lot of flexibility. The reason I'm focusing on this right now is because this PDT rule that the SEC has, which basically requires that you have $25,000 in your trading account, or you have a cash account. But cash accounts are a little more problematic in that you can't actually, when you close the trade out that day, you don't get the money that day. You have to wait a day or two to get it. But this PDT rule is going to drop from 25,000 down to about 2,000 to 2,500 this year. And they've already approved it. It has to go through the final sign-off procedures and all that stuff. But likely, sometime here in 2026, they're going to change that PDT rules. This in by itself is going to bring in millions and millions of new retail traders that are going to want to trade intraday. They can't do it now, right? They either say trade futures or they use a cash account, but typically they're just trying to trade swing trades. This shift is going to demand more fast, disciplined, momentum-based strategies So we're adding the MCAT strategy to prepare traders for a far more accessible, far more active market environment. Because remember, we as retail traders, we take our money from other retail traders. We're not taking our money from institutions. We're taking them from retail traders. We want to know what the institutions are doing because we're going to follow them, but we're not going to take money from them. We're going to take them from other retail traders who don't know as much as we do. They don't have this. They don't have the methods and strategies we have, and they don't have the information that we have. Okay, so that's why I focused on this a little bit. This is just this is a graphic of the alert service. We call it Compass. It's actually SPY Super System now. The system used to be the Compass system several years ago. It's been upgraded and changed to be considerably better, but I still call it the Compass Text Alert Service. This is what you get, the text alerts for any kind of overnight, because any kind of, they're mostly swing trades. We'll go out into your phone on SMS alert, and I'm on the alert service, so I know that it only takes somewhere between 5 and 10 seconds to receive the alert once I post it. Okay. Now, before I get into I'm going to show you the system, and I'm going to show you what it looks like, the SPY Super System. But I want to talk about one thing first, and I always focus on this when I start a webinar, and that is what moves the market. What actually moves a market? What creates a trend? What breaks a trend? This is important to know, because if you're in a choppy market, you really don't want to be trading. We've had a lot of that lately. Well, we as retail traders, we're these little marbles down here. And this up here is the institutions, made up of 4 different groups, and I'll talk about this. All right, but it's important to understand when the institutions are not in the market in force. I don't mean they're not in the market, but they're not in there with a consolidation or a number of them trading in the same way. In other words, you can have institutions buying Microsoft, institutions selling Microsoft, but if you've got a lot of institutions all buying it at the same time, this is what we want to know, right? That's what moves the market or moves that stock. So we as retail traders need to know that, because when we're trading, if the institutions aren't in a trade, we don't want to be in the trade. We don't want to be in with other retail traders, because what you get with just retail traders, for the most part, trading your stock, you're going to get chop, and you're going to get chaos, and you're going to get all those little ups and little downs, and you're going to get chopped to bits trying to trade in there. You basically don't want to be trading. So when we know the institutions aren't in there in force, we recommend staying out of the market, and that's what I say a lot of times during the day. If the institutions aren't in, when we don't have any trend, please don't trade. I call it an LPTE, low probability trading environment. I say it in the room a lot. That means don't trade, or if you do trade, take very small size and get out very quickly. Right now, the institutions are made up of investment banks, Goldman Sachs, Morgan Stanley, JP Morgan, everyone that everybody knows. But there's also other groups that make up institutions. There would be pension funds, massive pension funds, state workers, police, firemen, all those pension funds, all that money coming in either, they have that money to trade, right? And then you have hedge funds, hundreds and hundreds of hedge funds with more billions and billions of dollars. And lastly, you have mutual funds, Vanguard, T. Rowe Price. There's lots and lots of mutual funds. By the way, if you want to invest in a mutual fund, I would recommend either T. Rowe Price or Vanguard. They both have very, very low fees and no loads, what's called no loads. They're inexpensive to trade, and they pay off pretty well. I use Vanguard a lot, just for investment purposes. Now, so the institutions, by the way, are made up of trading desks. So they actually have humans that are pushing buttons, trading, but very few. Most of all the institutions come with trades that are done by algos, computerized programs that look for setups, they look for news, they trade off of all that. There's hundreds of different algos that trade different specific setups. And they program these to look for specific things. Some of the things they look for are strategies that retail traders use, MACD crosses, etc., RSI conditions. They'll look at those kind of things and they'll write programs to bust them. They'll wait for the retail traders to think that they've got a break, and they'll come in and they'll flush them back out again. That's what the algos do. They also read news. So if you want an example of how you can identify that, when you see a jobs report come out like a Friday morning at 8:30, or an FOMC, the Fed changing their rates at exactly 2 o'clock on a Wednesday, if you look at the volume that comes in at 2 o'clock and 1/1,000,000th of a second, you're going to see this big spike in volume. That's the algos. There's no human that can possibly put a trade in that fast. That's the algos reading the FOMC or the jobs report and trading off of that. Okay, so that's what moves the market. That's why it's so important for us to know what the institutions are doing. Okay, Donna, don't the institutions and funds have to remain mostly invested? Now, you remember what we got here. These companies have billions, tens of billions of dollars, and they have investments in specific stocks, but they also have trading desks that specifically trade intraday trades, especially the investment banks do a lot of this intraday trading, a lot of it, and that cash is done at the end of the day, and they've got it to invest with, but they're trading. Believe me, they're making more money than what they're paying you on an interest on what they're making on their particular investments. Okay, a little bit off topic here, but I do want to cover this. This is a blackjack table, ace and jack of spades here, nice little blackjack, $100 chips. Again, nice winning hand here. What in the world has this got to do with trading? And the thing that I put this in here for is when I first started to trade, well before I became a full-time trader, and I told people I wanted to learn how to trade, I wanted to day trade, and I was told, friends, families, that it's gambling, you can't beat it, it's rigged, don't do it. Basically, they thought it was gambling. So the interesting part for me was, is trading stocks and options gambling? Well, let me put it this way. When I was much younger, a lot younger, when I was, in my early 20s, I was a blackjack card counter. I made my living playing blackjack as a card counter. And I lived in Las Vegas and traded and went in the casinos and basically played blackjack. That's what I did for a living, and it was a lot of fun. And I was young, didn't have a lot of responsibilities, and it was fun. But the thing is with card counting, and understand, card counting doesn't mean I'm counting each card. What I'm doing is I'm tracking the cards that are removed from the deck as the hands are dealt, and I'm tracking whether more little cards are removed from the deck, deuces through 7, or more big cards are removed from the deck, 10, jack, queen, kings, aces. The reason being, as the little cards come out of the deck, the deuce through 7s, if there's a higher percentage of big cards in the remaining deck than there would have been with an original deck, the advantage swings to the player. And it's important to know where you stand as far as that's concerned. So we had to track the cards. So that was what card counting was. And by doing that, I knew when I had an edge. I knew when my likelihood of winning a hand was much higher than it would be normally. And so that's how we bet. We raise our bets. We take more hands when it was in our favor. We bet one hand to minimum bet when it was against us. Okay, so that gave me a mathematical edge over casinos. I know when the cards are in my favor. Now, I look at this as because trading stocks and options is very similar in that without knowing what the institution is doing, you don't have an edge. You're in essence gambling. So trading, obviously, if you don't have a strategy, don't have an edge, you don't have a good methodology that you can follow, and you don't know what the institution is doing, you are gambling. Any kind of trade you take is a gamble if you don't have an edge, right? Now, it's also, this is important, and I put this in here because it's really, really important. No matter whether you're playing blackjack, counting cards, or whether you're trading, both of these require discipline and emotional control. What I mean is if you start trading and you let your emotions start to dictate your trades, you're gonna blow your account up. You're just not gonna be profitable because both of these require discipline and emotional control. Discipline means following the strategies. Don't be straying away from the strategy because you're impatient, because you're greedy, because you're fearful, because you're angry. I mean, all of these emotions will destroy your trade. So you have to have discipline to stay with your strategy, and you also have to have the emotional control not to react to those emotions when you're in a trade. It's a killer to most traders. Now, I consider the SPY super system that I'm going to show you here in a minute my card counting system. It gives me an edge over the other traders, allowing us the ability to become consistently profitable. And the SPY super system, in conjunction with identifying the best high probability trades, can lead to consistent profits. You can always find several stocks that the institutions are in, but the key here is also, once you know that, to find the best one to trade, the one that's going to give you the biggest edge. Right, so that's what this is. That's what I do in the room. That's what I do on the alerts. All right. Now, Usually I don't do this early, but I'm going to show right now. This is the SPY super system. This is the actual structure and the actual chart that I run on Thinkorswim. Now, important to understand, you don't have to trade on Thinkorswim. I do not trade on Thinkorswim. But the information that the SPY super system generates is loaded onto the Thinkorswim platform. So this is my Thinkorswim platform right here, and I'm going to show you some live ones today. We're going to go into the actual trading platform and show it. But this, I just want you to see what it's made up of. This is what you need to become consistently profitable if you're able to use these indicators the way that they're explained. Right? You have 4 different things here. This is the actual oscillator that we're using to determine momentum. Right? This is called a Laguerre. Now, this Laguerre is different than your standard Laguerre. This has the divergence stripped out. Most oscillators look for they look for momentum and they look for divergence. We strip the divergence out. This just shows momentum. You don't really need to have this because it's being reflected up here. But right here is your current time frame momentum. This tells you what are the institutions doing right now based on momentum on this particular case, a 5-minute basis, or if this was a daily chart, this would be a daily basis. Current time frame momentum, multi-time frame momentum, and long-term trend. All right, those are the 3 key things here. Now the colors on this are reflected as green is bullish, and blue is bullish, yellow is bearish, and red is bearish. Those are the color combinations that we use. That's all you need to know to determine whether they're in there or not. And so these are the indicators that tells us. Now this is a 5-minute chart, and so this I would be doing for an intraday trade. And in this particular case, I'm looking at the SPY. This shows you what the SPY is doing right now, momentum-wise. It's been fairly bullish right through here. You can see a little bearish, and then it went bullish, and I'm following it. This is a multi-time frame. This is what I would use if I was using a daily chart for a swing trade. As the same thing with a long-term trend. Now up here in the body of the actual price action, this is where the rubber meets the road. This is when you're trading intraday. What you're going to look for is this is called the VWAP, the volume weighted average price. This should be on all of your 5-minute charts. You don't need it on your daily chart, but this is what you want to use on your 5-minute chart, or your 3-minute chart, or your 1-hour chart. The VWAP is important, volume weighted average price. All the institutions use this as a support and resistance level. So one of the key levels we use to enter trades. The other two that we have on here is right here is this green line. This is called the 15 EMA, the 15 exponential moving average. And then we have the white line, which is the 8 exponential moving average. And I use these in combination. These are both support resistance levels. In other words, you can enter a trade, long or short, if it breaks below the VWAP, the 8 or the 15. You can use all 3 of those as your support resistance levels to do that. And it's interesting to know, by the way, that when the 8 is trading above the green line, when the white line is above the 815 exponential, that's a bullish trend. And when the 8 is below the 15, it's a bearish trend. So basically, it shows you what the existing trend is on whatever time frame you're on in your chart, right? And we have another thing here called market internals. This stays up here on the 5-minute chart all day. This is not telling me what the SPY is doing. This is what's telling me what all 6,000 stocks in the New York Stock Exchange are doing. It takes all the volume of stocks moving up, subtracts all the volume of stocks moving down, and makes a determination if the market internals overall are bullish or bearish. Gives you a fairly over a 20,000 foot view of the actual trend in the market. All right. Now, a couple things you're going to notice here about the candlesticks. And I'm going to cover this fairly heavily when we get into the actual chart trades, but anything that has a yellow candlestick is basically a red candlestick, but it's got high volume. This tells you that the institutions are in here with some force. White candles are bullish, high volume candles, and this tells you that the institutions are in there with some force. All right, and so these are excellent places to get into trades. And they're going to relate. I'm going to be relating to these. I'm going to be talking about these a lot when I talk about the UMCAT trades, because this is what tells us whether we want to take an UMCAT trade or not. Okay, so that is the actual that's the actual SPY super system right there on a 5-minute basis. You can buy this software. This is what you can get it, and you get loaded onto Thinkorswim for you. You also can get the SPY super system for Ninja. It's called the I think it's called the I can't remember, but it does come for Ninja as well as Thinkorswim. I use it on Thinkorswim myself. All right. Now, I'm going to just, before I move on, I'm going to show a couple of UMCAT trades just so you can see. This is a new strategy that we just developed since November. And I want to show you these particular trades. This is a couple that I've run recently. This was done on 220. This was an Oracle. This is a 5-minute chart. Now, I want to kind of show you how these UMCAT trades work. Then we're going to go into detail later. But this is just for people who want to do intraday trades. But I want to show you how effective this is. What you're looking for with an UMCAT trade is something that's got momentum and volume. So this has got right here. This was Oracle. You see this yellow candle right here, and you see how the 8 exponential is down here below the 15, and you see this little arrow here. That's called a pop out of the box arrow. The SPY super system produces these pop out of the box arrows when the stock is breaking compression to the downside with a blue, to the upside with a red. But this right here was a breakdown. Now notice that the institutions, this is a 5-minute chart. You notice the institutions are selling heavily here. There's been a lot of selling all the way through here. Stock is compressing, but the institutions are selling the stock. I can see that they're selling. Now its price isn't reflecting it yet, but here I get the volume. Now this tells me the institutions are coming in with force to the downside. So this is where I take the trade. As it breaks below the 8, that would become my stop, right? So I take it right here. And you notice I got more high volume candles, yellow, then I get a regular candle, then a green candle, then another yellow candle. This is telling me I've got high volume to the downside, but the momentum is starting to fade here, right? Because I get a green candle, then the candle's small. So this is where I took the trade off right here, right? And that's 5, 10, 15, what, about 20, 30 minutes, about 30 minutes. I get in for $72 a contract, and I get out for $125 a contract in this amount of time. 6 candles, 35 minutes, right? 74% profit. If you took 10 contracts, it would have cost you $720. Yeah, you would have get out for a profit of $530. 74% profit, pretty big. But this is, I just want you to see this. We're going to look at this a little bit later, but that is that's the setup that you want for an UMCAT trade. Out of the money catalyst. The reason these are so effective is, and I want to be very clear here, we use out of the money puts and calls when we take this strategy, but you only should be taking out of the money puts and calls if the strategy is specifically set up to do it. You should never take out of the money puts and calls on swing trades or any kind of trade that doesn't have a lot of momentum and volume together, right? So that's why we call this UMCAT trade. So this one was a good one, was good for 74%. This was another one the same day on frog, a frog to the downside, right? So we look here and we see what the institutions are doing. We can see they're selling, they're buying, they're starting to sell. But right here, when they went from buying to selling, blue is bullish, yellow is bearish. Take it right here as it breaks down with a high volume candlestick, right? So we take it right here to the downside. You can see what we did here. This thing was moving down pretty quickly. So it was trading at about 42, and I took a 39 put, right? 39 put, pretty far out of the money. That's where the out of the money catalyst comes from. But I did it because the stock was breaking down with high volume, and I had stacked high volume candles all the way down here, one right after another, after another, and after another. Now I got out right here as the stock started to flatten out, and I left a little money on the table. You can see that. But this UMCAT trade, this on frog, I get in for this for 30 cents because I was so far out of the money. I only paid $30 a contract for this, and I got out for $200 a contract about what 40 minutes later. Yeah, about 40 minutes later. So if you had bought 10 contracts, it would have cost you $300. You would have made $1,700 on this. And most of the time when I do these, I'm just taking relatively small size, 500 to 1,000 or something. But my stats are based on $500 per trade. But again, for $300, you would have made $700 profit. Now this is not common. You don't get all these that often. But you do get a lot of 30, 35, 50, 60, 70% winners, a lot off of this particular one, all right? Oh yeah, question here. I'm not able to follow the market closely, I understand. Is it possible to pay for only the trades if the question makes sense? Yeah, you can, if you take the alert service, you're going to be getting the swing trades. Right, it's very difficult if you're not following the market. Now, if you can follow the market for an hour at a time, and you just can't follow it all day, then you can be in the room for I have a lot of people come in the room for a couple hours in the morning, a couple hours in the afternoon. They're not in there all day long, and they'll get a lot of these intraday trades. But if you can't be in there at all, then you can take the alert service, and you're going to get just swing trades. You're not going to get any of these intraday trades, obviously, because you have to be in the room to get the intraday trades. They're very, very quick. I mean, I can't alert on a trade that's going to last for 15 and 20 minutes, obviously. All right, so that was the trade I took in fraud. Really big trade, but so this shows you how that works. All right, so I just wanted to show you the platform and how some of these intraday trades work. I'm going to move along here now. We're going to cover some other things. I'm going to talk about Heikin-Ashi candles because I know we've had a lot of interest in that, and I'm going to talk about the rules we use to trade in the room, etc., and all the criteria that we use for finding high probability trades. Okay, rules to trade by. This is trade the best and skip the rest. This sounds really easy. It's not really easy. We trade the best and skip the rest. We're just going to take trades where the institutions are in them. Not taking any trades if the institutions aren't driving it. All right, and then skip the rest. And this is kind of underestimated by a lot of people. If you skip a trade because it doesn't line up on your SPY super system, because the institute doesn't show the institutions in there, you're making just as much money if you skip a losing trade as if you took a trade that made money for you. So remember, that's very important. All right, and our objective is, and I say this in the room most every day, our objective is not to make trades. Our objective is to make money. This is meant to keep traders from overtrading. Retail traders, overtrading is one of the biggest mistakes that retail traders make. They feel like they're a trader, they're sitting in front of their computer, they need to be in a trade all the time. You don't. No trade is a good trade, especially if the market's crappy. And I talk about this all day long. One of the things I talk about in the room, and I'm on air all day long talking about this, is I'm identifying what the market's doing right now. What's the SPY and the Qs doing right now in the market? Do we have any kind of a pattern or a trend that we can follow? If there's not, it's low probability trading environment, LPTE. If it is, we get trends, then we can follow those trends. And it's important that everybody knows that. And I try to, they probably get sick of me hearing it broadcasting that, but if you're going to take a trade and you don't have the market in your favor, you're reducing your probability of success. Okay, we maintain discipline and learn and follow the process. That means learn the methodology and the strategies that we use, and follow through on them. I mean, that's what discipline is. And remain patient. Probably one of the hardest things for retail traders to do is to remain patient. But patience is very important. Please don't be watching your P&L and trying to make a decision on whether you should stay in a trade or not based on your P&L. You look at your technicals. That's what the process is. That's what the criteria is that we specify. And remain patient. I mean, all the days I'll go by and I may take one or two trades, or some days no trades, because the market isn't conducive for it. Why would I want to put money at risk if I don't have an edge? Okay, and now we do need an edge. For profitable traders, we need an edge, right? Our edges, we have the SPY super system software. Like, this is a big, huge edge, because this tells us whether institutions are in the trade or not. And we can also see how much volume they're in there with. We also trade relative strength and relative weakness. Now, please don't confuse that with the RSI indicator that you can put in your chart, relative strength indicators. Okay, in my opinion, those things are worthless, just like MACDs are worthless. We look at the stock and we see what's our stock doing and compared to what the market's doing. What's the SPY doing right now? SPY's moving sideways and down. We've got a stock that's stacking green candles. We've got relative strength. That's relative strength and relative weakness. It adds to your edge, because that stock, if the market reverses on you, it's not going to get hit as hard as the rest of the market because it had relative strength, or it had relative weakness if you're doing it to the short side. Right? We trade with the market trend if there is one. And again, I focus on this all day long. You know, what kind of market are we in? And then buy near support and sell near resistance. Now, I pointed out the VWAP, I pointed out the 15 EMA and the 8 exponential moving averages, all right? Those are all support and resistance levels. The institutions use those. They also use, on the daily chart, they also use the 50-day moving average, the 100-day moving average, and the 200-day simple moving averages. On your daily chart, those 3 moving averages should be on your chart. Those are support resistance levels. As the stock gets up close to one of those support resistance levels, you got to be aware that you're getting close to resistance. If the stock's moving up, you probably don't want to hang around in the trade anymore. Okay, that's sub bias near support, sell near resistance. Very important. Those 4 things right there, if you can follow those, you're going to have an edge over about 98% of the retail traders in the world. Okay, now the compass system that's now called the SPY super system, this all it does is basically is go in and look at huge amounts of data, crunch those numbers, and find out what the institutions are doing, and then display it in color as they show you. And I think this visual element, these colored uses, are it makes it much easier for new traders who don't understand technical analysis. They haven't got to that level yet. It's going to let them know whether institutions are in the trade, and I think you saw some of those. All right, let me just get a sip of water here. Okay, so how do we get an edge over retail traders? I think we probably already know that. We take trades that are being driven by the institutions. We trade stocks that have relative strength or relative weakness versus the SPYs or the Qs. We trade in the direction of the overall market. It sounds easy, but it takes a little practice. How does this give us an edge? Well, our stocks are going to be supported by institutional buying and selling. If you come into a trade when the SPY super system is telling you that the institutions are in that trade now, right? It's, for example, long, you get a green or a blue color, or let's say it's green, and you see a stock that's popping out of compression right above the VWAP, and you've also got a white high volume candle. The edge is massive on something like that. The institutions are coming in, but it's telling you they're coming in with force, and that's a big deal, right? And the stock's going to be outperforming the SPY, and they're going to be moving in the direction of the overall market. There's your huge edge over other retail traders right there. All right, SPY super system. This is just the little logo for that. SPY super system itself is the software, but it's also a strategy that we use for trading the SPYs, the Qs, and the IWM. Or you can do it on futures, right? But looking at these indicators on the chart, it's called the SPY super system. We also have one if you're trading off of these indicators on the 5-minute chart. For like I do Tesla a lot, I do Microsoft a lot. That's called institutional momentum stock system. It's the same thing, right? But the difference is you on these you're just trading specific options on the SPY, the Qs, the IWM. On the institutional momentum stock system, where you're trading options on individual stocks, one of the criteria that you can use for that doesn't exist in the SPY super system for the SPY and the Qs is you can look at relative strength and relative weakness. How does that stock stack up against how the market's trading? So that's why I have a different code here for it, but it's exactly the same strategy. Okay, now again, the SPY super system is used to trade SPYs, Qs, IWM, and you can use it for futures, right? The institutional momentum stock system, which a lot of people still call it the SPY super system, it's used to trade individual stocks like Tesla, APP, stocks that have high volatility, similar to the SPY super system, but also uses relative strength and relative weakness as one of the criteria. All right, that's the difference. Okay, so the color codes, we've kind of covered this already. There's just 4 colors here for the SPY super system: green, strong bullish; blue, bullish trend; red, bearish strong; yellow, bearish trend. That's all you need to know as far as that's concerned, right? And again, I've showed you this already. Here is the same chart again. Same thing as right here. Everything's here that you've got. You've got your indicators. You've got these moving averages, the VWAP, the 8 and the 15, and you get your market internals, and you get your high volume candles. That is what you need to be consistently profitable as a trader. This is all you need. There's millions of other things out there that people use all the time, but this is what you need to do it, right? I mean, with this, I can trade off of this without any other indicators because I don't use hardly any others, right? I'll use Heikin-Ashi candles and things like that, but I don't care about RSI. I don't care about MACD. I don't care about Fibonacci's. I don't use Fibonacci's. There's a million of these things that people use, but these are the ones that I have found that give me consistent profitability, 85 to 90% win rate, generally speaking, every single month is what I get by using these indicators, right? And we just take strategies that are built around these indicators, like the SPY super system strategy and the UMCAT strategy, and those become our bread and butter to make money. Obviously, it works just as well on swing trades. You just switch to a daily chart. I'm going to show you some of those. All right, now I'm going to talk now about Heikin-Ashi because there were quite a few people that were interested in Heikin-Ashi. So we're going to talk about some Heikin-Ashi candles here. We'll talk about what they look like, how you use them. We'll look at some live trades that have Heikin-Ashi from Friday, and answer any questions you might have relative to Heikin-Ashi. Okay, Heikin-Ashi candles, here they are. All right, so this, don't pay any attention, it's British pound, Japanese yen, doesn't matter. This could be Tesla, it could be gold, it could be the SPY, it could be oil, it could be anything. All it is candlesticks. Everything is candlesticks. These are Heikin-Ashi candlesticks. What you know, take away from this, the most important thing is flat topped Heikin-Ashi candles are bearish. Flat tops are bearish. Flat bottoms are bullish, right? No, see, no lower shadow or what I call a tail. No tail, no wicks. These are Heikin-Ashi bearish candles. These are Heikin-Ashi bullish candles. This is how you identify them, right? Notice each candle starts halfway down the previous candle. Always does that. It takes two regular candles to make up a Heikin-Ashi candle, right? So it's basically, what it's doing is it's eliminating a lot of the noise that you see trading regular 5-minute candlesticks. Now, the most common way that you use these Heikin-Ashi candles, at least the most common way I use, is to find what's called Heikin-Ashi reversals. I'm looking for a trend. In this particular case, I'm looking to go long a stock that's coming down toward a support or resistance level. And I want to get into it when it confirms that it's hit that reversal off the support level. And the best way to find it is with a Heikin-Ashi candle. So I'm going to show you a couple things here. These are bearish Heikin-Ashi candles. This is a bullish Heikin-Ashi candle right here, flat bottom. Notice it's following a couple of dojis. But one thing to remember on this is kind of important. When you take a Heikin-Ashi reversal candle like that, if it's not big enough, not as long as the one that created the trend, you don't want to take it. You could have taken this and you would have made some money on it. But I wouldn't take this because it's too small. We've got a very, very strong trend coming down here. So I'm looking for a reversal that's going to have some oomph to it, basically. So I wait. I don't take it. And again, I might be kicking myself because I would have made a little bit of money. But notice I'm starting to get wicks and tails, and then I get a bearish Heikin-Ashi reversal here. Now, I'm not going to short this because I want to go long. So I wait to see what happens. And here's another bearish candle. Now I get a Heikin-Ashi, a non-Heikin-Ashi candle with wicks and tails. Here is my Heikin-Ashi reversal candle that I'm going to enter the trade on, right there. Right, flat bottom, big candle, a lot of power, a lot of push to this candle, bigger than these. That's my Heikin-Ashi reversal candle. This is where I enter the trade on this candlestick. And one little thing to remember about these candlesticks, as they're being created, for example, if this was a 5-minute candlestick, once about 2 minutes or 2.5 minutes of that 5 minutes has gone by, if there's a flat bottom, it's going to remain a flat bottom 99% of the time. So you don't have to wait for the candle to complete, which isn't the case on a regular candle. Generally, when you're trading a regular 5-minute candle or a regular daily candle, you've got to wait to the end of the day or the end of the 5 minutes before you enter the trade. You can take it once you're about halfway through the session. And if this was a daily candle, after about 1 o'clock, this flat bottom is going to be there at the end of the day. You can take the trade based off that. So here's where you would get in, right here. Another Heikin-Ashi bullish, Heikin-Ashi bullish, Heikin-Ashi bullish, right up. This is your trade right here. This is where you get out of the trade. Once it starts to flatten out with wicks and tails, and you get a red candlestick, you're out of the trade. There is your Heikin-Ashi reversal coming off of a downtrend, hitting support and bouncing up. That's how you do it, and that's what you look for, right? And these things are extremely effective. But you got to remember a couple of the rules I mentioned. All right, so again, here it is again. Now this is I've got the kind of same thing laid out here, but I'm using a couple of things here. So let's say this blue line right here is your VWAP, volume weighted average price on a 5-minute chart, and you're looking to get in to this stock because it's been bullish on the day. It's pulled back, and you're waiting for an opportunity for it to break above the VWAP. This is where you get a Heikin-Ashi reversal candle right here as it breaks above the VWAP. There's your entry into the trade right there. All right? You didn't enter it over here because you were too far below the VWAP. You didn't enter it here, they're too small, but there's the breakout, and there's where you take it. And then you get candle after candle. You get a little red one here, which is still above the VWAP, and then you ride this thing all the way up. And here's where you get out, right? You get a Heikin-Ashi bearish reversal candle, you exit the trade. There's your trade, right? That's what you're looking for. Now, distinctions, what's the Heikin-Ashi candles? We just talked about this, right? So bullish Heikin-Ashi candles have flat bottoms. Bearish Heikin-Ashi candles have flat tops. And you can put Heikin-Ashi candles on any of your platforms. You just switch from regular candlesticks to Heikin-Ashi. I'll show you how we do that on on the Thinkorswim platform. Bearish Heikin-Ashi candles have flat tops. Bullish Heikin-Ashi reversals are identified by flat top Heikin-Ashi candles, followed by flat bottom Heikin-Ashi candles. And there can be doji candles in between. They don't have to come one right after the other. And the vice versa, bearish Heikin-Ashi reversals are identified by flat bottom Heikin-Ashi candles, followed by flat top Heikin-Ashi candles. Okay? That fairly clear? What's the advantages? Well, smooths out the price action. It's not going to be as noisy. You're not going to get shaken out of as many trades if you're on Heikin-Ashi candles than if you were watching on regular 5-minute candles or 1-minute candles or 3-minute candles. Any time frame, it's going to be different. Makes identifying the trends much easier, obviously. Improves identifying confirmation of trends or trend reversals, and helps identify potential exits when the candle bodies shrink or reversal occurs. Now, one little tip I'll give you if you're using Heikin-Ashi candles, when you're in a trade and you get in, you're using Heikin-Ashi candles, and it's approaching an area where you think you want to take profits. Okay, I want to get out of this trade at the next, where it starts to lose momentum at this point, switch over to regular candles, because you're going to identify the top more quickly with regular candles than with Heikin-Ashi candles, because you're going to have to wait for 2 candles. So you want to get out quickly. You want to get in with confirmation. You want to get out right near the top. So that's why you switch to regular candles. At least that's what I do. All right. Now I'm going to show a couple of Heikin-Ashi charts just so you can see the difference here. This is an old chart of Uber, but this is my TC2000 platform. This is the platform I use for charting and also for doing some scans. But this is Uber back here on May 1st of 2023. Now pay attention to this date right here. Right, that's May 1st, 2023. Right, this is a regular Uber chart. These are regular candles. See the move down. This, by the way, is a 200-day moving average. This is a 100-day moving average, but it's bouncing right off the 200-day moving average. Gap up, gap up. Kind of difficult to trade these when they do that. So watch this May 1st candle right here. Right, a lot of people are going to be hesitant to take this on a gap like that because it seems like it's getting extended. Let's switch over to what this looks like. Exactly the same chart on a Heikin-Ashi candle. Right, here's May 1st. See the Heikin-Ashi bearish trend right here? See the Heikin-Ashi reversal candle right here on May 1st? Flat bottom, big volume, moving right up, much bigger than these candles. There's your entry. You get into this trade on May 1st off that Heikin-Ashi candle, and here you see you get another. So that's a pretty big run up here from about $30 to about $36 or so, maybe more on these candles. Now, if you go back over here, May 1st, this is where you would have entered. You would have bought it on this candle right here, because that would have given you the Heikin-Ashi candlestick. Somewhere on that day, this is where you would have get in. You would have captured this whole move up here, right? Now notice something on the Heikin-Ashi candle. See what you got here? Gap, gap, no gaps. There's no gaps on the Heikin-Ashi candles. The gaps are filled because you're using 2 candles to create the candle. So you don't see the gap. On the Heikin-Ashi candle, you would see this. You would take it somewhere during that day, and this is what you would have got. Somewhere in here, you would have taken it, and this is the move you would have got. Okay, so that's what Heikin-Ashi candles look like. Now, I do want to look at some live charts with some Heikin-Ashi candles. So I'm going to bring up the SPY Super System, the live SPY Super System that I actually use. Here it is right here. All right, this is the SPY Super System. It's displayed in my room every day. I talk about this. This is, everybody can see the SPY Super System. They can only see the stocks that I've got. If they've got their own, they can actually switch from whatever stock whatever stock they want to look at. But here it is right here. Now there's a couple of some scans that we have. This is called a cascading up scan. This is looking for relative strength. This is looking for relative weakness. This down here is looking for strong bullish, strong bearish scans for swing trades. This is for swing trades. This would be intraday trades if you're looking for relative strength. These can be switched over to daily as well to find cascading up on the daily chart. Cascading up means is you get 3 higher closes on a stock. 5-minute candles or daily candles. Each candle is closing higher than the last one 3 times. Same thing on cascading down. Okay, and if you look down here, if I'm on a daily chart right here, if I just click on this symbol, it's going to bring up Nokia. There it is right there. Here's the daily chart on Nokia, and you can see you can see this. This is a decent setup for long here. You notice it's the institutions are buying. They just went over to buying. They're buying on multi-time frame. So this is daily. This is 1, 3, and 9 days because it's multiple time frames and it's breaking up. Now it shows a yellow candle, right? It shows a little bit of bearishness, but it's still a high volume candle on top of a high volume candle. This just means that it didn't close as high as this one right here. It's closed a little bit below it, but that's what you use for these swing trades. These would be swing trades right here. If I move down to this, see this VG. This is I don't even have enough data on this because it hasn't been around a long, but those are pretty nice high volume candles. I'd be interested in it. All right, here's P10. So that's what you do on these. And if you're on a 5-minute chart, if you go here and just go to 5 minutes, you click over here, you're going to see what these stocks are doing on a 5-minute basis. If I looked at, let's see, MU, there's Micron, last 5 minutes, there's 5-minute candles for the day. HIMS, see all the big volume here, the white candles. So when you're trading during the day, this is where you'd be looking for SPY super system trades or UMCAT trades moving up, and these would be SPY super system trades or UMCAT trades to the downside right here. Okay, but I'm going to move that out of the way so I can look at some Heikin-Ashi candles. So I'm going to switch this to daily right here, and I'm going to switch the style from candlesticks. I already got it on Heikin-Ashi, okay? And I'm going to look at a few trades. I'm going to look at a few that I looked at before. This is Kroger right here. This is Kroger. This is Kroger. This is the daily chart on Kroger, right? This shows you that the institutions are buying across the board here, right? They're green. They're buying on the 1 day. They're buying on the 1, 3, and 9 day. The trend is strong. You've been moving up. We had a big high over here, but again, you've got high volume candles pushing this trend up. That's a nice trend. So if it opens green on Monday, it's an excellent trade for a long, right? Costco. Let's look at Costco now. Costco also was strong, fairly strong. But you notice on Costco a couple things here. There's no white candle here. There's no volume, no big volume on this. You do have the institutions buying, but your trend is yellow. This is okay for a potential long, but you got to be very cautious because you don't have a high volume candle moving this thing up. All right, and NBIS, which I think was the one that popped up when I switched over here to NBIS. NBIS is a really, really, really nice setup. All right, it's a nice setup on NBIS here. Volume isn't high. It was high here, but it's still moving up nicely. But institutions buying. Momentum, you can see the momentum is steadily rising. Beautiful setup for a long on NBIS. And I'd put that one down if you're thinking of trading on Monday. This is a very good potential long. All right. On the short side, Newmont Mining. Gold was very weak on Friday. And here's the daily chart on it. Not high volume. We had a high volume candle here. See, this would have been a beautiful entry for it. Right here, as it breaks down and everything went to yellow and red, this is where you could have taken a trade. This is the 8 exponential and the 15 exponential on a daily chart. You can use those for support resistance on the daily chart as well. This is where I would have taken the trade if I was going to take it, right there. And I would have got out right there. But this is what you've got right now. You've got it breaking down. That's a good setup with Newmont. This, by the way, is not a this is not a Heikin-Ashi reversal. That's a Heikin-Ashi continuation. It's a continuation of an already existing bearish trend. All right. And I got a couple more just to look at. Alpha Salon, just had earnings. You're going to see a tremendous flush down in this one. You don't want to make sure that this isn't going to get a bounce back for this. That's off of earnings. But look at the size of this candle. Look at the volume coming into it. Very, very big to the downside. All right, Alpha Salon, Shopify also. Let's look at Shopify. Now, on Shopify, this is okay. It's okay. You did go from bullish to bearish right here. But the indicator is the momentum indicator is pretty high up here from down here. So I'd be very hesitant to take Shopify right now, even though it's telling me I've got a Heikin-Ashi reversal candle right here. All right, and just a couple more to look at. ISRG. This is a good one. ISIG is a very good potential short. And Meta, which is one I traded Friday as an UMCAT trade. Really, really nice move here in Meta. This is really set up as a short as well. Big volume, breaking down, institutions selling it. Trend is red, multi-time frame is red. That's a really nice setup, and it'd be another one I would note. Okay. I do want to mention one thing here while I'm on this. I guess I'm probably going to show it in a minute anyway, but I traded Meta yesterday as an UMCAT trade, out of the money catalyst trade, right? Where would I take it? Where did I take it? I took it right here, right? As the stock broke down below the VWAP, right here, this is where I took the trade. And I took it on this candle, and this candle. It doesn't seem like much, does it? I made 48% on my out of the money puts on that little move right there. Right, and then I get out when it flattened right out. But that's an UMCAT trade right there. See, everything's red or yellow, and you're breaking down with a pop out of the box symbol. And if I switch over to regular candlesticks, you're going to see you can see it just as clearly. But the Heikin-Ashi is what I'm focusing on right here. So Heikin-Ashi candles is what I use for that, and that's where I took that trade. Okay, so that is that's Heikin-Ashi candles. Anybody have any questions on that? Hey, Rafsine, you're welcome. Okay, let me go right back to the webinar here. Where is it? Right here. Okay. All right, so that was some Heikin-Ashi reversal candles. All right, so again, the color codes, we're going to talk about some more trades here. Green, blue, red, yellow, that's all you need to know. Okay. Now, this chart layout, which I've already showed you, it is optimized for clarity and precision. I added the 8 exponential moving average, and I use those, by the way, in combination with the 15. Being that if the stock comes down and breaks through the 8, if it's bullish, many times it'll stop at the 15. So if I'm in a trade and it breaks through the 8, most times I'll wait to see if it holds at the 15 and then bounces. All right, and it's vice versa on the short side. If it comes up through the 8, it might hit the 15 and turn around. So I do use them in combination with each other. And then I added the high volume candles to align with the SPY Super System current momentum indicator. Again, this is for bullish or bearish, increases the probability of success and larger profits. Okay. Now, the high volume candlesticks, I've had these in here for a while when I first put it out, just to clarify. High volume candles are white for bullish, yellow for bearish. This is 120%, stocks that are showing 120% of the most current 50 period moving average volume, right? So that's quite a big increase. Right, there's the chart. We've looked at that a couple times already. Now, what do we use for our basic high probability trade setups? Here's the criteria that is the process. All right, I'll look at the daily chart first. For any stock that I'm going to trade long for a swing, I'm going to look at the daily chart first. Very important, right? I don't want to trade short a stock that's got a bullish daily chart. I don't want to trade against my SPY Super System. SPY Super System is telling me that it's blue or green on the daily, on the multi-time frame momentum. I certainly don't want to take it short, right? So the daily chart needs to line up, and then I'll look at the 5-minute chart. Now for intraday trades, I'm only going to be using the 5-minute chart. I'm not going to be using anything else beyond that. Okay. We trade with the trend, both the stock and the market. This is what I call context. If the market is trending up and you got a good long and it's outperforming the SPY, that's a good trade. That's context. Both stock and market are trending up. Then you got to look at the SPY Super System. This is the deal breaker. SPY Super System has got to tell you that the stock is bullish or bearish in the direction that you want to take it. And then you look at relative strength. Once you've gotten all these stocks, then you look at the ones that have most relative strength of the market, and then try to enter near support or sell near resistance. All right, that's all there is to the criteria for these things. Okay. Let's see, how do we get Thinkorswim indicator for SPY Super System and IMS? Does it include the scanner? Yeah, if you buy the SPY Super System, the software, it's going to look like this. It's going to have the scanners on it. It's going to look like this. You're going to get, when you buy it, you're going to get all these indicators. Rightline will put it on your Thinkorswim platform. You don't have to buy Thinkorswim. You just download it, and they'll put it on here for you if you don't feel like you want to be technical to put it on there. They'll just take it over your machine, put it on there. It doesn't cost a thing, of course. And then you get all the updates and anything that comes later as we improve this thing. You'll get all of those. You get all these indicators. It's going to look exactly like mine with the same scans I have. Exactly the same. Okay, Donna, please repeat the 100% of what colors the candle. Yeah. All right. So when the SPY Super System, it finds what it's doing is looking for stocks. Let me get this back over here again. All right. It's looking for stocks that, to get a white candle, the volume on that particular candle is going to be 120% of what the 50 period moving average is. Right now, you can change it. You can set it up. You know, somebody can want to change it to 20-day moving average. I use 50-day moving average. So this stock, this candle right here, this candle right, this candle, the volume on these candles, 120% or more of what an average candle normally is. All right, that's what it means. 120% of the 50 period moving average, which on a 5-minute chart would be 55-minute candles. Okay. How do we get access to the Warish opportunity? 5 stocks. Oh, I don't know about that. That you'll have to get from Anthony, I think. I'm not sure. That was in one of the other presentations, I believe. The Warish opportunity. Okay. All right. So there it is. And here is our criteria. We call it the high probability trade setup funnel. All right. Now here's the UMCAT. We talked about this a little bit. This is the UMCAT strategy. A nice little logo here. And this is what AI will do for you, by the way. Produce this for me. The UMCAT strategy. These are the results. Now I've been tracking this since November 17th. And through February 11th, this is what we had. 170 wins, 27 losses, 86.2% win rate. But this is something you really need to take notice of. All right, the profit factor. Profit factor, if you don't understand that, is a really good indication of how successful a strategy is. If you have a profit factor of 1, that's breaking even. Anything with a profit factor of 2 is doing extremely well. Anything with a profit factor of 3 is exceptional. When you get up to profit factors of 4 and 5, you're in the outstanding. You're just not going to find a lot of strategies that have profit factors that high. That's extremely high profit factor, especially over a lot of trades. I mean, you can get that on 5 or 10 trades. You can get, you know, a profit factor of 20. But typically speaking, over a lot of trades, as long as if you're getting anything over 2, you're doing well. This is a 5.2, which is because we're getting in cheap and we're getting out quickly. This strategy requires you to exit as soon as that stock shows any kind of momentum failure. Sideways move, downward move, you got to get out. So you're not taking very big losses on these things. And if you catch them and they're a runner, like we had with that frog, you can be up, you know, 50, 100, 200% on these things. And we had profits based on $500 per trade at that point in time, 17.9. Now move ahead here to where we are now, from November 17th to March 13th. This is through Friday. Total trades 236. No, that's not right. This needs to be added together. That was an old number. Winning trades 239. Losing trades 41, 86% win rate, sticking right in there, 5.67% profit factor, 5.67. So this is a lot more trades, right? And our profit factor is still hanging up there above over 5.5. This is really, to me, this was pretty amazing that we could get these kind of results. It's a very important thing, the profit factor. And they'll tell you the SPY super system, I don't have them all displayed here, but the SPY super system, which we're using for the SPYs, the Qs, the IWN, and any kind of stocks on a 5-minute basis, have a profit factor right now of 4.07%, 4.07, but 5.67 on this UMCAT trade. But you've got to remember that these UMCAT trades, the setup has to be perfect. You've got to take them only when you've got those high volume and momentum, because you're going out of the money. And if you take it out of the money, put a call, and you start to lose momentum, the premium is going to strip out of those options very quickly. And I'm in the video I did on this, I'm very specific about this. Please don't just start willy-nilly take out of the money calls because they're cheap. It's a losing strategy if you don't have the proper setup for it. Okay? Okay. Yeah, this is something that Rory put together for me today. This is obviously the cumulative profits we have, you know, was basically the equity curve from when we started. This is, you know, we've had a couple of little drawbacks, but this is a pretty impressive one for me. Again, 5.87, $500 risk per trade, 85.3% win rate. That's really good. Okay, right, so UMCAT, here it is again. I'm going to show you a few more of these. This is the one I showed you before. This was on I know I didn't show you this. This was AAOI. They did this one on the 13th. I don't think so. I think it was before that. But anyway, This was on the 5-minute chart on AAOI. Right here at 10 o'clock in the morning is where I took the trade. I got right, get in right here, in at 208 and out for $4. Might have actually been on the 13th, but I'm not sure. It was late last week. So we're in for 208, out for $4, 93% profit. 10 contracts produced $1,920. Now you would have had to put 2,000 into this for 10 contracts, but I was just using 10 contracts as a point. If you were just doing 500, you would have taken 2 of them, maybe 3, but you still would have made a lot of money. But here's why I get out of this. Okay, here's the high volume, high volume, high volume. Get a little high volume to the downside. That's really unimportant because it's still high volume and it's not breaking down. Another doji, then a big pop, and this is where I took it off right here. It looks to me like it's starting to lose some momentum. I'm still green. Notice the institutions are buying all the way across this, but they noticed they switched a bit to selling right here. I got out of it right here. Okay, that was AAOI. That was when we took. Oracle, I showed you this Oracle one again. Institutions selling, breaking down, high volume candle to the downside. You've got to have a high volume candle to do an UMCAT trade. Please don't be doing UMCAT trades when you don't have high volume candles. All right, if you want to take the trade, nothing wrong with taking the trade. But if you had a nice breakdown here and this candle was red and not yellow without volume, just take an in the money put. Use an in the money put. That's really that's all you need to do. It's a perfect in the money trade setup, but you can't take UMCATs without high volume because it gives you a much more likelihood that the pattern is going to continue to the downside in this case. Right, and there's Frog. I've showed you that one already. Again, just a beautiful, beautiful trade. And that would have only been $300 to get in and $2,000 to get out. Big trade because the stock, these candles were actually fairly long. They were quite a bit of movement in these particular candles. And this is what you're looking for. You notice we took it right when it went from buying to selling right here, went from blue to yellow right there. We took it. That's where it went down. All right, now I'm going to go to some live charts here, as I'm not going to be going too much longer here. I'm going to go in some live charts to see some SPY super system indicators and the high volume candles in action. Again, this combination identifies not just when institutions are buying or selling a stock, but when they're buying or selling with major volume. Now remember, if you're doing swing trades and you're looking at daily charts, the same thing applies. If you're getting into a swing trade and you're entering a swing trade and you've got a high volume white candle or a high volume yellow candle to the downside when you're entering the trade, you have a much higher probability of success because the institutions are in there with force. On daily chart, it would be for a swing trade. Same thing that we use here for 5 minutes for the UMCAT strategy for intraday trades. All right, so again, we're going to look at some live charts so we can see the exact setups, which we've already showed you several of these for both the SPY Super System and the INCAT. Again, these extremely high probability trade setups use the SPY Super System indicators and the high volume candles on the 5-minute chart to identify setups, right? This combination identifies not just when institutions are buying or selling, because we got to know that, but when they're buying or selling with major volume, right? And both of these are very powerful intraday strategies, produce win rates over 85%, as well as profit factors in excess of 4, which I've shown you. This is really if you don't understand profit factors, please look it up or put it in your ChatGPT or your Copilot and say, what are profit factors 1 through 6? How do you rate them? And see what you get back from there, because it's going to tell you that these things are really powerful. All right, so I'm not going to keep going over that one again. This was a trade we took in NVIDIA, an intraday trade right here. This was before I had high volume candles. But you notice the institutions selling, institutions buying, pop out of the box on the 5-minute above the VWAP, above the 8 exponential. Take it right here and write it up right to here. That's a trade we actually took on NVIDIA here. And this was a SPY super system trade, 5-minute chart. This was a SPY trade. We got it here. See how the institutions were selling? Institutions were selling. It broke down below the VWAP on the 8. We had a pop out of the box. We take the trade. And the 8 becomes your stop. So you just stay in it as long as the stock doesn't close above the 8. And probably you would have got out right in here. This would have been the last candle you would have stayed in on. All right, there's another SPY to the upside right here. Yellow selling, blue buying right here. You take it right here, you write it right up. And if we had colored candles, some of these probably would have been white. That's how you find these. well, we talked about emotions, right, before. This is kind of important. The fact that people that trade with emotions are going to end up losing money. And what's emotions? Well, everybody knows the market moves on fear and greed. Fear and greed, the two biggest emotions. But don't forget, there's a couple of other things in there. One of them is anger. When you have a losing trade, this revenge trading is a real thing that people take. They'll try to get even by going back to by taking a trade and doubling up in the size or whatever. They're trading out of anger. Or if you've had 3 or 4 winners in a row, you feel like you can't lose. Now you're trading out of elation. You feel elated that you beat. Now you start taking trades thinking everything is going to work for you. Those are all emotions. And when you're trading with emotions, you're trading in a dangerous territory. This is what you're going to look like eventually. All right? This is what you look like if you've got a methodology and a strategy that you can follow all the time. You know you're not going to win every trade, but you know your probabilities of winning are very, very high as long as you stick to it. Okay. Rommel, what strike and date do I use for this day trades? Typically, I'm using weekly expiration for most of these because if they have a expiration, first of all, I don't take UMCAT trades out of the money or SPY super system trades if the stock doesn't have weekly expiration. It has to have weekly expiration. So for UMCAT trades, I'm going to use Friday's expiration unless they have something other than Friday. There are some stocks, all of Mag 7, AVGO, all the silver and gold stocks, they all have expirations every other day. So I'm going to take the closest expiration date I can get for those. And now on the SPY, if I'm doing a SPY super system trade and it's late in the afternoon, say it's 2:30, 3 o'clock, what I'm going to do is I'm going to take the trade, but I'm going to use the next day's expiration, not with intention of holding it overnight, but to do that to limit my time decay on the trade if the stock starts to move sideways. Okay, one strike. I go one strike out of the money with the strike expiration of this week. But remember, I'm planning on getting out of these trades that day, right? So I'm going to take the closest expiration I can get. So Monday through Friday, I'm going to take Friday's expiration if that's the closest expiration, and I am usually going to go one strike out of the money. But in the video I did, I tell you that how far out of the money you want to go in an UMCAT trade is dependent upon the volatility of the stock. Something like Tesla, you can a lot of times you can go $4 or $5 out of the money and still do very well. So yeah, 0 DTE dates, correct. If it is 0 days, the next expiration. Something like APP, Apploven. This stock moves sometimes $25, $30 a day. You can take it out of the money, $7 out of the money if you catch the direction right, and you're going to get them cheap, and they're still going to make it. So, but if you're using like Verizon, Procter & Gamble, Microsoft, something that doesn't make big moves, then yeah, one strike out of the money is probably where you want to go with something like that. I do zero DTE trades, yes. I do 0 DTE on all of these if they have expirations that day. Absolutely. SPY and SPX. I'll do 0 DTE on SPY, yes. I'll take because if I'm doing a SPY super system trade on the SPY, I'm anticipating getting out today. This is going to be a quick trade. I'm not planning on holding this overnight. So I'm going to take the cheapest options I can get with the quickest expiration, which is 0 DTE, unless it's late in the afternoon. And then I'll take 1 DTE just to mitigate any kind of time decay for that day. Because if the stock starts to move sideways, the expiration today is going to drop much faster. The premium is going to drop much faster on today's expiration than it will on tomorrow's. Okay, and I think I go into that in the video I did. Okay, all right. Process, procedures, results. I've talked about this. Please learn the strategies and the methodologies before you start watching your P&L to decide if you're making money. A lot of people look at the P&L to tell them whether a trade is good or bad. It's not. You should be trading off of technicals. You should not be trading off your P&L. It's one of the biggest mistakes people use. Index is 0 DTE, stocks 5-7 days out. It's 0 DTE is going to be on indexes are going to be this week, and typically unless they have an expiration, the SPY has expirations, basically every day. you know, and gold has them every 2 days. And this Mag 7 now have expirations every 2 days, Monday, Wednesday, Friday. So I'm taking the closest expiration I can get, not 5 to 7 days. Okay, so again, focus on P&L without having to follow solid process to follow is going to really mess you up. A lot of people follow their P&L. You should never look at it. All it does when you're watching your P&L is instill emotion into your trade. Seeing whether you're making or losing money is automatically going to instill emotion into you. Please don't look at your P&L. All right, in the alert service, we talked about this. It's just for day trades and short-term swing trades. It's not an investment type alert service. If anything that I post in the room that's a swing trade is also going to go out on the alert service, but the intraday trades are not going to come out of the alert service. They're too quick. Again, designed for traders who can't watch the market all day. It's going to have real-time alerts on the highest probability trade setups. What does that mean? It means stocks that the institutions are in, and when the market's moving in the same direction, market internals are bullish for a long, bearish for a short. That's where it's coming from. We just put one on ENPH on Friday. All right, this is my equity curve for the trade room. The actual trade room, these are trades. This is $2,000 per trade, and these are the trades that I posted. So if you followed my posted trade, you're at $2,000 per trade. Your equity curve would have looked very, very similar to that. All right, and these are the SPY Super System option room trades here. All right, these are the trading results. 2003. If you took every trade, 2,000 into trade, we made about 60,000. All right. 2024, 2,000 per trade, about 55,000. And 2025, 2,000 per trade, about 55,000. And one thing to remember on your trade, your profitabilities in these trades, a lot of it has to do with how the market's moving. Trending markets, much easier to make a lot of money than choppy markets. This market, particularly in the last 3 months, has been extremely difficult to trade swing trades. You've got gap ups and gap downs all over the place. You've got tariffs driving the market up, driving the market down. Then you've got oil problems driving the market up, driving the market down. It's all over the place, so it's much more difficult to trade. So your trading results obviously are going to be higher on trending markets and lower on choppy markets. And I try to bring this up in the room all the time to try to let people have an idea of whether this is a good time to increase your size. This is a good time to cut way back on your size, right? Low probability trading environment versus high probability trading environment. All right, this is I'm not going to go. This is some trades we put back last year when the tariffs went on. We had 4 trades on in the room and on the alert service. They made huge money. Nike was up 216%. All right, so I'm just going to cover. This is January 2, 2026. I think this is the last one I've done so far. 13 wins, 2 losses. These was in the room. If you were in the room, you would have seen these because these all get posted. Most of them got alerted. 2,000 in each trade only produced 2145. That's a small month. It's a very weak month for the service, but we didn't take a lot of trades. Right? January, February, March, April 2025. Again, you can see the win rates: 84, 89, 83, 81. It stays within that range most of the time. The wins vary. Again, here's a month where we had a really trending market: 7,800, 3,800, 5,000. That's pretty average. And again, here's some May trades. So what I want you to see is what you normally see on these trades in the room and on the alert service. These are not the UMCAP trades or the SPY Super System trades, because the only results I've got on those are the ones I actually take, and I can show you that, and I've showed you that, but I don't post them. So I point them out, but I don't post them. So everybody is kind of on their own in those trades. But again, you can see the 20, 24, 20, 28, 25, 71, 32, 38, 60. This is the kind of percentages of gains you'll see, and losses. You will see some losses, obviously. In June, I was on vacation for a couple of weeks, only took 11 trades, still had a 91% win rate. But July, lots of trades last July, lots and lots of trades. Again, you see the percentages hanging in there with about 30, 20, 40, 60, all in the range, and we had a few losses. 30 wins and 3 losses, a big month for us last July. 91% win rate, 2,000 invested at each trade produced almost $17,000. That's a big month. That's a very big month. That's not normal. Normally, you're going to see somewhere in the neighborhood of 2,500 to 7,000 if you're taking all the trades in a month. All right, August 20 and 4, 59.60. September Again, pretty nice 21 and 4, but I'm not going to keep going over these because it just, what you're going to see is we have almost every month we win, we have a winning month. I had one losing month, I'll show you that. But October to December 2025, 45 and 9, 83% win rate, 47, 48. And these October, December, very difficult trading conditions, very difficult. All right. Now this is, I'm not going to go out through all this. September 2024. Now the alerts, by the way, just if you're on the alert service, this is what you're going to see. You're going to get an alert, an SMS alert. It's going to have the date. It's going to have the ticker, like Nike. It's going to say buy April 11th, 67 puts, for example. This is telling you the April 11th, that's the expiration date. 67 puts, that's the strike price. Here's what you should be paying for it. And that I could say 285 to 290, something like that. Then you'll get another one later that's going to say same thing. It's going to have a sell order for 9. So you place a sell order, good till canceled. And then when it gets sold, you're going to get one that says, okay, it was sold. And it's important to understand that you could get another one. I could change it from 9 to 850 or 9 to 950. You get another alert telling you what's going on with the trade. Okay. And how do we receive these stunning results? Well, I think we've talked about that, right? We know when the institutions are in the trade and we're taking them. And again, we do triple screen assessment on momentum, multi-time frame, trend, also some money flow. This is what the SPY super system is calculating. Right? So we've seen this multiple times. You also, by the way, if you buy the SPY super system, you get 2 templates. You get this template, and you'll also get one with just the current time frame momentum on it. This is just for folks who just want to trade intraday trades off the 5-minute chart. And you get them both, and you can swap them back and forth on your platform if you want to. All right, so this was a SPY super system, hike and action reversal entry. I think I've shown you enough of these. You can see this is coming off the 15, it's selling off here, down it goes. All right, beautiful trade right there. That was on 221.25 using the 5-minute chart, hike and action reversal candle. SPY super system. I'm not gonna spend a lot of time on this. The SPY super system off the SPY Qs IWM. When I started this a couple of years ago, this thing has been killing it. And the thing is, there's a lot of trades. You'll notice in August we had 56, 6, and 2. These are very quick trades, but it's important to remember that you're going to have one trade on at a time for an intraday trade, and they're going to be short duration trades. Okay. There it is for again for November, December. Question here: can I show how the scanner works, and how can we find the best trade setups? Yeah, I mean, you're scanning through stuff all the time. I have scans on TC2000 that I use as well to find some stuff. But the TC2000 scans, I mean the Thinkorswim scans, I'll show you in a minute. I'll bring it up and show you exactly how those work. Again, what you'd be looking for is a cascading up, cascading down for intraday longs and intraday shorts, for SPY super system trades, or for UMCAT trades. The scanner that was at the bottom, which is the one Wyse bullish, one Wyse bearish, those are swing trades that you'd be looking at for potential swing trade setups. All right, so here's the SPY super system trade. I think we've seen enough of these. This is when I first started showing people this. Institutions, see how it went from selling to buying. Stock broke above the 15 in the VWAP. This is where you take the trade. This is where you get out of the trade. This keeps going up, and these was before high volume candles and before the 8. All right, I'm not gonna spend a lot more time on these because I think you've probably seen this. Again, these are more recent trades. So this was a line. We took this as actually a swing trade. This went out on the alerts, but I ended up getting out of the trade after an hour because we were up 51% on it. You notice that right here it went yellow to red. Green to yellow right here. This is where we took the trade as the institutions went from selling to buying, and they broke down below the VWAP with a pop out of the box symbol. That was likely was a high volume candle, but we didn't have them at the time. All right, and here's another one, URGN. This is NVIDIA. This is a day trade. I made a daily trade. This is a swing trade right here. This is where we get in. SMR, another good one. This was a Nike trade that we took. We actually took it here, right here on this 28. This is where we took the trade. Notice the institutions are selling the heck out of this thing. We wrote it, and then we got the news on the tariffs, and it plummeted down. That's where we got the 216% off of Nike. All right, SEPS rep, the same thing. Another trade in HIMS here. Okay, so that, again, I don't want to, it's a little after 5 o'clock. I know everybody's had a long day, but anyway, that's how this system basically leverages looking when the institutions are in the trade and when they're not, and how much volume they're coming in with. Those things plus our indicators give us the edge that we have over other retail traders. And, you know, to be able to produce 85%, 86, 87% win rate month after month, we've been doing this for 5 years now, and I've been doing it since 17 years. You have to have, that is some consistency, and there has to be some validity to these particular, these strategies and these indicators. All right, so we covered all that. And here's the SPY super system. Again, SPY, Qs, IWM futures, you can use it on stocks and the UMCAT trades. We've covered those. Right, I have videos on all of these things. If you come into the room, you're going to be able to see this every day. Okay, and before I'm going to do I'll do this pricing here on this, and then I'll show you the SPY super system scanners right after, again, with that Theo. Okay, all right, so here we have the trading room and the text alerts. This is for the trading room and the text alerts. We've got two things: trading room, text alerts, and the software, SPY super system software. The trading room uses the SPY super system. I have it posted every day, but you know, so you can see it out there. But if you have your own, you can use it. Again, quarterly membership, you get 2-week trial. You get the text alerts. You get my trading room for 2 weeks, and then you get the Wise Way to Trade options. This is the videos. There's about 31 of them, and you also get access to a private Discord chat. So this gives you a quarterly membership. When you go from after your 2-week trial, you can switch over to quarterly. It's $396 for the quarter after the 2-week trial. Now, if you want to do cheaper, obviously you do the annual membership. The annual membership, $14.98. That gives you the room and the alert service and all the same stuff here for a year. Right, and then the best deal, like, is the one-time payment. This you get in the room and the alert service forever for $19.98. And these are the codes you should use, 50% off. By the way, they'll be in the chat box. If you go to the chat box, the information will be there on the SPY super system trading and the SPY super system software. Okay, is it just for SPY trades? Absolutely not. Absolutely not, Theo. It's for any trades, any stocks that you want to follow or trade. All right, so this is the best deal there, $19.98. One-time payment, you have it forever. You have the alert service forever. The software, the SPY super system software, this is a pretty good price. $14.98 for a year. Put in, say, $500. That gives you the SPY super system software. It also gives you a free month in my trading room. You can try the trading room for months. It gives you the market scanners, obviously, all the videos, and it gets installed on your machine for free from Rightline. Any updates will get installed in your machine as well. You know, all you can do one-time payment, $19.98, only $500 more. You get this forever. You'll have the SPY super system forever. Any updates that come along, you'll always get that. So it's really an outstanding deal. I mean, when I bought this before I started this trading room, so I actually paid for the SPY super system because I was trying to find a way to get around some of these algos and some of the things that they were doing to the methodologies that a lot of retail trades that it used, and it increased my percentage win rate by 8%, which is massive, massive. All right, so those are your two. There's the trading room and the text alert. Again, they're in the chat box as far as linking to them. And here's the SPY super system, the software. This is, by the way, the return on a subscription investment. I'm figuring $1,600 is the most you can pay a year. That'd be like 3-4 quarters. Average trade size 2,000. The result of this has been 40% ROI. In other words, you're getting 40 times your investment in this back. 40 times what you're normally paying for that. Obviously, a lot more than that if you're doing an annual or a yearly or a lifetime. Right? So subscription is consistently paid for itself. ROI, simple math, proven results, and always a disclaimer: past performance is not indicative of future results. We don't know what's going to happen. All right. So those are your options here for trades, so to speak. Options for the options room, your subscription service, and I want to show the scanner here for Theo. Okay, so here's your scanner here. Now, the SPY super, you said just for SPY. A lot of people use it for SPY trades and Q trades. I mean, I do. That's what the SPY super system initially was for. But you can use the same criteria for stocks, and it's still called the SPY super system, which is you've got the current time frame momentum is in your favor. The stock is breaking above for bullish or breaking below one of your three support resistance levels, the VWAP, the 8 or the 15, right? And that's what you need for it. Now, to cap trade, you get the same criteria, but you have to have high volume candles, and in other words, momentum here. You have to have real strong momentum that's coming through, shown by these high volume candles. Now over here, if I'm looking at stocks that are cascading up, this is where I would look for cap trades and SPY super system trades on the stock. If I'm just looking to trade the SPY, I don't have to use a scanner, obviously. I can just put the SPY in place and see, is there places yesterday I could have taken a trade in the SPY? Probably. I mean, I typically right here, you could take it short because you see the high volume. That could be it. And you could have taken it out of the money. You also could have taken it short here with the SPY super system trade, but that would be in the money, right? So there's several opportunities come along during the day. Here's the cues. But if you're looking to trade the SPY super system on the cap trades, then you would look up here and you'll be looking for stocks like as MU, right? Micron. Finding a location, finding a spot to take the trade, most likely long because it was very bullish yesterday, right? And you would probably want to take it early on. If you're going to take it here, I wouldn't take it before 9:45. You want to give it some time. But there's where you could have taken MU. There's HIMS. And again, this scanner is going to show anything that's got 3 candlesticks or more moving up in the same direction, right? So there they are. It could have ended the day with a nice trade at HIMS to the long side. This was a bearish trade in HIMS as it went yellow and red here as it coming down, but you wouldn't take out of the money. You would have to take in the money because there's no high volume candles. All right, it's not that complicated, but it does take a little while to get used to. Obviously, his Genie was a beautiful short in Genie, and you have to know what it's doing that day. If it was up for the day, typically I'm not going to take a stock short if it's long for the day. That's what you're going to find. Okay, does that help you out, Theo? Okay, great, very good. Again, these would, and I showed to these. These will be for swing trades. You switch over to a daily chart over here to take these stocks. Do I want to take them long? And then I have one that's bearish right over here. And there's probably a lot more bearish ones in here than there are bullish ones because yesterday was a terrible day in the market. So there's your swing trade for American Airlines. Look at that. Coming down high volume. Bank of America coming down. SOU. And no high volume at the end of the day, but you had some in here. Key. These are daily charts, by the way. So this is showing what's going on a daily basis. So if you had these and you'd seen them earlier, obviously you could have taken it short earlier. CMG, nice short on CMG, but no high volume one. You're really looking for stocks with high volume to the downside here, right? Yellow candles in the last 2 days or so. And American Airlines was kind of shows you how strong this has been to the downside. And had high volume. Notice the white candles in here, but they weren't going anyway. Notice they're white, but they're filled in. They're actually, these are Fibonacci. If I show you the actually regular candles, you're going to see open candles. These are bullish, but high volume, bearish, high volume. So you're getting kind of interspersed high and volume candles, a lot of buying and selling in American Airlines, but overall it's bearish. That's what you do for swing trades is right here. You use this particular scan on the bullish or bearish scan right here, and you switch to a daily chart, and you're going to find them there. You're looking for a stock that in this case is short, is coming up with volume, just like CLF is coming up with volume here. High volume breaking down looks pretty good. CLF. Obviously you got to look at where's my support resistance levels on it, where's my 50-day moving average, all those kind of things. It's going to show you. Like I have TC2000. This is TC2000. This is my scanning program. See, this is CLF. You see how nice this is for a short. See how it's broken down after earnings. Definitely a good short setup. And this is telling you exactly the same thing, and it's telling you with volume. Now, I still do not recommend taking out of the money puts or out of the money calls on the daily. Use in the money. Always use in the money. But this tells you you've got some high volume pushing the stock down, and that tells you you got a much higher likelihood of success on it. a text alert offer for the UMCAT. I can't, as I said, again, I cannot alert on UMCAT trades, right? I can, if you can look, you can learn it on the videos, but you've got to take them yourself. If I've got a trade that's going to last 2 candles or 3 candles, 5-minute candles, there's no way for me to learn on them. I can't even post them in the room because by the time I type in the trade, put in the price, the strike price, half the trade might be over. So I call them out in the room when I see them. But the easiest way to do that is is to learn the strategy off of the video that I've done, learn those criteria, and ask me about them when you're in the room. Because I got a lot of people pointing out some really good UMCAT trades during the day that I didn't even see. But I cannot learn on them. There's no way. Where can I download each of your scans to my SPY super system? I already have. Yeah, James, probably the best thing to do is just, if you don't have them, just call Rightline or email Rightline. Tell them, you've got the SPY super system, you want the scans. They'll put them on there or they'll send them to you. Okay, you're quite welcome. All right, everybody. Thank you very much for being here today. Listen, I appreciate all the questions. I hope I was clear on this. I know there's a lot of material to cover. I understand that, but I'm pretty excited. I mean, I love trading options. I'm not a professional presenter. I'm not a salesperson. I'm just a trader. I just trade options. That's what I've been doing for a long, long time. But I know a system that works here, and I'm just trying to bring that to many people, because what I try to do in the room is to try to help everybody become better. I mean, that's all I'm trying to do, is make people consistently profitable. Learn so you can end up being an individual, independent trader on your own. All right. The offer links again, it should be in the chat box. It's in the chat box, I think, Michael. And if you can't, just call Rory, 786-732-4656. I'll leave that up there, so you can do that if you want him. And he'll go over each one of the options that there are. There's the just use save 50 if you do want a quarterly, save 50% over here if you want to do the annual membership, and then there's save 50% on you'll see these 3, right? Either the quarterly, the annual, or the one-time payment, and then you've got the 2 for the software, the annual membership and the one-time payment. And Rory will take care of that for you if you just call him. If you look in the chat, I mean, I can see it in the chat. I can see the alerts in the chat box. Not the alerts, but the actual links to the orders. Okay. All right. Listen, thank you, everybody. I appreciate you being here. I appreciate all the questions, all the participation. I really do. And I hope everybody has a great weekend. Hope to see some folks in the room on Monday. Have a great weekend. It's been a very volatile market, extremely volatile. You don't know what's going to happen on Monday. Oil prices shooting up over $100 a barrel. So it's been very exciting trading. The thing for me, for an intraday trader and even a swing trader, I honestly don't care whether the market goes up or the market goes down. We make money both ways. It's just a matter of reading the trend and trading the trend. That's all. Oh, you're welcome. You're welcome. Very much appreciate you being here today. Thanks very much. Have a great weekend, everybody. See everybody. Hopefully see a bunch of people back here on Monday.
Thank you, David, for that excellent presentation and those valuable trading insights. If you'd like to learn more about David's strategy, we've placed a special discounted link in the chat box. And in case you can't see it, give Rory a call at 786-732-4656. And that brings us to the conclusion